Uh, a very good morning to everyone. Today we have a session on issues in valuation and section 56 by Dr. Anup Shah. I would like to formally introduce the speaker for today. He is BCom from Sydenham College. He is a fellow member of ICAI, having 19th rank in All India CA final and 11th rank with distinction in Inter CA. He has authored and co-authored several books, uh, including Handbook on Capital Market Regulations, Wills, Succession and Family Settlements, Law and Business. Uh, he is also a director as an independent director in various listed companies. He is member of editorial board of BCA's journal and also member of international tax uh, of the Chamber of Tax Consultants. Uh, Personally, I would like to quote what one of the participants said. It is magical to hear to him. Also, I would like to say that it is his knowledge is such that I feel he is not less than a library, having knowledge in so many laws and always updated about the same. We welcome you, sir. Before handing over to Dr. Anup Shah, I would like to Mr. Jaydeep to hand over a memento. The stage is all yours.
Thank you, Ujjwal, and good morning. Even though the physical presence is very thin, but it's even nice after 2.5 years to be standing on a podium and talking, because I've been so bored giving lectures online that this year I decided I'm not giving any lectures online, because in the first year in 2020, I went overboard and then I got really bored. So this year I had said no virtual, but since Deepak said it's physical, I immediately agreed. So it's nice to be standing and talking for a change. And yeah, we will just. Yeah, that's fine. So what we intend to cover, friends, in the next hour and 15 minutes are issues in valuation and section 56.2. Actually, it should read issues in section 56.2 and valuation, because first comes the section, then come the valuation rules. So we'll try and look at what are the main issues under section 56.2 and then look at some of the valuation issues. Excuse me. Is there a pointer or something? This is in slide change. Okay. Okay. Yeah. So the scope of our discussion would be section 56.2, which has two subsections. Section 56.2.10, which deals with receipt for no or inadequate consideration, and sections 56.2.7b, which talks of issue of shares at a premium, and then the valuation rules for each of these sections. Let's first look at income from other sources under 56.2.10. Now, this section has a history. It originally was born as 56.2.5, which spoke of receipt of money for no consideration. Then it became 56.2.6, which again dealt with money. Then it got branched out into three parts. 7, which dealt with money and immovable property received by an individual or an HUF. 7A, which dealt with unlisted shares received by a company. And 7B, which dealt with issue of shares by an unlisted company. Ultimately, 7 and 7A metamorphized to become 10, which is currently what we have on the statute, 56(2)(10), which deals with various types of property received by any SSE. 7B remains intact, dealing with issue of shares by an unlisted company. Now, this section deals with 3 types of property which a person can receive. First is money, second is immovable property, and third is other property, which are defined to mean certain types of movable property. And it has come into force on or after 1st day of April 2017. So applies from AY 17-18, previous year 16-17 to any person, whether resident, non-resident, or resident but not ordinary resident. Definition of person under 231 would apply. Earlier sections did not expressly cover an AOP or a BOI who was the recipient. Now there is no distinction in applicability. So irrespective of who is receiving, everybody would be covered. Applies to receipt from any person, just as it applies to receipt from to any person, it applies to receipt from any person, subject to the exceptions. And the application is at the stage of receipt of the property. Receipts prior to the date of this coming into force would not be covered by this provision, but would be governed by the earlier provisions if they were applicable. Property has been expressly defined in an exhaustive manner under explanation D. So only what is property will be covered. Any other type of property, even the property as understood in generic law, will not be covered. Explanation E defines a whole list of relatives in an exhaustive manner. So only those relatives who are defined would be covered by the exception. Other relatives, even though relatives in law, will not be covered. And Rule 11 UA lays down the methodology for determining the FMV. That's the fair market value. Section 2, subsection 24(17)(a). The definition of income has been amended to include receipt under 56(2)(10). So now that is also part of the definition of income. And section 49(4)(10) states that the cost of acquisition of a capital asset received by somebody on which 56(2)(10) taxation has taken place, the fair market value would be stepped up cost. That is, you would substitute the original cost with the fair market value on the basis of which you have been levied tax. The reasons for introducing this provision, now these are very interesting and they have been referred to in some tribunal decisions also. So the memorandum explaining the Finance Bill 2010, which was for the earlier avatar of 56(2)(10), and the memorandum explaining Finance Bill 2017. These provisions are introduced as a counter evasion mechanism to prevent laundering of unaccounted income in the form of gifts. So this is an anti-laundering, anti-tax evasion statute, and this genesis has to be borne in mind when you're looking at this provision. The intent is not to tax transactions in the ordinary course of business or trading transactions, the profits of which are taxable under business and profession. And the existing definition of property has been expanded, and these are anti-abuse provisions. So time and again, the memorandum is explaining these are anti-abuse, anti-laundering, anti-tax evasion provisions, which have been introduced to prevent tax evasion in the form of receipt of gifts. So after the Gift Tax Act was abolished in about 1997, till 56(2) was introduced, there was a lull. And during this period, a lot of tax evasion is purported to have taken place via giving of gifts, because there was no tax either on the donor or on the donee. Coverage, very interesting. It's for the recipient. Now, if the recipient is a minor who receives a property for inadequate consideration, who is the person who we have to tax? Is it the minor or is it his parent? Because clubbing takes place under section 64. So you have to look at everything from the minor's perspective, carry out any exceptions from the minor's perspective, And then if there is a tax, it is clubbed. I mean, if there is a taxable income, it is clubbed with that of the parent. So in Lucky Pamnani, the Mumbai Tribunal had an occasion to look at a case where a minor received a gift from a relative of his father. And the father said, since clubbing is taking place in my hands, you look at the relative also in my hands. And the tribunal said, no, the recipient is the minor, and therefore only a relative who is a relative of the minor as defined in law would be an exceptional category, not your relative. So that shows who is the person with whose viewpoint do you have to see the section. Property must be received without consideration. Now it's very interesting that something which is the edifice of this section, receipt for inadequate or no consideration, the term consideration has not been defined under the section. What do you mean by consideration? So you need to go back to basics of law, Indian Contract Act section 2D. Any act or absistence of an act done by a person at the behest of another in return for something is known as consideration. So what does consideration mean in general contract law? And this has been defined in 1872 prior to independence, and it stood the test of law. You do something or you agree not to do something in return for something. So that something which you are doing or not doing is consideration. It could be in cash, it could be in kind, it could be in money, it could be in money's worth. We have two important decisions under contract law, Chinnaya versus Ramaiah Madras High Court and Keshav Mahindra Bombay High Court. In Chinnaya versus Ramaiah, the Madras High Court said consideration can flow from a third party or a stranger to the contract. It's not necessary that only those parties who are privy to the contract should be those who give the consideration. So here a mother agreed to make a gift to her daughter in return for the daughter taking care of her maternal uncle. And then the daughter said, there's no consideration from my uncle. Why should I take care of her? Take care of him. So the court said, no, consideration flew from your mother, who was a third party, and therefore it was valid in Indian Contract Act. In Keshav Mahindra's case, consideration flew to a third party, and the contract was upheld as being valid in law. The Jeep company, which we have today of America, agreed to give a distributorship to Mahindra and Mahindra in return for Mr. Keshav Mahindra renouncing his rights issue entitlement in favor of Jeep. And the Bombay High Court said this was not a gift by Keshav Mahindra to Jeep company. It was a tripartite arrangement where one entity gave a dealership to another in return for rights issue renunciation in favor of the first entity. So consideration can flow from and to a third party to the contract also. Would these be valid propositions under the provisions of 56.210? I think yes, because when you say consideration and you do not define it, then I have to go to the Contract Act. And if I have to go to the Contract Act, then whatever is consideration in that law will also apply in this law. That is what I would believe is a valid principle of interpretation, that if I'm going to one law, I would take everything under that law into this, because there are no exceptions or carve-outs under the Income Tax Act when you define consideration. Similarly, alimony receipt, something there is a divorce going on or a separation, and one of the spouses receives alimony. Can it be said it's without consideration? Obviously, no. The mental harassment and the giving up of the marriage is valid consideration. So it need not always be a property or a money's worth which you get. Even this would be valid consideration, and that's the view of the Delhi and Mumbai Tribunal. If you get motor accident compensation, there was an accident and you received compensation from one of the parties, physical harassment or physical injury is also consideration for a contract, and therefore the motor accident compensation would not be a gift. It is not taxable under 56.210. Interesting question before Mumbai Tribunal in Chandrakant Shah and Punjab Haryana in Saranpal Singh. If you give a loan without interest, can it say that the borrower has received a gift on which 56.210 is liable to be paid? First of all, look at it. Is a loan a gift? Is not the genesis of a loan that you have to repay it at some point of time? Then where is the receipt without consideration? And even if you say that the 0% interest is a gift, there may be certain other business exigencies because of which the loan was given at without interest. Hence, the words of the tribunal that the department cannot get into every action of why a businessman does something. There are certain business exigencies because of which he would have given a loan at below interest or at free interest. And therefore, such transactions would not fall within the purview of 56(2)(10). Compensation for agreeing not to contest a will. There is a will, and as you would appreciate, wills need to be probated in many cases. Now, a probate means that a court of law will decide whether this will is final or not. And if there are conflicting parties, then one of them will present its case, the other would oppose it. What if I pay off the person who is opposing it and tell him do not oppose it, and therefore my claim goes through? The person who's receiving consideration is giving up a valuable right of not to litigate. And a right to litigate is a valuable right. So when I'm giving up that right, I have received consideration for giving up something, and therefore 56(2)(10) would not apply. That again is the Mumbai Tribunal's decision in Parvez Poonawalla, that when you are giving up a right to contest a will, you're not doing it free of cost. Harassment compensation. Here, not under the pretext of 56(2)(10, but quite relevant. There was a harassment case levied against one of the executives by one of the film stars, saying that during the ad shoot, she was harassed by this executive. The company decided to pay her a compensation for her willing to drop all cases against the film star, against the executive. And it was held that this is not a business income in her hands under section 28. It's not a perquisite or a gain because she has suffered mental anguish. The issue of 56(2) was not examined in this case, but I believe it would be equally relevant, and the analogy given by the Mumbai Tribunal would apply. Mental anguish is also consideration. So just as physical injury is consideration, mental anguish, emotional anguish, all of these are valid consideration which have been suffered. And if you're getting money in lieu of that, you're not getting it free of cost. You are getting it because you have suffered something. Mumbai Tribunal, an interesting decision. I don't understand how this went to the courts also, in Sanidhi Patel, where she gave funds for PMS management to a PMS agent, that's a stockbroker. And there was a power of attorney in favor of the broker to carry out discretionary portfolio management. The issue was it a gift received by him of the shares and the funds? Obviously, no. He's not the ultimate beneficial owner of the funds. He's only owning them as a custodian for and on behalf of the PMS owner. Therefore, he's nothing but an agent or a bailee, as we would call it in contract law. And a bailee would never be the beneficial owner. Therefore, the funds are returnable to the owner. He is answerable to the owner, and he cannot be made to be levied to tax under 56(2). Advance received towards land sale, but land not yet transferred, advance not yet received, period of 3 years elapsed, no action taken by the payer. Here, the Mumbai Tribunal in Nilesh Thakur has taken a view that the advance is not taxable in the hands of the recipient of the advance. Now, while this decision is good, I would not take it as the binding principle, because you would have to see every advance on the facts and circumstances. There have been certain cases where advances have been pending for years together and no action taken. Then there would, or there could be, a question mark as to whether this is a genuine advance or whether there is something more than meets the eye. And if the recipient is a company, you would also be advised to look at the public deposit rules, because if you received an advance which is not appropriated towards goods and you are not returning, there's a possibility of the advance turning a public deposit and then you violating the Companies Act. So be cautious when you are looking at such things and look at the facts and circumstances of each case. Compensation for cancellation of a contract. A contract or a right under an agreement is a valuable capital asset which a person has. If there is agreement is cancelled and you're receiving any compensation, are you giving up something? Yes, definitely. You had a valid contract which is now being cancelled. Termination of the same, if you receive any compensation for that, it would not be taxable. And there are decisions in the past which have held cancellation of contract to be a capital receipt, like Gujarat High Court in Minor Balabai, where they said that when a contract was cancelled, what you received is capital receipt. On the same logic, 56.210 was also held to be not applicable. Award received by an amateur sportsman. This was in the context of Jaspal Bindra, the ace shooter, where it was held that if professional sportsmen receive an award, they are taxable under section 28. However, for amateurs, these are capital receipts, and therefore the section should not apply. Now you would have to then draw the line as to whether he is an amateur, whether he's a professional, or if he was an amateur who has now become a professional, at the time he received it, whether he was an amateur or a professional. So all this again goes into the realm of facts. What is the nature of property? Is every property exempt or is every property taxable? It is only property which is capital receipt for the recipient, which is taxable under this section. Character in the hands of the giver, that is the transferor or the donor, is immaterial. Now, what is capital asset has been defined in section 214, and that does not say this definition is only for the purposes of capital gains. This definition applies for the entire act, and therefore the 214 definition would also apply for 56.210. Very wide, but for section 56, only those properties which are defined in the explanation would be covered. So you go by the definition of capital asset in 214, exclude what is there in 214, come to 56, cover those which are expressly covered, and only that would fall within the purview of property for this section. For instance, rural agricultural land within 8 kilometers or outside 8 kilometers of the city limits is not capital asset. Now that is not capital asset under 214 and hence would not be capital asset property for section 56. And there you have Jaipur Tribunal and Pune Tribunal decisions on the same line. So that shows that what is not capital asset under 214 will not be covered here. Similarly, section 56.210 is not applicable if property is stock in trade for the recipient. So if I am treating it as my stock in trade and I receive certain property, then it would not be taxable in my hands. What can be such instances? Jewelry or bullion by a jeweler or a gold trader. It's stock in trade. So therefore, it would not be covered under this section. We are only talking of this section. We are not getting into the entire act. Shares received by a broker, a trader, an arbitrager, a jobber, arts and paintings for an art house, all this would be stock in trade. What if I receive it as stock in trade and thereafter convert it into capital asset? So at the stage of receipt, I say it's my stock in trade and then I convert it. Now we have 28 subsection 6A. The fair market value would be taxed under valuation as per 11 UB as business income. So earlier there was this arbitrage where people were trying to receive it, convert it into capital asset. Hopefully it did not attract GAR. There was no 28.6A, you could have gone out. But now you expressly have 28.6A and GAR is always there to catch things. What is the scope of the property covered here? Money, immovable property, shares and securities, jewelry and bullion, arts, paintings, sculptures, drawings, archaeological findings, and now cryptocurrencies. Let's first look at immovable property. Immovable property has been defined to mean land and building or both. And the memorandum also says it is covering land and building. Under section 50C, various decisions have held leasehold rights are not immovable property because they are not land and building. They are interest in land and building. And definition of immovable property as found under form 37I or section 269 UA was very wide to include land, building, rights in land and building. It is not so under section 50C and not so under 56.210. Similarly, transferable development rights, TDR, which are very valuable in the city of Mumbai, especially in the suburbs where you could load TDR and increase your FSI. That is a right in a land. It is not land or building. So that would not be treated as immovable property under 56. Only land and building is covered. In this context, the decision of the Bombay High Court in Chheda Housing versus Jahan Bibi, rendered under the context of the Stamp Duty Act and Registration Act, is very relevant for anybody who wants to understand what is land and building, what is immovable property under general law. So you look at various statutes in India, like Transfer of Property Act, Registration Act, General Clauses Act, Maharashtra Stamp Act, all of them have a different definition of immovable property. But when you come to Income Tax Act 450C, it only talks of land and building. Now, land is also not defined. Land, you will find a definition in General Clauses Act and Transfer of Property Act. And it's again a very vague definition, as land includes everything attached to earth, but does not include standing timber, growing crops and grass. So what it means is immovable property is a larger universe. Within that, there is a subset of land and building, and other types of immovable property would include TDR, would include transferable leasehold rights. All of that would not be covered within the definition of land and building. Now, when you look at 56(2), it says any immovable property, and then it talks of any property. Now, that gives a confusion that when we talk of immovable property, is it okay if it is capital asset only, or even stock in trade is covered? Because there is a bad drafting example. Property has been defined to mean immovable property being land and building. But when you look at the charging section, it says receipt of any immovable property. So there was a confusion, and which has been expounded by the Jaipur Tribunal in Saini's case, where the Jaipur Tribunal said all types of immovable property is covered under 56(2). It need not be covered within the definition of property. Now, if you take this absurd proposition to its logical conclusion, then what would happen is that the definition of immovable property within property, being land and building, would be rendered otiose. That is, it is rendered without any effect altogether. So you have a definition which is not used anywhere in the section, and all types of immovable property, whether land, building, TDR, leasehold rights, capital assets, stock in trade, would be covered here. I think that is definitely not the intent, and that is not the correct interpretation also. Therefore, the correct way to read this is that only immovable property, being land and building or both, should be covered under this provision, and further it should be capital asset in the hands of the recipient. Otherwise, all builders would be liable to tax under 56(2)(10) whenever they receive a land or building at below fair market value. And that is not the intent, because if you go back to the memorandum explaining the provision, which we read out in the beginning, it clearly said that the intention is not to tax normal trading transactions and business assets arising in the normal course of business. So then you are going against all of this and trying to bring it within the purview. This decision of Saini has been distinguished subsequently by the Jaipur bench, again saying no, immovable property should only be restricted to capital assets. Shares and securities, that's the other important property. And there's no definition of shares and securities in the section. But Rule 11 UA defines it to mean shares means as understood under the Companies Act 2013, and securities means that found under the Securities Contract Regulation Act, Section 2, subsection H. Shares would mean equity, preference shares, non-voting right shares, differential voting right shares, whether of a listed company, unlisted public company, or a private limited company. Even shares of Section 8 companies would be covered. There is no exception for that. When we come to the exceptions, this is something which we would look at, that whether issue of shares of Section 8 company at below FMB, can you say it falls under the exception? And the definition of securities under 2H, very wide, covers all types of marketable and non-marketable securities. Now even units of AIF, mutual funds, REITs, InvITs, everything is covered here. So this is, even stock options are covered here. So this is a very exhaustive definition which is found in SCRA. Allotment of shares. So if shares are allotted and the book value at the time of allotment is higher than the issue price, can the recipient be taxed on the difference? Now here there is a fundamental decision which you must look at, that is Khode Distillery Supreme Court, that allotment of shares is a creation of shares different from secondary purchase, which is a transfer or a receipt. So there is no receipt of shares, there is a creation of shares. Receipt can only take place by way of transfer. Ignoring this decision, we have the famous, or rather the infamous decision of the Mumbai Tribunal in Sudhir Menon HUF, where the Mumbai Tribunal said no, receipt of shares is after allotment. That is when the shares have already come into existence, either by way of physical or demat. If there is a disproportionate allotment, that is, there were 3 shareholders, 2 decided to subscribe, 1 did not subscribe, that is disproportionate. Then the shareholders subscribing are gaining at the cost of the guy not subscribing. And therefore, there is a deemed gift from the person not subscribing to the persons who are subscribing. And this is also assented by a very old Australia and New Zealand High Court decision in the case of Robertson, which was looked at in our Gift Tax Act. So when Gift Tax Act of 1958 was in force, this decision has also been considered by our courts, that if there is an issue of shares at lower than FMV to some shareholders, resulting in lowering of value of other shareholders, then there is a deemed gift under the Australia-New Zealand gift tax law. So I think this was one of the decisions which influenced the Mumbai Tribunal. And therefore, now if there is a rights issue where some people subscribe and others don't, then the difference would be taxed in the hands of the recipient. Similarly, if there's a fresh issue, which is at below FMV, then the difference would be taxed in the hands of the shareholder subscribing. Appeal has been admitted against this decision in September 2018, but it's not yet come up for hearing before the Bombay High Court. Now there is a twist to this decision. See, all this happens on a fact-based cases. What if allotment of shares is covered, but it is made to a company where all the shareholders are relatives as understood under this section? Here the court said, in this was Visakhapatnam Tribunal, that because it is between relatives, who is gaining? A relative. Who is suffering? A relative. If the person who is suffering had given a gift to the person who is gaining, would it have been exempt? Answer is yes. Then in such a case, just because he did not subscribe and his brother or mother subscribed, how can you bring it to the tax net? And they went into the memorandum explaining the provisions. As I said, that they went into the memorandum in some cases. This is not a case of black money or tax evasion. It's then how can you apply an anti-abuse provisions to a family-owned company? So in such a case where all are relatives, 56(2)(10 will not apply if some suffer and some gain. What if there is a disproportionate allotment, but lower than offer is subscribed to by the shareholder? The shares issued pursuant to lender's covenant to increase the company's net worth, and lower than proportionate allotment does not attract rigors. Here in Sudhir Menon, they said it attracted. In Subodh Menon, that is the brother's case, they said disproportionate means higher than others. So if the shareholder becomes poorer, then it does not apply to bona fide transactions which are not money laundering. So time and again, courts are looking at the reason why 56 was introduced. If there is no money laundering, if there is no hint of evasion, you cannot attract the rigors of this section. So I think this is something which should be looked at going forward in each case, and try and make out a case that this is not being attracted because of the reason by which the section was introduced. Bonus shares. Now, this is something absolutely absurd, that how can you attract 56(2)(10) when there is a bonus issue? There's no unjust enrichment in case of bonus allotment because it's pro rata to all shareholders. And it's never without consideration. Fall in intrinsic value of original shares is the consideration. I'm owning a share worth 50 rupees. If there's a 1:1 bonus, it will now become 25 rupees for each share. Money remains with the company, shareholder gets nothing extra. The Karnataka High Court has affirmed the Bangalore Tribunal's decision in Dr. Rajan Pai. But what if there is disproportionate bonus allotment. If you jog back your memory to 2007 in Reliance Power Limited, after the IPO did not do good, the promoters came out with a bonus issue in which the promoter group forgo their bonus entitlement. So they said 60% does not want bonus, only 40% will get bonus. Now can this be invoked that this 60% is giving a gift to the 40%? I yet don't think it can be, but this is something which even similar cases are taking place in dividend entitlement. 60% or 70% of promoters say we don't want dividend, let the minority shareholders get the dividend. In such a case, can you say that the promoters are giving a gift to the minority shareholders? These are issues which have not yet come up for testing, and hopefully they don't. What if there is a bonus NCD or bonus preference share issue? Now, can you bring it to tax here? There is a specific provision for taxing both of these as deemed dividend under 222A. And my view is when there is a specific provision, it would override a generic provision like 56(2)(10) and hence not be covered under the purview of income from other sources. It would be taxed as a dividend because you can't look at both 222 and 56 and levy the same income twice. Conversion of equity, conversion of compulsorily convertible preference or debentures into equity. CCPS and CCDs, very popular route of doing private equity funding, AIF funding, foreign direct investment, and the conversion takes place on milestones. That is, if the company performs as projected, it's 1:1. If the company performs better, then it's you get the shares at a lower number. And if the company does worse, you get more number of shares as an investor. There is an express exemption from capital gains under section 47 for conversion of preference or debentures into equity. There is an express provision for the period of holding under rule 8A and section 242A. But what happens to 56? Do they get triggered? There's no express exemption under 56. That's quite strange because while there is an exception for some transactions under 47, this is not an exempted transaction. So for the person, it is not a capital gains, but he has to examine the applicability of 56(2)(10). Now, which FMV should I compare? The FMV on the conversion date or on the date of issue of the equity shares? That is, I had got the preference shares in 2010 or 2015. Now in 22, I'm getting equity shares. So do I compare the FMV in 2015 with the issue price? Or do I see the FMV today with the conversion price? Or do I see the FMV today with that time's issue price? I believe if you look at it clearly, you can only look at it once. That is on the date of issue. That is when they were issued in 2015, what was the fair market value and what was the issue price? If it is higher, again, examining the same transaction would mean double examination of the same transaction, one on issue, one on conversion. But there is no express clarity on this. So this could become something where private equity investors and venture capitalists could have problems when you look at it from this perspective. Buyback and reduction. When a company is buying back its own shares, can you compare the buyback price with the FMV of the, or the net worth of the company and say whether there is a liability 56(2)(10)? This has been the matter of dispute before the Mumbai Tribunal in Vora Financial Services. Now, first look at it logically. Is the company receiving property? Now, here the answer is yes and no. When a company buys back shares under section 66 of the Companies Act, it must receive the shares and within 7 days physically extinguish them. So for a small period of time, it is receiving the property. But what is the property which it is receiving? Its own shares. Can a company under the Companies Act be a shareholder in its own self? Answer is a resounding no. So if I cannot own my own shares, how can I receive my own shares? So it was never property to begin with when I'm getting it. Hence, I believe you cannot apply 56(2)(10) when I'm buying back shares because you are then owning property which you are not entitled to own. And in law, you cannot compel a person to do anything which is impossible. So if I cannot own my own self, then I cannot be made to pay tax on something which I cannot own. If it is reduction, it goes a step better because reduction cancels the shares altogether from the date of the order from NCLT. You don't even have to receive it and then cancel it. So in reduction, it's very clear there is no receipt of property, whether you can own it or not. In buyback, while you are receiving the property, it should not be treated as property because you are not owning it. And that is what the Mumbai Tribunal saw in this case. Plus, we have a specific provision for taxing buyback, both unlisted and listed companies. Therefore, even if you look at specific versus generic provision, this should not apply. Bombay High Court has admitted an appeal against the Mumbai Tribunal's decision in Vora Financial, but that's something which we'll see. Hopefully, Bombay High Court would also be on the same lines. But this is something which has become one of the points to be considered when you're carrying out any buyback, and everybody is wary of this provision, whether we would be hit by it or not. Receipt of jewelry and bullion. Jewelry, there's an inclusive definition under 214. As we said, the same definition will apply here. Ornaments of gold, silver, precious metals, whether or not sewn into any apparel. Precious, semi-precious stones, whether or not set in furniture. Same definition should hold good here. What is bullion? Not defined under the Income Tax Act. The decisions of the Supreme Court under VAT and sales tax have defined bullion to mean gold and silver reckoned by mass and weight. Raw gold in the form of ingots or bars are treated as bullion. Now, what about gold coins? They are not raw gold because they are finished, they are polished. Can you say that is bullion? I think it's a touch and go case. You could probably argue it's not bullion, but then on the same time, it is reckoned by mass and weight. So it's a touch and go case, but there are decisions, or there are views rather, I would correct myself, which are saying gold coins are not bullion. What of any other metal which is reckoned by mass? Example, a platinum bar. Bullion is always understood to mean gold and silver. Can we say a platinum bar is not bullion and hence not covered? Possible to take that view. But I think as trade and commerce is progressing, maybe an extended definition of bullion could be also ascribed to include platinum. And this is not a legal definition. It's a generally understood definition. So could be platinum is also covered. Personal effects such as silver utensils or gold utensils are not capital assets and therefore should not be covered within the definition of property for this section also. Archaeological and drawings, so that includes study of antiquities, drawings, paintings, sculptures, and similar things. But collection of stamps, antiques which are not covered above, or ancient books, they are not drawing, art, painting, or sculpture. So if you have valuable property of this type, it would yet be outside the purview of 56(2)(10). Of course, finding such things is also interesting, but collection of stamps, which could be very valuable. A rare stamp prior to independence could fetch you a lot of money. And if you have a collection of them and you gift it to somebody, it will not attract tax for the donor. Virtual digital assets, a lot of hue and cry over it in the recent finance bill, added from 1st April 2022. But if you look at the definition, it's very wide. It will even cover loyalty points, reward points, in-app points. Now, all of these, if you receive, can you say it is receipt without consideration? Not always, because I'm getting loyalty points because I'm loyal to that airline or that restaurant or that garment store. And therefore, my consideration is my act of visiting that store again and again. What if I get bonus loyalty points on my birthday or anniversary? Then can you say it's without consideration? Again, I would say no. It is to entice my loyalty. They are giving me this. So they are not giving me free of cost. They are giving me because I come. They are giving me because they want me to come. So my view would be loyalty points would yet be outside the purview of virtual digital assets for the purposes of 56(2)(10). Gift of cryptos which are not exempt would now attract tax in the hands of the recipient under this section. Currently, several gifts are being given in the form of crypto transfers. And I know of several discretionary family trusts which are using this purview, because when you give to a trust, there's a very limited window in which you can do. So the trustees are setting up crypto wallets and the donor is giving a crypto gift, and that is how trusts are being set up. This will now be plugged because of that route. How would the valuation rules be provided under 11 UA for virtual digital assets? Something which we have to see. If they are listed crypto assets, you can easily get, but there are several unlisted crypto assets. How would you then get into the realm of valuation of those? Would they say that you go to a valuer? Who would be that valuer? And if you are a miner, those of us who are familiar with this universe understand that mining is the way of creating new bitcoins or new coins. Now, when the miner receives coins, he's not getting it free of cost. He is getting it in lieu of his effort and skill of mining. He has invested in technology. He has invested in heavy duty machines. He has invested in electricity, which is very expensive. And then he is getting mining rewards in the form of coins or similar virtual digital assets. Therefore, receipt by a miner should not trigger 56.210 in his hands. But this is something which is going to have to be explained to the assessing officer. What is mining? What is the universe? Only then could this settle down. Items which can yet be gifted. So this is a question which I am often asked. Is there anything which is not covered? Answer is yes. Precious watches not made of gold, silver, diamonds. That's not jewelry. It's not bullion. Expensive pens, cars, yachts, airplanes. So if somebody is willing to gift you an aeroplane, please take it. There is no gift tax on it. Bikes, helicopters, expensive food and wine. They're gold-plated hamburgers and stuff like that. So if you're getting that, you are free to eat it without any sin. There's no sin tax on that. Clothing, bags, luxury vacations, travel, furniture, laptops, mobiles, business undertakings. In R.C. Cooper, the Supreme Court said a business undertaking is property, but it's not a property as understood in law. So if you are getting an undertaking free of cost, at least 56.210 is out. Huh? We are not looking at other sections or other provisions. Intellectual property rights like goodwill, patents, copyrights, trademarks, they are not yet property. And cryptocurrency is not property till 31st March. So please go and ask whoever is willing to gift you. Take it before the year ends. You will be, and the rest of them you can take even next year. And even give. So if anybody is interested, my coordinates will be there at the end. You can gift. Exemptions. There are various exemptions which are provided. Those exemptions which are there under section 47, but very limited. So we looked at conversion from preference to equity. It's an transaction exempt under 47, but not exempt under 56. So there are some exemptions under 47, which apply under 56 also. Receipts on the occasion of marriage, receipt by will, inheritance, family trust, charitable trust, in contemplation of death, stock in trade, and from relative. Exempt under 47, I'm not reading the list, but these are the important ones which are there. To cover some issues, a transfer between holding company and wholly owned subsidiary. Now, this is available provided the holding company continues to own more than 100% of the subsidiary for a period of 8 years. 47A says, if you vitiate that relationship, it will be taxed in the year in which the relationship is changed. 56 does not have such a clause. So even though I have changed the relationship, I will not be levied to tax in the hands of the recipient under 56.210, while the donor will get taxed under 47, the donee continues to go tax-free. Issue of shares under merger debenture, applicable for both equity shares and preference shares. In Telesound India, Delhi High Court has said shares includes preference shares also. So even if you issue shares which are RPS on a merger, it will be outside the purview of 56, but not if bonds and debentures are issued. Here, if you are getting bonds, debentures, or money in lieu of fractional shares, there's a moot point where the 56 could be attracted. We have the decisions of Gujarat High Court in Master Raghuveer Kumar Trust and Leena Sarabhai, which have taken a view that if you are giving debentures in lieu of mergers, then 47 exemption is not available. What happens if I give debentures in addition to shares on merger? Then 47 exemption should be available. And on the same logic, 56 exemption should also be available. But if it is only debentures, then it may be difficult to give both 47 and 56 exemption. If what is being demerged by a company to the resulting company is not an undertaking as understood under explanation to 219AA, then the tax neutrality is not there under 47. Consequently, there is no exemption under 56. So if you look at the Rajasthan High Court decision in Uma Enterprises, where land was transferred, and the Rajasthan High Court said, this is not a business undertaking because it's not your business to carry out real estate development. It is just assets and liabilities put together, not constituting a business undertaking. And therefore, the demerger was not held to be neutral. If that is the position, the recipient company will also not get the exemption under 56 and would have to now consider paying tax on the receipt of the property as being without consideration. But that brings us to a fundamental provision. Can an issue of shares under merger and demerger, which has been blessed by the NCLT, ever be treated as a tax evasion provision? Is it an anti-abuse provision which you are going into? So that then gets us back to that dehors of the exemption. Can you even levy tax at all? On the occasion of marriage, received by the bride and groom, not by the parents of the bride and groom. In Punjab and Haryana, they were being a little innovative, and they said when the parents received gift, it is on the occasion of marriage, but it's not their marriage, it is their children's marriage which you have to look. Receipt on occasion of marriage means it does not have to be on the marriage ceremony. It could be in close proximity. So nowadays marriages come with a plethora of functions. And if you keep getting gifts at each of them, all of them should be outside the purview. But something which is very far, like an engagement 6 months ago, I don't think that could be treated as being on the occasion of marriage. Secondly, it can be from anyone, even a stranger. Need not only be by a relative, means it's not necessary that only relative has to give you a gift. No limit on the amount of gift. It could be more than 50,000, and no limit on the number of marriages. You can keep marrying and every time keep getting gifts. So this is something which a lot of people find very interesting, that there is no limit on the number of marriages. Although there are other laws which prevent you, just in case you have ideas. Receipt under a will or an inheritance. Now, if you get anything under a will or an inheritance, there is no tax, even if from a stranger or from a client. So if one of your clients is very happy with your excellent skills in filing his tax audit report and decides to give you a gift under his will, it will not be taxable in your hands, even though he is not relative of you. What is the meaning of will and inheritance? Will means there is a testamentary succession, means they laid down a will in which you are getting. Inheritance could be by way of succession, that is intestate, where there is no will, or something by which you get under any law, like Hindu Succession Act or Indian Succession Act. You do not need a probate, a succession certificate, a letter of administration for getting exemption under these sections. It is just by operation of law. However, to prove that it is under a will or succession, for the satisfaction of the AO, having one of these documents would obviously help you. Otherwise, how are you going to prove that you got it? So a copy of the will or a copy of the probate in which you are the beneficiary. And if you have got it intestate, then a copy of the legal heir certificate or the succession certificate would help to show that you were the beneficiary and hence you got it. What if I get an asset as a nominee? Now, this is one question which I have been asked time and again. And in my estate planning practice, this is something which everybody asks. I got a flat as a nominee. I got it from somebody who is not my relative as understood in law, like cousin to cousin. Am I liable to tax under 56(2)(10)? First of all, understand the concept of a nominee. A nominee is never the beneficial owner of the property. He is only a stopgap. Law does not like a vacuum. So when a person dies, the law wants a face to deal with till the ultimate beneficiaries get the property. That vacuum is bridged by a nominee. He steps into the shoes of the deceased. He is closed with the rights and liabilities of the deceased till he hands it over to the person who is the beneficiary under the will or the successor under the legal law. Nominee is just a stopgap arrangement. You have numerous cases like Sarbati Devi, life insurance policy nominee, Vishin Khanchandani, nominee of National Savings Certificate, Indrani Wahi, nominee of flat in a cooperative society, very important decision, Ramesh Chand Talwar, bank account nominee, and Shilpa Sen Gupta, PPF account nominee. All of these decisions have held that the person who is the beneficiary under the will or the succession law is the legal and the beneficial owner. Nominee is just a stopgap. Therefore, when you receive property as a nominee, you don't receive it as understood under 56(2)(10). You are just an intermediary. You do not have to pay tax, even if you got it from a person who is not a stranger. And you don't have to look at the exemption of will or inheritance. You are not at all covered under this provision. So this becomes very, even for a joint holder who is not the real holder or beneficial owner of the account. Property received in contemplation of death. This is a Latin maxim known as donatio mortis causa. That is, when you receive any property from a person because he is fearing that he is going to die and he wants to make a gift before that. So here we have section 191 of the Indian Succession Act 1925, which says that properties in contemplation of death can be given provided they are movable property if the donor is expected to die from an illness, but the gift should revert back if he survives. So there are two conditions in the 195 or 191. A, it is only qua movable property. B, donor must get it back if he survives. The gift tax had similar conditions, and you had the Supreme Court decision in Abdul Muhammad Karim. 56(2)(10) does not talk of any such conditions. Therefore, is it necessary that property in contemplation of death must only be movable? And is it necessary that the donor must get it back if he survives? I don't think so. But if you look at the Chennai Tribunal decision in F. Sasai Raju, they have looked at the very same definition under 191 and they have referred to Abdul Muhammad Karim and said these are two essential conditions for gaining exemption. So based on this tribunal decision, you would have to follow 191 and the conditions laid down therein. Here, there was another interesting decision in Rohan Shah Mumbai Tribunal where a person was becoming a sadhvi, and pursuant to becoming sadhvi, she made certain gifts. It was treated that the recipient got the gift in contemplation of death because they said becoming a sadhvi is like giving up your life and you are no longer known by that name. Thus, they claimed exemption under this clause. Mumbai Tribunal said no, death means physical death, not what is understood in spiritual law. And therefore, since the person is yet alive, you cannot claim exemption on this clause, and it would be treated as a taxable gift if you are not otherwise exempt under other clauses. From or by a charitable trust, institution, university, hospital, medical, educational association registered under 12 or 12AA. Now here, whether issue of shares by a section 25 or a section 8 company at lower than FMV, can it be held to be exempt? Answer is, I think that should be no, because if you would then look at it, whether it is from a trust, then you would have to say, yes, it is from a trust, but then it is an allotment of shares. Is it a receipt of property? So this is something a little bit of a gray area, which needs to be seen whether you can cover an allotment at below FMV under this purview and then claim exemption because of this subsection. From any relative, most interesting clause, that's why I put it at the end. Gift received from defined relatives only is exempt. So while your cousin is your relative, he is not a relative as understood in this law. No occasion to be demonstrated. You don't have to prove why your relative gave you a gift. It could be just out of fun, but it is exempt. Uncle, aunts are relatives of nephew and niece, but converse is not so. Here you have an interesting decision of the Rajasthan High Court, where a gift from a brother was made from the bank account of the nephew. So it was held that since it is gift from brother, it is not taxable. But the Chandigarh Tribunal in a similar decision said it is made from the bank account of the nephew, and therefore the donor is not the brother, it is the nephew, and nephew to uncle is not an exempted gift, and therefore it was held to be taxable. I believe the Chandigarh Tribunal is the right way to look at it, because whoever is the bank account from which the gift is originating, that is the person donating, not the person who says that I had donated. Mother, sister, son, or cousin is not a relative as we looked at. Lineal ascendants and descendants, not defined anywhere in law. But what does it mean? Relatives in a straight line. Grandfather, father, son is descendant. Son, father, grandfather is ascendant. What about mother, grandmother? or female lineal ascendancy, descendancy. Is it possible? Yes. There is a lot of myth prevalent that lineal ascendance only means sons or male relatives. No, it could mean females. It could mean a combo of male, female also. And you have a 1926 decision in estate duty, Dhanilal Devilal of the Rajasthan High Court, which has taken the same view. What about adopted children and stepchildren? Section 2 definition of child says child includes an adopted child. Even otherwise, under the Hindu Adoption and Maintenance Act, adopted child is at par with a biological child, and Supreme Court has held that adopted child is entitled to succeed to the estate of the adoptee parent. Therefore, adopted child would also be substituted in lineal ascendancy, descendancy. What about stepchildren? Under general law, stepchild is not entitled to succeed to the estate of his parent, and you have Bombay High Court decision and Supreme Court decision. But Section 56(2)(10) expressly provides child of a spouse. Therefore, even stepchildren would be entitled to succeed and get the property free of cost if received from a step parent. If any gift is received from a relative, would Section 68 also have to be examined? Now, 68 comes with 3 conditions: ICG, identity, creditworthiness, and genuineness. Identity is known because it's from a relative. Genuineness is proved because it has come by banking transactions. What about creditworthiness? I got a gift from my brother who gave it to me. It's not taxable in my hands because of 56, but my brother has only 1 crore of net worth and he gave me a gift of 95 lakhs. Can the department say the creditworthiness in this case is not proved because you cannot give away 95% of your estate? Or can I say that once I'm exempt under 56, you can't examine me again under 68? Kerala High Court and Sunil Thomas said both 68 and 56 operate in different spheres. One is for taxing unaccounted cash credits and gifts. Other is to look at whether adequacy of consideration. Just because adequacy of consideration is demonstrated, 68 does not go out of the window. So you would yet have to examine it under 68 to look at whether the capacity of the donor is proved. Converse is also true. Gift received by uncle from nephew, where ICG is proved. So 68 is not applicable, but 56 would be applicable because nephew is not a relative of the uncle. So the donee is not getting it from a relative, and therefore there would be liability to tax under 56. So you have to examine both, especially when you are getting gifts from relatives. Creditworthiness often remains one of the sore points. So please pay attention to all of this when you're looking at any gift. From any relative who is an HUF. Is an HUF my relative? Now here there are lots of tribunal decisions for and against. Some have said that when all the members of the HUF are individually relatives, you can claim exemption. While others have said even if all the members are relatives, you cannot claim exemption. So this is something which is an evolving law. But if the HUF comprises of non-relatives, such as your cousins, your father's brother's sons, then definitely you cannot claim benefit on the grounds that all the members are my relatives. So this is something which has become fact-based. Mumbai Tribunal has time and again taken a view it is exempt. Others have said no. Receipt under family settlement. Now, what is a family settlement? When there are disputes in the family, to give up those disputes, to amicably settle them, and to have goodwill and harmony within the family, you may agree to give up certain rights and get certain assets. Supreme Court in numerous cases has held that a family settlement is not a transfer. Hence, you don't need a conveyance, you don't need registration, no liability to capital gains tax, no liability to stamp duty. Therefore, can I extend that proposition and say no liability to gift in the hands of the recipient, and therefore 56(2)(10) is not attracted? Is not my settling of disputes adequate consideration? Is not maintaining harmony within my family adequate consideration? I would think yes. And that's also the decision of the Mumbai Tribunal in Paras Gundecha. But I would add a caveat: the family settlement must be genuine. If it is not genuine, there are decisions such as Mahatme's case where the Bombay High Court has looked through it and said this is just a sham which was done to evade paying capital gains tax. Same view could be taken This was done to evade taxing under 56(2)(10). So as long as it's a genuine capital, genuine family settlement, 56(2)(10) should not be attracted, even if the person giving and the person getting are not relatives as understood under this section. Because if they are relatives, you anyways don't need to go here. Amount received on partition of HUF. On the same breath, we have Sudha Iyer, Mumbai Tribunal, where the amount received by a co-parcellor on partition of the HUF was held to be in lieu of her existing rights and liabilities and obligations in the HUF. So she had a right by virtue of being a co-parcellor. That right is now coming to an end, and therefore what she gets or what he gets is not free of cost. It is in lieu of an existing obligation and a right. Private trust. Now, this is something where there was a lot of ambiguity, and after adding of the exception, the ambiguity has gone up. So when you are creating a private trust, there is an exemption for the property received by the trustees only if it is received by an individual who creates a trust solely for the benefit of his relatives. All throughout 56(2)(10) is viewed from the point of the donee, that is the person receiving the property. When we look at the exemption for a trust, we have to look at it qua the viewpoint of the donor, that is the person giving the property. The person giving the property can only give it to a trust set up solely for the benefit of his relatives. If that is the condition, only then the property would be exempt in the hands of the trust. So look at it from his viewpoint, exempt in the hands of the trust. Must be a private trust. We are not talking about charitable trusts under the Bombay Public Trust Act. So trusts like BCA, Chamber of Tax Consultants, all these are public trusts. We are talking about family trusts. It can be discretionary or specific. What is discretionary specific? We don't have time to go into, but you look at 161(1) for what is a specific trust and 164(1)(a) for what is a discretionary. When shares are not defined left to the discretion of trustees, it is discretionary. Settler must be individual, because if it is a corporate, obviously he cannot have relatives. So now you are limiting it down, whittling it down only to an individual settler. Trustees could be anyone. It's not material who the trustees are, whether they are a body corporate, whether they are individual, whether they are a combination. We have to look at settler, we have to look at beneficiary. Both of them must be individuals, because beneficiaries only can be relatives and individual or settler can only have relatives. Must always be an individual from both the angles. Now here, to give an exemption, as I said, you look at it from the viewpoint of the donor. To give an example, gift by uncle to nephew, it is exempt because we are looking at it from the nephew's perspective. Uncle is his relative. But gift by uncle to trust set up for the benefit of nephew. Now I'm looking at it from the uncle's perspective, and nephew is not my relative. Therefore, while I can give it to him a gift directly, I cannot give a gift to a trust set up for his benefit. It's absolutely absurd, but that's how the law exemption reads. Gift by nephew to uncle, not exempt, because when you look at it from the uncle's perspective, nephew is not his relative. But gift by nephew to trust set up for the benefit of uncle will be exempt, because now you are looking at it that uncle is a relative of the donor. So this is how you would have to look at each of the exemptions. Whose angle are you looking at it? And trust is the only exception to all the exemptions when you're looking at it from the donor's perspective. 56 and non-residents. A share sale of a foreign company by one non-resident to another non-resident. Now here, foreign company derives substantial value from an Indian company. After the infamous Vodafone amendment, indirect transfers are also liable to tax in India if a foreign company derives substantial value from Indian assets. So if more than 50% of the value of the foreign company is from India, and that value exceeds 10 crore rupees, that transfer of foreign company shares is liable to tax under 9(1) explanation 5. Now, if the recipient gets it below fair market value, can you bring it to tax 56(2)(10) in the hands of the recipient? Would the indirect transfer rules extend to him? Answer is yes, because it is a share of a company, and company as understood in section 217 includes a foreign company. So if the buyer buys below fair market value, 56 would be attracted in his hands. Excess of fair market value over consideration is taxed as income from other sources, liable to tax and originating and accruing in India. And section 5 says all income accruing in India to a non-resident is taxable in India. Now you also need to go to section 90 and check the applicability of the treaty. If there is a treaty between that country from where he is and where India is. So if we look at India-UAE treaty, there is an article 23 for income from other sources, which says income from other sources will always be taxed in Dubai or in UAE. Because of that, even though 56,210 income is there, it will not be taxed in India, but it would be taxed in UAE. No tax in India, no tax in UAE, it goes tax-free. But if you look at India-UK treaty, there is no article similar to that, or India-Singapore treaty. It talks of residual income. Now, residual income under Article 22 in India-Singapore treaty says it will be taxed always in the country in which it originates. That means it will be taxed in India. Hence, if it is a Singapore company who is selling shares of a foreign company, he will be liable to tax in India under 56,210. So look at the applicability of 56, look at the applicability of scope of total income, and then view it in the context of the double tax avoidance treaty between India and that country. Coming to the valuation rules under 11 UA, for immovable property, if the stamp duty ready reckoner value exceeds 10% of the consideration and 50,000 rupees, then the section is attracted. So if the stamp duty reckoner value is 5 crores, agreement value is 4.5 crores. 50 lakhs, that is 10% of 5 crores, is higher than 45 lakhs. Therefore, entire 45 lakhs is liable to tax. Entire 50 lakhs is liable to tax as income from other sources. Now, how do you work out the stamp duty ready reckoner value? So every 1st of April, the Mumbai registrar comes out with a stamp duty ready reckoner value. He divides Mumbai city and Mumbai suburbs into various villages, and then villages are divided into zone and subzone, and subzones are divided into city survey numbers and cadastral surveys. You need to follow 9 steps to work out your reckoner value. Find out the division, village number and name, zone and subzone, city survey number. What is the type of the property? Residential, office, shop, gala, or industrial property? What is the built-up area? If the built-up area is not known, it is 20% over carpet area in case of non-MOFA RERA properties. And if it is a RERA property, it is 10% over carpet area. Market value of property as given in the reckoner, which is given in terms of square meters. So don't get happy on seeing that it is only square meters, and 10.764 square feet make a meter. So multiply that. Many people just multiply that by square feet and say, this is very small. It's not so. Look at special factors like lifts, depreciation, staircase, front face, back face, which are provided in the reckoner. And on that basis, arrive at the reckoner value by multiplying that with the built-up area. Depreciation is one factor which is very essential, and it ranges from 0 for a 2-year-old building to 70% for a 60-year-old structure. Now, getting 70% adjudication by the collector is often a nightmare, because that would mean loss of revenue for stamp duty, loss of revenue for income tax, and various other factors. But proof of age would be a must. So they would look at OC certificate or building completion certificate, municipal tax assessment, ration card, electricity bill to ascertain whether the building age is 70 years or not. And if so, even then it may be an uphill task to get that. Shares and securities, you have to bifurcate between quoted shares and unquoted shares. What is quoted? Quoted means quoted on a recognized stock exchange with regularity from time to time. What do you mean by regularity? Not defined. You may take Q from the SEBI takeover code, which defines regularity as frequently traded, and they've laid down an objective test. That could be one way of looking at whether that's regular. Recognized stock exchange. Recognized stock exchange means one as understood under section 2 of the Securities Contract Regulation Act. And that means a stock exchange recognized under section 4 in India under SCRA. That means only Indian stock exchanges are recognized stock exchanges. If you have a share listed on NASDAQ, it would be an unquoted share, even if that share is Apple, Google, or Microsoft. So the world's most valuable companies listed are treated as unquoted shares when it comes to 56-10. So if you have got a gift of Apple shares from a non-relative, you will have to value it as per this method. Where you are going to get those information, that's your problem. Income tax is not going to go by the quoted price because it's an unquoted share for the purposes of Rule 11 UA. And what is this method of valuation? It's the adjusted book value method to be valued by a CA or merchant banker. Here, chartered accountant valuation is yet valid and subsisting. It is only in 56(2)(7)(b) when they needed a DCF valuation, they have taken away CA's valuation. CA's valuation is yet valid for Rule 11 UA for 56(2)(10). You find out assets minus liability and work out the per share value divided by the number of equity shares. You require the audited balance sheet as on the date of acquisition of shares. Now, if there's a mid-year acquisition of shares, how are you going to get the audited balance sheet? If you are a minority shareholder, how are you going to get the audited balance sheet? All these are questions for which there are no steady answers. Under Gift Tax Act, there was the alternative of taking the closest audited balance sheet. For 56(2)(7)(b), Rule 11 UA sub rule 2, there is an option of taking the last audited balance sheet. But here there is no option expressly provided. But I think there is no other alternative but to take the last audited balance sheet if you are not able to get one. And when is the trigger point? It's when you receive the shares. Now, in case of physical share certificates, Supreme Court has said that when the shareholder sign the blank share transfer deeds and give the share certificates, the receipt is completed. So that would be the point. In case of demat shares, it would be when the demat slip is signed and given to the DP, the receipt is completed. In case of the following assets in the balance sheet of the company, you would have to get them valued. So jewelry or art, you would need an open market valuation by a registered valuer. Shares and security in the manner provided in this rule, which we just looked at. Immobile property, substitute the stamp duty ready reckoner value. Now, if the company has a JDA, a joint development agreement, or it has TDRs or tenancy rights, is it treated as immobile property? Because it is not immobile property under the section, but the rule does not refer to land or building. So what happens? Do I treat them as per balance sheet value, or do I have to do a stamp duty reckoner value? And if I have immobile property abroad, I have a house in London or an office in US, how am I going to find out the stamp duty ready reckoner value of that for the purpose of valuation of this company? Reduce the liabilities, exclude provisions made for meeting unascertain liabilities. Now, what are ascertain and unascertain? You can look at Ind AS 37, where the contingent liabilities and ascertain liabilities definition is given. Present obligation is ascertain liability. Potential possible obligation is a contingent liabilities. Now, contingent liabilities, even if disclosed in the accounts by virtue of notes, cannot be reduced for the purposes of valuation under 56(2)(10). So while we may do so in a commercial basis, we cannot reduce it while doing, what is the time we have? 5. No adjustment for these assets and liabilities, investments in LLP, partnership firm or AOP. These have to be at book value. So here you don't need to find the underlying value. Any intellectual property rights like patents, copyright, take them at book value. Plant and machinery which have low realizable value at book value only, and crypto assets. Would the rules be amended to provide for their valuation only, or you take them at balance sheet value only? Lastly, if you have cross holding, A holding in B, B holding in C, and C holding in A, how would you value it under this rule? Probably you'll have to do simultaneous equations. If you would jog back to our final CA days when we would do simultaneous equations for valuing holding companies, this is how I think you would have to value it under Rule 11 UA. NBFCs and core investment companies take a bottom-up approach. Start with the company which has no investments and keep valuing up and substituting. Can AO question the valuation report? He can only look at the method prescribed under this rule, and he cannot look at any other method of valuation. What about reference to a departmental valuation officer? There is no express provision in Rule 11 UA or 56(2)(10) for reference to DVO, like there is in 50C. But there's section 142A, where the AO can, for any assessment, refer to DVO, an estimate of value of any bullion, jewelry, investment, or any other valuable article under 56(2). This section was amended from 1st October 2014. It now reads, AO may, for assessment or reassessment, make reference to DVO to estimate the fair market value of any asset, property, or investment. Specific reference to 56(2) has been removed. That means the section has become very wide. All disputed valuation cases would now be referable to the DVO. But here we must remember the Supreme Court decision. A DVO is a creature of the Act and is bound by the Act and the rules, and he cannot deviate from there. So DVO also must follow the valuation prescribed under 56(2)(10) and Rule 11 UA. We don't have time for 56(2)(7)(b because I think my time is up. And if there are any questions, I'll be happy to take them. Okay. Yeah. So valuation methodology to be followed in case of CCPS, whether same as equity, considering it is compulsorily convertible into equity, I would think yes. For Rule 11 UA sub Rule 1, when you are valuing, it is the same. But remember, you are valuing CCPS. So under 56(2)(7)(b, there is a similar decision of the Bangalore Tribunal in 2M Innoviti, where they said that when you are valuing CCPS, don't forget that you are valuing CCPS. You can follow the same rule, but then do the conversion metrics also. Whether gift of immobile property by mother-in-law to daughter-in-law, this is happening any longer, and then sale by the giftee will attract clubbing. There is an exemption under 56(2), not under 64. So 64 yet remains. Can the giftee avail benefits under 54? And giftee would mean donee, I presume, since there will be no capital gains taxable, but it would be in the hands of the donor. So you have to look at it in the donor's hands, whether she can avail of clubbing, all these exemptions. Amount received from HUF by member, whether 56 covered read with 10 section 2A. Section 10 subsection 2A exempts any sum of money received from an HUF by a member. So what you receive from the HUF, yes, you can exempt it under 10(2)(a), provided it is sum of money. If it is property in kind, like immobile property or other asset, then 10(2)(a) would not apply, but you can claim exemption if it is on partition, that I've given up my rights and therefore it is nothing but my existing rights which I'm getting. Yeah, this I've already answered. Are there any questions from the floor? Yeah.
You have mentioned that there is no taxability involved if the shares are being allotted to the same set of shareholders. Similarly, now if a scheme of arrangement is worked out wherein 3 companies out of the 2 listed are upgraded into, or they are merged into the parent company, and 2 listed companies go out of listing and they are allotted the shares of the parent company, which is going to be listed rather. So whether there will be a tax implication under this, or it can take the shelter of this NCLT order and of demerger.
As long as it is an amalgamation as understood under 2(1)(b), eligible for exemption under 47, then you can get the exemption under 56. If what you are saying is not an amalgamation under 47 exempt, then 56 exemption will not be available. But I would say even without that, you look at the general intention of the law. Is it for tax evasion? Yes. Can you say there is tax evasion when NCLT has blessed the scheme? Therefore, even if there is no exemption, you should try and claim an exemption that this is not an anti-abuse.
Because the shareholders are deprived of the first
exactly
shares and they are being given the
so I have given up something.
Okay.
Yeah.
What about the payment from the seller, the shareholder?
So he is not getting anything free of cost. His shares have gone out of existence.
No, but suppose if the buyback happens at much lower than the FMB.
But he's only getting
the,
money. He's only getting money in lieu of that.
Yeah, no, especially in case of holding company, where the discount to the FMB as you calculate under Rule 11 UA is much lower than the, the actual buyback value is almost say 20% of the FMV.
Okay.
Then what will happen under for the seller for a buyback?
So again, I would look at it that my assets have gone out of existence. There is no provision that I am receiving shares. I am getting money. So what I'm receiving is in lieu of my shares. So then you cannot say what was the value of what you gave up.
Oh, my question was not with 56, with 50 CA.
50 CA. Okay. Okay. So whether 50 CA can apply. Now there I would look at it. Are you being taxed under capital gains? You're not being taxed under capital gains because on buyback, it's the company paying tax.
No, but
So
there is,
50 CA doesn't apply only.
it is only to the extent of you are debiting the reserves, not in all cases.
No, on everything. Buyback applies even if there are no reserves. Even if you do a buyback from securities premium, there is a buyback tax. See, buyback is not under 222. Buyback is under 115 BBQ, where there is a separate section which says money paid minus money received. Even if the source of buyback is share premium, you do not have a single accumulated reserve, yet the company ends up paying buyback tax. Therefore, all buybacks are exempt in the hands of the shareholder. 50 CA does not come into perspective. That's my view.
Okay.
Yeah. As I put a caveat, na, that 56 only I'm dealing with. I did law also.
Sir, question on valuation.
Yeah.
Property sold under auction, given for the adjudication. What will be the effect under income tax law? Because
Yeah.
there will be the difference in a
So
valuation.
here there is Justice Gautam Patel's decision under stamp duty that when property is sold under government auction and it is lower than stamp duty ready reckoner value, can you say that this was done by money laundering? Are you saying that the court was a party to this money laundering exercise? That is what Justice Patel has so rightly said. I would use the same decision here, that when the court auction is there and I have gone by a legal channel and I have paid lower than reckoner value, how can you say 56 should be attracted? But then this is an argument. You're going to have to go through the process because it's exempt, I mean, expressly not covered.
Thank you.
Yeah.
Thank you, Anup bhai, for giving a very exhaustive session. We had a wonderful clarity on the subject. With this, I would like to call upon Reno to propose a very hearty and well-deserved vote of thanks.
Thank you, Ujjwal bhai. It was an absolute pleasure today to firstly attending this Taxcon mega event on behalf of MCTC and being given this pleasant task of vote of thanks. Supply, valuation and taxation of property, shares, capital assets, gifts, now crypto. It is and it will always be a matter of litigation in our country actually. But the way CA Anup ji has presented his crisp and clear views today in front of us, backed with his in-depth study, practical examples, noteworthy case laws, high court judgments, it will definitely polish our existing knowledge on this topic. He has refined the section 56 today threadbare and simplified it for all the participants here. I, on behalf of MCTC, Taxcon team, and my personal behalf, would like to thank CA Anup ji today for sharing his valuable inputs here. Lastly, I would want to take just 2 points from the introduction that my colleague CA Ujjwal has said today about Anup ji. One, he is a library of tax laws. Yes, he is. Second, it was magical to listen to him. Yes, indeed, it is poetic and magical to listen to him today. So thank you, Anup ji. We'll just have a 2 minutes break and the next speaker is already present virtually with us. We'll just start the session in the next 2 minutes. Thank you.
Let's start. Good morning, one and all. The second topic is going to be controversies in ITC under the GST law. Now, friends, when it comes to controversies in GST and especially ITC, people are given several names to see less credit, seem less credit, seemingly less credit, but it is never seamless credit. But what is seamless is discredit. So I think that we should have another term which is now seamless discredit, is how the ITC laws are going. And I see no one better than Advocate Rohan Shah to take us through the controversies and also give us some snippets of his quote unquote battles in the court. So I request my convener Jatin Cheda to give an introduction. Thank you.
Thank you, Parth. It is giving me immense pleasure to introduce Senior Advocate Mr. Rohan Shah. Mr. Rohan Shah is a graduate from the Government Law College, LLB. He was the first class and was placed in the first in a university. Mr. Shah is a qualified solicitor and member of Law Society of UK. There is a very good list of his career. So to highlight the few of them is like Mr. Shah was founded the law firm Economics Law Practice ELP, and he was a founder partner and managing partner of that firm. He was been a full-time counsel practice. He was an independent counselor in the Supreme Court and various high court like Mumbai, Delhi, etc. tribunals and other jurisdiction. His area of practice mainly in indirect tax such as world trade laws, custom duties, exempt, excess VAT, GST, etc. Mr. Shah involves himself with a very other committees like government committees and other delegates. He was the part of the Indian Commerce Ministry team. He was the member of Expert Council Committee formed by the Ministry of Finance, for the rationalizing the tax structure of the gem and jewelry industries. Mr. Shah was appointed in 2007 as a member of committee formed by the Ministry of Commerce, making the India an international trade hub of the elements of a diamond industries. He is the member of the high-level committee appointed by Ministry of Finance under the chairmanship of Dr. Ashok Lahiri. He is author of various publications such as articles, Indirect Tax, Direct Tax, World Trade Law, GST, published in Times of India, Economic Times, Business Standard. Mr. Shah has been speaker at various international legal forums, including Cambridge Process Plenary Sessions, International Fiscal Association. Mr. Shah was featured by the India Today in January 2000 edition in listing 50 Indians for the next millennium. Mr. Shah also featured by Economic Times, the Times of India, Business India in relation to his achievement in his career as a lawyer. With this brief introduction, I may welcome Mr. Shah, who has joined us online. And I, from the all 6 association, I welcome Mr. Shah and I request them to take a charge. Thank you.
Sorry, am I audible and am I visible? Hello?
Yes, sir, you are audible.
Okay. So just so have you got the presentation up for the audience? Let's get the presentation. Yeah, sorry. Are all of you able to see the presentation?
Yes, sir.
Okay, great. Let me begin. So firstly, thank you for giving me this opportunity to address colleagues in the profession. And I think as we come to input tax credit, as was mentioned by somebody who made the opening remarks, that it is probably the one area of GST which has caused the maximum amount of heartburn and maximum amount of litigation. Over the next hour, I'll try to sort of hit on some of the key issues historically and in the context of the current debates which are impacting industry and I'm sure are therefore creating opportunities for you all with your clients. I think it's most useful to look at the issue. I can't seem to move the slide. Most useful to look at the issue. Sorry, give me a second. Oh, sorry. I'm told Mr. Deepak Shah is controlling the presentation. Should have done it. Can we go to the next slide? Yeah. So I think most useful for us to look at this really in 4 different silos. One, when we began with the ITC concept in GST, what was the scope of eligibility and what were the conditions for taking credit? The second, the transitional provisions. The third, what were the restrictions in the context of the availment of the credit and the aspect of the cash refunds. So in the course of this, I'll take it up as eligibility, restrictions, transitional credit, and then the cash refunds. If we go to the next slide. Hello. Yeah. The fundamentals on which we sort of entered into the GST were the promise of the free and full flow of credit. And it was one of the pillars of the framework of the GST that we would have a free flow of credit, which meant no tax on tax, and which effectively meant that we would eliminate the cascading impact of indirect taxes. And that was seen as one of the great merits of taking what were a series of different indirect taxes, either imposed by the state or the center, and putting them together into one cohesive levy, which levy would offer us the situation of a flow of credit, which was not possible in the old structure, because in the old structure, central taxes could not be offset against state taxes and vice versa. And the impact of the move to this cohesive credit system was supposed to be reducing the overall tax cost in the country by about 3 to 4% in terms of indirect taxes, and a corresponding spurt in terms of economic activity and in terms of economic consumption. If we go to the next slide, the basic formulation. Yeah, sorry, can we go beyond? Can I take control of this, if you don't mind? Hello, the movement of, hello.
Yeah, you can have it.
Yeah, sir, 1 second. We are just passing the control to you. Sir, I think you can do this thing. Can you just check that at your
Yeah,
side?
I can. Yeah, thank you.
Yeah, thank you, sir.
So if we come to the basis of the empowerment of credit, can you eliminate these boxes? Of the empowerment of credit, the provisions of section 16 really are the empowering provisions. And if we see the conditions which are inherent in section 16, they are actually quite simple, which is in a way reflective of the credit system we used to have pre-GST and the credit system that you have all over the world. One, that the person in question would be in possession of the tax-paying document. The person should have received the relevant goods or services, that the tax should actually have been discharged in the manner of being paid to the government, and that you had a record in terms of the procedural aspects and the audit aspects. Now, as simple as this was, some part of this got contentious. And the one part which got contentious at the highest level was the issue of instances where duty-paying documents were available with the service recipient or the goods recipient. The recipient had in fact discharged the tax and paid it over to the supplier, but the supplier in turn may or may not have paid his tax over to the government. And if he didn't, then we had a series of different actions taken by government to address this issue, each one of which has successively restricted the ITC and actually made it more and more litigious and more complicated. Now, few and far between as they are, there have been a few beneficial amendments to section 16. And, we'll study those in this slide and then sort of move to how the provision has actually become more onerous and more restrictive. So one of the issues, which was practically impacting industries is that you effectively in the original invoice paid 100 rupees. There was then an additional payment which was passed on to the recipient by way of a debit note. And the issue was, did you calculate the time frame for eligibility from the original invoice or from the date of the debit note? And we now have amendments with effect from the 1st of January 21, where effectively relevant to those debit notes, your situation is that you would count your period of time and the time limit from the date of the debit note and not the date of the original invoice. Now, as we know, every time that a more onerous provision comes in, government is unafraid to make it retrospective, irrespective of what the courts have said in the past, irrespective of global perspective that retrospective amendments are clearly unwelcome. We've not been afraid to legislate retrospectively. But in the context of this particular facilitative provision, we find that even though it is curative, it is only prospective and therefore looks forward from the 1st of January 21. The other facilitation which has come in the context of bill to ship to transactions in relation to services. And in services, there was no recognition of this stream of transaction. But now you are enabled to get your credit, even in a situation where these services are provided by the supplier to another person at the direction of or on the account of the registered person. So again, something which was a commercial reality, but was a gap in the context of ITC recognition, now sort of has the recognition, and this is another facilitative provision. If we see the finance bill of 22, again, one welcome amendment that your previous time limit, which was really the 30th of September of the following financial year, as a time limit in terms of your ability to take credit of any tax paid, that now effectively stands enhanced by a 60-day period, and that effectively goes to the 30th of November. While these facilitative provisions are very few, there is sadly a plethora of provisions which have successively sought to restrict and in many cases almost outright frustrate the availability of credit. And there are a series of them, and I don't think I'm going to be able to cover everything in the detail that might be warranted, but let's take up all of the key ones, right? So section 16(2)(c), since the inception of section 16, and therefore from the 1st of July 17, specifically had a requirement that the ITC will only be available if in fact the tax has actually been paid to the government. Now, there are two parts to this. As a recipient of either goods or services, I can be responsible to ensure that the tax charged to me in the invoice is paid by me to the supplier. How the supplier then in turn interacts with the government and the sequence of how he makes his payment and the extent of how he makes his payment is of course not within my control. And because conceptually, this is what in law we would call an exposure which is vicarious. Namely, if A commits an act or a default, the consequence goes to B, and B in this case being the recipient who has already paid the tax. There were a series of challenges. And the series of challenges really were across the lines of saying, A, I have no control over what the supplier does, and therefore the onus which you are asking me to discharge, that I can only take credit if he pays the tax, is an impossible onus because you are asking me to ensure compliance by my supplier over whom I have no control. And the second situation was, it is the statutory obligation of the supplier. If he does not comply, you have recourse against him. So why are you visiting me, the recipient who is compliant, with an adverse consequence? And the third situation is that ultimately you do have the credit mechanism to ensure that there can be a discharge of tax through the credit mechanism. Now, if you're going to have a situation where you deny me credit, the situation is actually I'm going to end up paying more tax in cash. And therefore, some people position this as an argument in the context of this being a double taxation, because I had already paid the full tax to the government, but I was not able to get the full credit, as a result of which I would have to pay more tax in cash on the further and ongoing transactions. Now, this issue in terms of a similar provision came up in the context of Section 92G of the Delhi VAT Act. And that particular judgment is of some relevance, although it is not a judgment directly in the context of the GST provisions. The situation is that it deals with a very similar provision where the buyer of the goods could not take credit if the seller of the goods had not deposited the tax which he had recovered from the buyer. Now, the view taken by the Delhi High Court was really in terms of four key issues. Firstly, they said that you cannot have a situation where a buyer in a bona fide transaction who honestly pays his tax to the seller can be denied a credit on the fundamental basis that you have completely obscured the difference between a bona fide buyer and somebody who may be party to a fraud or a fraudulent scheme, and there is no justification to so disable the availability of credit to a genuine bona fide buyer. The second situation that the Delhi High Court considered is that this sort of a basis which does not distinguish between a bona fide buyer and a malafide buyer is something which is in a manner contrary to Article 14 and the concept of equality under Article 14, which permits the government to make a distinction between categories of citizens based on the particular objective of a legislation. And Delhi High Court felt that a distinction should have been made in this sort of a provision for a bona fide buyer who should have never been denied credit and a malafide buyer who could be denied credit. And therefore, it was said that in not making this distinction, the government had effectively slipped up. The third concept was one where they said, you cannot place on the assessee an impossible onus in order for him to be able to exercise his vested right, which many have interpreted as the vested right to credit. Now, the impossibility is this, that while I can be in control of paying my tax, I cannot be in control of the supplier paying his tax. And from that perspective, if you will, in a manner, visit me with a disability because he does not do something, then you are placing an impossible onus on me, because neither by law nor by contract can I ensure that he actually pays the tax. By contract, I can have a term to say you will pay tax. I can seek an indemnity for failure to pay tax, but I cannot physically force him to go pay his tax. So for all these reasons, the provision in 92G was read down, and it was read down to effectively say that a bona fide buyer must get the benefit, whereas only a fraudulent or a malafide buyer is somebody who should be denied the credit. Now, this basis in Arise India, which is on a very, very similar provision to 16(2)(c) of GST, is something which, of course, now people are urging in the context of saying 16(2)(c) is also in that manner not sustainable in the law. And we have a series of challenges to 16(2)(c) pending in the high courts. In all cases, notices have been issued. We haven't got a final ruling. So, you have Unifab before Bombay High Court. You have the Aniruddha Banerjee case before the Calcutta High Court. Now, the only ruling really, which is a GST ruling, is the DY Beathal Enterprises ruling of the Madras High Court. But that introduces a slightly different aspect from the Arise India, because in Beathal they say that you as the tax department have every recourse against the supplier who has not paid the tax. He is your assessee, he is registered with you, you can give him a tax recovery notice, you can effectively seize his goods. You have an entire machinery of how you can take actions against him for recovery or to penalize him for non-payment. And if therefore you have a full legal recourse against this supplier, then why are you targeting and disabling the receiver or the purchaser? Because that is not compatible with the law. And in Bethel, they actually said that there was not adequate inquiry against the supplier. There was not adequate investigation and action against the supplier, and they set aside the demand for that purpose in the facts of that case. Moving on. Besides the restriction and the way in which sort of it has been interpreted in the 16(2)(c) scenario, another huge issue of contention has been situations where there is a mismatch between the GST 3B record of the particular recipient and the GSTR 2A. And the situation very simply is that if the 2A effectively does not match the 3B, then the situation is your capacity to take credit is not equivalent to your 3B and the duty paying documents, etc., which you hold, but your capacity is then restricted to the balances in the GSTR 2A. And in the context of the GSTR 2A, what was legislated by Rule 36(4) was that you could effectively only take credit, and depending upon the circumstance, to a maximum 120% of what were the balance in the GSTR 2A. Now, the bringing in of this restriction as a rule drew a series of writ petitions, and the challenge effectively was that 36(4) was ultra vires the act. Now, why is that so? As we all know, under the GST law, there is a basic framework of the availability of input tax credit, which is really section 16, and then, read with the restrictions in 17(5), etc. Now, as in all enactments, there is a rule-making power. And the rule-making power mandates that the rules will be made in a manner consistent with the act. As a result, if any rule is made which restricts credit or disables credit, that rule could not be legally valid unless there was a corresponding empowerment in the act. And therefore, unless the act gave such an empowerment, you could not formulate a rule. The challenge to 36(4), therefore, classically became the challenge to say 36(4) under the rule-making power is an illegality because it imposes a restriction beyond and contrary to whatever is provided in the section. And to the extent that it goes beyond the section or runs contrary to the section, 36(4) in itself is illegal and ought to be struck down. And therefore, today we have pending proceedings in the Rajasthan High Court. We have the Gujarat High Court, where you have 2 proceedings, including Surat Mercantile. And the challenge essentially is a repeated constitutional challenge which comes up throughout GST, that the provisions by way of rules to restrict credit are much more onerous and beyond the scope of the relevant section. Now, because these challenges came, as we've seen repeatedly in the context of GST, an amendment was made whereby in 16(2), you brought in a clause 16(2)AA. Now, this was brought in with effect from the 1st of January 22. And this was brought in to now give sanction to what 36(4) says. And in this manner, the government sought to answer the challenges in the various writ petitions to say, yes, there is a source of power for the rules, which is to be found in the section. And that particular section is 16(2). AA. What it of course does in a manner do is that the government is signaling that in the period prior to 1/1/22, the rule was not in a manner supported by any empowerment under the section. And I would therefore logically think that all the petitions and challenges which are for the period prior to 1/1/22 in that manner should effectively succeed. Other issues, of course, continue to remain. The issues of vicarious liability, etc., which we'll touch on in the next few slides as well. Another of the provisions, which has made the whole credit mechanism far more onerous is, again, the insertion of Rule 86A. You brought this in the rules by way of a notification in the December of 19. And this is a situation where you empowered the commissioner or the authorized officers to disallow the debits of the electronic credit ledger or to block the ledger based on a reasonable belief that the input tax credit has been fraudulently availed or is ineligible. Now, two very difficult and contentious concepts here. The concept of reasonable belief in the context of tax laws, both direct and indirect, in the context of regulatory laws, whether it's the FEMA, whether it's the PMLA, it has always been one of the most highly contentious issues as to when can it be said that a reasonable belief has been formed by the proper officer. There have been a line of judgments of the Honorable Supreme Court to say that if there is even a modicum of evidence, then that is sufficient to form reasonable belief. Why? Because economic laws are the lifeblood of the nation. Unless we have revenue, we cannot run the various programs of government. And therefore, in the context of economic laws, leeway must be given to officers. So this is a very generous view in favor of the department. There is also a far more stringent view to say that reasonable belief must be caused only in a situation where the amount of evidence would leave no reasonable person in doubt that A, there has been a breach and that any proceeding brought will result in an indictment of the person. So at one level, we have the modicum of evidence test. At the other level, we have the sufficiency of evidence test. Practically, however, we know that officers use and misuse the reasonable belief to state any frivolous reason to say that that constitutes a reasonable belief. So firstly, you have the troublesome concept of reasonable belief. Then you have certain stated instances. Some of those are very warranted. So for example, if ITC was taken on duty paying document issued by a non-existent person or credit taken by a non-existent person, or the 16(2) scenario comes back again in the context of saying that, in respect of the supply tax is not deposited or paid to the government. But your situation is when you open this up in the context of saying on reasonable belief, you effectively can disable the entirety of the credit ledger. The risk that you put the assessee to is massive, and the checks and safeguards that you have are non-existent. So expectedly, we have constitutional challenges. Amongst these, I think the leading challenges are the Realty Private Limited in Calcutta High Court and the VIJ engineers in Punjab and Haryana. We also have a recent decision of the Bombay High Court in DV projects, and constitutionality came up. Various arguments was taken. The situation is courts tend to protect many of these provisions on some sort of constitutional anvil. So here the situation was that court said, look, there is a balance. The balance is you have said reason to believe. If you say reason to believe, then that would be on the basis of material which is available before it. The aspect of credit being ineligible or fraudulent is in a way best left to a tax officer. And in any case, under the provision, the officer has to record his reasons in writing. Now, in a way, this did not deal with three fundamental challenges. One situation is the doctrine of proportionality. And the doctrine of proportionality says that the consequence you can suffer must be equivalent to the breach which has occurred. So therefore, if you fraudulently indulge in a transaction to take credit, yes, the consequence is that your electronic ledger, electronic credit ledger can in a manner be frozen or disabled. Yes, you may suffer a penalty. But that is in a proven case of fraud. At a reason to believe stage, which is a preliminary inquiry stage, if you say that there is a right to freeze the credit, then between the causation and the consequence, there is no proportionality. And if there is no proportionality, then just on the proportionality principle, Rule 86A would have been vulnerable. The other challenge is, where is natural justice? You take your action based on evidence which is not put to me. If you put the evidence to me, I could very well have effectively offered you an explanation. But you don't give me that opportunity. And therefore, this also runs contrary to natural justice. It runs contrary to the protections of Article 14, which is equality in the sense that if others will get a show cause for other breaches across the Act, why will I not get? Especially when all you really have is a reason to believe. Also, your protection under Article 21, that due process fair trial. Now, court took a view which I think will get tested in the Supreme Court. Court said, why should I only have a hearing pre the judgment? Even if there is a post-decisional hearing given, that should be good enough. And in the facts of the case which was before it, they ordered this sort of post-decisional hearing. Now, post-decisional hearing in a matter which involves revenue is actually unheard of, because the fair trial rule says you must be A, put on notice of the case against you, and B, you must have an opportunity to defend your case fully. Now, if a decision is taken, you have already suffered an adverse consequence, and then somebody gives you a hearing, it completely upsets the apple cart, because the legal principle is hearing followed by decision, not decision followed by hearing. And while therefore the Bombay High Court has sort of espoused a post-decisional hearing in this situation, I think, as this goes higher, there are several grounds of challenge which will effectively come forth. As we sort of continue in this saga, again, where you see more and more onerous provisions in the context of credit, the board circular of 2/11/21, which then now says, oh, we are giving you guidelines. And why these guidelines? Because there are so many challenges that they said, okay, we will give you guidelines. And part of those challenges would have been also on the basis of excessive delegation, that you have not given any tangible criteria for the reason to believe. So from that particular perspective, this is also going to be an unsustainable provision. So now the guidelines in a manner of saying that, yes, the reason to believe, and the reason to believe must be that it is ineligible or fraudulent. The officer will only act after a proper application of mind. He will not act in a mechanical manner, and he should prima facie be satisfied that he has material evidence based on which he can act, and that he will record his particular reasons to believe in writing. Now, point is, all of these are ultimately in a circular, and therefore, as a circular, they have a certain persuasion, but they certainly do not have the statutory force in terms of saying that this should have been ingrained as a balance in the provision itself. And the issue, therefore, is we have challenges. You have a provision which puts a very unequal and a highly onerous power in the hands of the officer. There are no checks and balances. And from this perspective, the situation is you will, on proportionality, on excessive delegation, have continued challenges. I think a provision like this, if at all, should have only been restricted to situations of fraud and in a situation where there was enough primary evidence for officers to form the view that there is fraud. And one easy balance for this is don't invest this power in one officer. You know, you can always have a subcommittee of officers, a principal commissioner, a commissioner, and the investigating officer. And then on a majority view, you take the view that there is reason to believe, because if you create this mechanism, not only will you get more qualitative investigations and decisions to investigate, but you also give a far greater faith to the assessee that the framework is a fair and transparent framework. Again, moving on in this sorry saga, you know, the insertion of 86B again sort of came into effect 1st of January 21. You know, situation to say that in a situation where your tax payment, your credit availability and utilization is in excess of 50 lakhs, then you have a restriction. You cannot pay all of your taxes from your credit. You can only pay 99%. Now, again, the fundamental premise of credit is every rupee of tax paid should become credit and should be offsettable. But you bring in this restriction, and you know, you could have 99% over a period of time. You know, you could say you can only use it for 90. Tomorrow you could say 70. So the situation is again expectedly challenges, and those challenges very clearly again on the basis that Rule 86B restricts availability of credit, but there is no empowerment for this under the section. And as a result, this is ultra vires. Expectedly and proposed amendment. This proposed amendment now to section 49, and you are now trying to write the basis to say that, you know, the government effectively will now have this right. And in terms of the government's ability, since you have given an empowerment in the section, you are saying that that will effectively cure the empowerment issue in terms of the rule. And now, very clearly, this can be done. And the answer for everything is it is becoming more restrictive because there are so many frauds. And the frauds are rampant in terms of taking ITC. And the situation is, open the papers every day and, you know, you will see that somebody 100 crores, somewhere 540 crores, etc. And because rampant frauds are there, the situation is we can keep on restricting in the manner we want. Now, if you take the entirety of the value of these rampant frauds, the entirety of the value of these rampant frauds is not even 1% of the totality of the credit utilization across the country. And the situation is that at a 1% in a transitional law, you would actually have just increased the policing to offenders rather than to make statutory changes to disable the entirety of the 99%, which is effectively tax paying and compliant. So what we have a situation is that 1% of suspected fraudsters have effectively colored the system for 99% of honest taxpayers. And I think that's probably, to my mind, really the one fundamental tragedy of the GST has been the successive action and action after action to keep reducing the availability of input tax credit. Again, we have this new availment framework 16(2)(ba). Now your situation is you are looking to insert this provision in terms of, again, saying that you will restrict credit and credit will not be available in the context of the supply if the same is restricted in the details provided in form GSTR2B. So your situation is you are sort of getting into a one-way communication process. You look at your auto-generated statement, and you will now have a list which is eligible and ineligible or restricted, and really, again, what you're getting to is that if a supplier defaults, then again, a honest recipient who has discharged his tax is really going to again have his wings clipped in the context of the availability of credit. And if we look at this, right, you look at all of these particular provisions, they have a common thread, right? And the common thread is that if a supplier defaults, then the consequence of the supplier default is going to be to the recipient, and the recipient is effectively going to lose in some form or manner, either in a restricted manner or in an absolute manner, his access to credit. Now, the first legal challenge to this is that as a government, we have completely overlooked the entirety of the law on vicarious liability. Vicarious liability is a stream of the law which in equity says, please don't make Tom pay for the crimes of Tim. You cannot have a situation where somebody else's default creates a disability for somebody who in himself is compliant. Now, in our situation, firstly, we have a civil consequence. So the civil consequence is, despite your having paid the tax, you will effectively not get the credit. Besides the civil consequence, in certain instances, you will have a penalty, which is quasi-criminal. You will then have certain exposures to be prosecuted. Now, the one fundamental principle which other economic laws do not transgress in any part of the world is making, as I said, Peter liable for what Paul has done. It is not a fundamental basis adopted in economic laws anywhere in the world. You have to be part of a conspiracy for you to suffer the adverse consequence of the act of another. So the only way that you can suffer for the act of another is that you are part of a conspiracy and you have effectively acted in unison with a common intent. But absent that, you can never have the concept of vicarious liability. And the fact that we keep expanding this really is showing up our system as a complete deviant from credit systems across the world and legal systems across the world. The other situation here is that once you keep reducing my availability, but those successive provisions don't have checks and balances, like the provisions in terms of saying, you could say you have reason to believe. Constitutionally, all these provisions whereby you are seeking to deny me, where there are no checks and balances, where there is no prescription, they all suffer from the vice of excessive delegation. The theory of delegation is that when you do something as government, where you delegate power away from the parliamentary process into the executive process, and those actions are likely to impact the fundamental rights, such as the right to do business under Article 19(1)(g), the situation then is you must prescribe suitable checks and balances, because maintaining the fundamental rights is the fundamental duty of the government. If you don't have checks and balances, administrative officers can invade into territory and take actions which disrupt the business of a assessee, of a citizen, which directly is contrary to the constitutional protection of Article 19, or you recover taxes where you have no authority of law, which again is contrary to Article 265. So we are seeing this trend of increasing vicarious liability. We are seeing this trend of restriction with excessive delegation because no checks and balances. Clearly, we have now so chipped away at the fundamental pillar of GST in terms of saying credit will be available for every rupee paid, simplified credit, full credit, seamless credit, that, I think the structure itself at some stage may be in danger of falling. The other situation is universal principle. You cannot compel a man to do that which is impossible. So what you are telling me is that I will not get credit if I cannot ensure my supplier pays the tax. And you know that I have no control over my supplier. And from that perspective, you are saying the conditionality that I ask of you is a conditionality you can never satisfy. And if you cannot satisfy it, then the Latin maxim effectively was to compel a man to do that which he cannot do is really to drive him to his civil death. Because if I am in a business where every day I have to pay tax for my supplies, but I can get no credit, I am going to be in an unviable business, and an unviable business is really civil death. So again, we sadly are moving in to place this impossible onus on an ever escalating basis. And ultimately what? Everything must traverse through the high courts to the Supreme Court, which is effectively a 15-year journey, a 12-year journey if you are lucky, a 10-year journey if you are very, very lucky. But from that perspective, for 10 years, you are going to be in a state of really animated suspension. You are going to keep paying taxes. You may not get the credit. And that again fundamentally brings us to double taxation. If cascading taxes come in, because ITC as a concept is getting diluted and destroyed, ultimately we are getting into double taxation. And from that perspective, the situation is it's a tax on tax, or the same commodity is suffering tax through two different measures, which it is not supposed to pay. So I think really the trend in terms of how Section 16 is successively getting more and more constricted, more and more onerous, is really a sad story for how we are going with GST. And I think government has to take this value call. You want GST, you're going to give credit, then I think all this shadow boxing, where every day some new provision comes in to haunt us, really has to go. Let's go then to the other part, which is the statutory restrictions. And in the context of the statutory restrictions, I think many have been commented on, but I think increasingly the two which are getting more and more contentious are the denial of credit in terms of situations where immovable properties are constructed, and typically you have a burnout of the credit. The only exception is plant and machinery, and what is plant and machinery has also become quite contentious. But the fundamental situation is, open the front page of the financial papers. The hottest sector going seems to be investments in warehousing, investments in data centers. That is what the government is also saying is going to give us some of our greatest growth. Now, take that as an opportunity that the whole government is standing behind and promoting, and look at that now in the context of 17.5C and 17.5D. What you are effectively saying is all input services, if ultimately they result in an immovable property, even if you now generate rent from this, and even if you pay GST on that rent, I will not allow you the credit. The only exception is works contract service for further works contract service. Now, in this day and age, A, this restriction has absolutely no rationale. B, you don't see this in any other systems. Yes, I make a building in the context of self-consumption. Somebody may say, you are not putting the asset to further use, which is a outward supply, which is taxable. That is understandable. But if I create an asset, which asset, even though is capitalized, is depreciated, is ultimately going to result in a output in the nature of a taxable supply, then the restriction of this credit no longer has a rationale. It, to my mind, was irrational to begin with. And if now we are saying the national policy is really to sort of move in this direction, where we can move and store goods all over the country, for us to be a fully, truly vibrant distribution economy, then the situation is this just does not make sense anymore. We've had those restrictions really from the July of 17. Sadly, and as we go across, of course, we've had further round of restrictions because we expanded the scope of 17.5 in the February of 19. And expectedly, we have a series of disputes. Now, on this immovable property aspect, the only judgment which seems to have taken a line to say what is the rationale for this has been the safari retreats judgment, right? And the safari retreats sort of has done in its best attempt, I think, a judgment to say, oh, you should read down this provision. But, reading down in a situation where you have a specific statutory restraint is not an easy concept. The situation is, I think there has to be a full frontal attack on the rationale of 17.5C and 17.5D. And from that perspective, we see that, Safari came up to say, read this down. In DLF Cyber City, Punjab and Haryana, again, followed Safari, but at an interim stage. Bombay High Court also has followed it, but at an interim stage. There is no final ruling in the context of this. In the context of the 17.5D concept of plant and machinery and the specific exclusion of telecom towers, again, you have a Bharti Airtel-led challenge in the Delhi High Court, admitted. They are saying they will consider it with a sort of group of other matters which raise these challenges. But the fundamental sort of issue is that when you challenge constitutionality here, of course, it will be said that it is within the domain of state to decide in exercise of its sovereign powers what policy it must have in terms of permitting or not permitting credit. Yes, that is undoubtedly true. But when you have a provision, even a policy provision, the policy provision running contrary to your stated industrial policy of the future, your stated infrastructure policy of the future, then are we not going into the area of arbitrariness? Are we not going into the area of, some may say, perversity? But the question really is, should all of this only go to court? Because as a legal issue, it's a minefield of issues, right? The first issue is, what is an immovable property? So if we look at the law as evolved by the Supreme Court, Solid and Correct and Sirpur, Metallurgics, Triveni, you have a different series of tests, right? Firstly, immovable property not defined in the context of the GST law. So you look at the General Clauses Act, and your situation in terms of structures is this thing attached to the earth? And when we look at the General Clauses Act and these explanations, attached to the earth would mean a foundation or a wall. Now, so if you have a foundation or a wall, it is embedded in the earth because the foundation is embedded and then the wall is embedded in the foundation. And then if you permanently fasten on some things, they could also effectively be immovable. Now, if we look at that test as judicially stated, then you have two different tests. One is the permanence test. That means you have created the structure, the structure will stay there for eternity. Now, a dilution of the permanence test is that in this day and age, we can make very large buildings even with screwdriver technology, because nuts and bolts can put walls together, and then you have anchor bolts and 1 lakh square feet where houses are created. So the permanency test was diluted to say, if the structure can be dismantled, moved somewhere else, such that the functionality of the structure is not impacted, then in such a situation, it is not immovable. And this was a dilution of the old permanency test, which regarded construction in the way that many of us would know it traditionally, which is construction in the accretive method. What is the accretive method? That brick by brick, you create something, or steel plate by steel plate, you create something. And every time you put a brick, it is becoming part of something which is already immovable. So finally, after all bricks are laid and everything is done, you have a structure which has always been immovable because its foundation was embedded in the earth. Now, technology has taken us to a situation where structures can be dismantled. So the situation is, if you can dismantle it and take it somewhere else and repurpose it, it is not immovable. But there is another test. And the other test is the object or intention test. And that object or intention test is, did you intend for this structure, even if you could ultimately dismantle it, to be in this place? Now the answer is yes. If you look at the contract which I have with the person who is taking my warehouse, it is typically long-term. It typically is telling you what sort of specs are needed, and therefore I am meeting his specs. It typically has a locational requirement because the man wants to know where his warehouse will be. It requires statutory permissions to be taken, including municipal permissions, sarpanch permissions, if it is rural. Therefore, it seems that even if you can move this structure because you can dismantle it, you will not meet the intention test, because the intention test is, yes, this must stand here, at least for 10 years, 15 years, 20 years. So as a result, the scope of what is immovable is very wide. The exception is plant and machinery. The situation is plant and machinery you have defined. And what we are saying is that if you have plant and machinery, which you render immovable for functionality, that is also a facility you get. But the superstructure is always caught as an immovable because of the intention test. And if the superstructure is caught as an immovable, then quite honestly, for sectors like this, I have no facilitation, whether it is warehousing, whether it is creating large industrial parks, whether it's creating large business parks. And from that perspective, the situation is, yes, we can go and debate it. Yes, we can have constitutional challenges. But is this not something where, consistent with what we are saying is our industrial policy, we actually should take a legislative step to revisit 17.5C and 17.5D to say, whatever be the situation where this particular asset will be used to generate a outward supply which is taxable, we will grant you the credit. I think it's very important that we move in this direction, because if we want this sector to, as we say, grow at 100x in the next 3 years, but we are saying the solution is in going to Supreme Court, which is 10 to 12 years, then quite honestly, we are on a really sorry path, in the context of this. Also, some very peculiar situations like CSR expenditure would not be allowed. And of course, I think the Authority for Advanced Ruling and even the Appellate Authority has in a manner become some sort of a terrible joke, because 99% of their rulings are negative to the assessee and supportive of the revenue collections. And as a result, we have not got a advance ruling. What we've sort of effectively got is the tragedy of being told that everything you want to do in business is going to result either in a tax liability or a denial of credit. Now, CSR is a statutory obligation. I have no option to conduct my business unless I effectively discharge the CSR. Now, that which is part of my statutory obligation is one of my necessary expenses. And if it is a necessary expense, then somewhere, as a prudent businessman, I have factored it into the value of either the goods and services I supply. Now, that commonsensical commercial issue, nobody is willing to deal with. We are instead hassling with the law, and the view is at the AR level that, oh, this is not part of your normal business. So what we are now being told by the wise men in the ARs is that compliance with law is not an integral part of your normal business. Now, that as a proposition is so horrific that what you are saying is you can do your business, whether you comply or you don't comply. The situation is that is extraneous to your business. It is not within the normal course of your business to comply with Indian laws. So that's one view on CSR. You then have different issues like, free gifting. Now, free gifting, again, as everybody knows, there are no free lunches. If you are getting something free, the cost of it is somewhere or the other being recovered from you. And from that perspective, there was the old test, which was the test in the context of Bajaj Auto, where a very wise bench of the West Regional Bench of the SESTAT effectively said, look, there is a very simple principle. If a businessman includes the cost of any element in the pricing of his goods or services, you have to give your input credit. But now what we are getting into is to say, look, the gift is extraneous, it is optional, and therefore all sorts of reasons, effectively why we want to deny. And, this also spreads to sort of other situations like goods lost or destroyed, etc., where there is absolutely no rationale. If we will not allow expenses which are for legal compliance, if we will not recognize that accidents, destruction through fire, other causes will occur, if we will not allow incentivization, and we will say that these are extraneous, not part of normal business, therefore no ITC, I think we're really burying our heads in the sand, in terms of our revenue anxieties. But what we're doing is really saying that, in the administration of GST, neither is common sense common, nor is commercial sense common. Let's then come to the transitional provisions. And the transitional provisions were really what? Tax which you had paid under the old regime, I promise you I will migrate it under the new regime. You have incurred the expenditure, you are carrying it on your books, and I am going to facilitate you take it. It was just what one might expect as a commonsensical commitment to ensure that as you go into GST, you will not suffer an adverse consequence. And therefore, we had a series of different provisions which would effectively enable this nature of transitional credit. Now, ultimately, that move of transitional credit was tax cost incurred only to be migrated. But even so, let's look at the number of controversies. Firstly, time limit for claiming transitional credit in your Tran 1. So your rule 117 prescribes the time limit. That is your December 17. Issue therefore arises, is this mandatory or is it directory? And the difference therefore being, if it is mandatory, you will lose the credit beyond the period. If it's directory, it can be relaxed. Therefore, we go to the courts. As we go to the courts, different views. Gujarat says 117 is good law, not ultra vires. Punjab in advert makes a lot of positive comments, but ultimately says nobody is challenging the vires of these rules. Bombay High Court in Nelco takes the similar view to Gujarat, says that it is not ultra vires, it is legal. Delhi High Court in brand equity takes a view to say 117 has to be read down. It is just directory, it is not mandatory. When you have a situation of credit which is already a consequence of tax paid, then how is it that you can effectively say we will deny it? But what did they then do? They said, oh, not the period under 117. Why not the period under the general law of limitation? Therefore, 3 years. But again, we brought in some sort of limitation. Now, if you see the last line in every one of these in the table, everything ultimately goes to Supreme Court. Each of these cases are in the Supreme Court. When they will be taken up, what will sort of effectively happen? Hard to know, but important to know that the Delhi High Court judgment in brand equity was specifically stayed by the Supreme Court. So right now you really have a situation where 117 is operating under the question mark whether it is mandatory or directory, but in effect it is mandatory because you are not able to take that credit. The situation sort of again, your section 140, your amendments effectively have happened in terms of saying time period and such time period as prescribed. Again, goes to high courts. The PR money situation, which says ample reason to conclude 117 is intra vires. Again, this comes up in the context of Amplexor. Madras High Court raises two fundamental issues which have always come up after the Daiichi. Daiichi talked of the vested right of credit and said you could use it at any stage. Since then, repeatedly, courts have looked at this notion and asked a question mark, is it in fact a vested right? And many are veering towards the view that it is not. Again, reframes the issue, 117 mandatory or directory. Raises the issue in terms of saying there are only prescriptive conditions. Conditions can always be legislated in the context of policy powers of the government. It has been argued that it was my legitimate expectation that I will be allowed to migrate this credit. Actually, that is stating it very mildly. It is not your legitimate expectation. It was the sovereign commitment of government that I will migrate your credit. And the moment you do not allow the migration of credit in a situation where taxes are already paid, some have raised the issue of double taxation. Now, whether it's classically double taxation or not, you have at least borne a burden, which is a tax burden on your supplies, which has become a cost because ultimately there is no migration of credit. Likewise, the situation in terms of section 140 subsection 3, time limit of 1 year, JCB, Bombay High Court, Justice Dharmadhikari said, why are you saying that the migration must be unconditional? Even your right to SENVAT was conditional. It was never absolute. So how can you hope in migration to have better rights than you had prior? And he says there can be no estoppel against statute. But what we seem to miss is that I had a certain pool of credit on a certain day, 30th June 2017. It was your sovereign commitment, you will migrate it. Now, when you bring in restrictions to the process of that migration, essentially you fail on your sovereign commitment. Now, it is not about whether there is the constitutional right, whether there can be estoppel. Essentially, it is there a sense of fairness with which government must act once it makes a commitment to its citizens. But that is not the central issue that the courts are addressing. And while we have JCB as one view, of course, we have Philco, and Philco takes a view to say prior regime had no such restrictions which 117 now has. And from that perspective, there is no rational or reasonable basis for it. So again, two viewpoints. And again, inevitably, we are headed to the Supreme Court where these matters are. And there is, again, one must note, like happened with the Delhi High Court judgment in brand equity, here also the decision or judgment which is in a manner against revenue, a stay has been granted on that. In the context of, again, this transitional credit, the issue was, can we transition cesses, the ed cess and the secondary? The situation is, you had it on your books on 30th June 17. Yes, you could carry it forward under section 140 sub 1. Then somebody woke up to the fact to say, oh, this doesn't seem to be right. So then you brought in a series of amendments. Those amendments sought to insert the word eligible duties into 141. So by defining your eligible duties, you could restrict what was capable of being transitioned. Now, on that eligible duties, your situation then was, you brought in an amendment, and the amendments effectively were 3 different amendments. You could have applied amendment 1 to section 141, but you chose not to notify it. So there was no new definition of eligible duties under section 141. The only amendment which came in was the 3rd amendment, or the explanation 3, which said that the cesses will not be available. But that explanation 3 also does not directly apply to section 140 sub 1, because that explanation 3 applies only in the context of situations where explanation 2 applies. And again, explanation 2 is not been made applicable to 141. So 140 subsection 1 is amended. The provisions which would have given full effect to the amendment have not brought into play. And as a result, now we have the litigation where several assessees are saying, not having brought the amendments into effect, I do have a right to transition my credits in terms of cess and in terms of the secondary cess. Issue goes up to different high courts. Chennai sort of takes a view to say, no, explanation 3 is enough. And in terms of explanation 3, no cesses can be migrated. In the previous regime, we had the BHEL, which was cesstat. where they said that if you newly enact a provision that says credits can lapse, then that would not be a proper exercise of your legislative powers. We have Grasim, in the Gujarat High Court. But as all of this is happening, we then have a judgment pro assessi, which is the Godrej and Boyce. Justice Datta, Chief Justice of Bombay High Court, dealing with a show cause notice, which said, I want to recover wrongly taken credit on cess and secondary higher education, says your 140 sub 1 stands unamended. Explanations 1 and 2 are not brought into effect and made applicable to 141. Therefore, the jurisdiction to issue the notice to sustain your claim under explanation 3 does not exist. The show cause notice itself must fail. So here again, the factor that they made some partial amendment to 141, but the amended explanations, particularly explanation 1 and 2, have not been made applicable to 140 subsection 1. You have one view, which is the Chennai view, which effectively says explanation 3 denies you. You have the Bombay view to say explanation 3 can't deny you on its own till you bring explanation 1 into effect by also making it applicable to section 140 subsection 1. Then you have the controversy under subsection 140 subsection 7, which is you had credits, you bring it into the ITC regime. This was in terms of input service distributor. You would then effectively distribute it to your branches. It's a non-obstante provision, which means it operates notwithstanding any other restriction. In spite of this, we have challenges. And what are the challenges? Challenges effectively are you allow this to effectively come into the Tran 1. And you have entries in the Tran 1 whereby your transitional credit under 140 sub 7 comes into your Tran 1. But from Tran 1, you should distribute it either through Tran 1 or under the ISD return, which is GSTR 6. So now what happens? I enter the Tran 1, but having entered Tran 1, there is no distribution mechanism, either in Tran 1 or in GSTR 6. So therefore, operation successful, patient dead, my credit is migrated, but utilization and distribution effectively is not secured. And as a result, we are all involved in petitions, Bombay High Court, Delhi, Telangana, series of cases, best of names and best of assessees, all afflicted by this issue. Everybody acted on the sovereign promise, and everybody now is looking at sovereign litigation because you're telling the government, I haven't got what I have wanted. As a last issue, and just to round off, the issue of cash refund. And cash refund really is the concept prevalent universally that if you cannot utilize your input tax credit, you should take it as a cash refund, and government is obliged to give it to you as a cash refund. In our situation, we've had a set of controversies in terms of, can I get cash refund? And, the most classic controversy has effectively, of course, been that when you talk of inverted duty structure, where is the refund available? Section 54(3) and the definitions in terms of input service tell you that the credit available on input services and capital goods would be available. Rule 89, which is the administrative provision on how you compute the amount of refund, only talks of inputs, does not talk of input services. Net result, series of writ petitions in the context of the issue. Gujarat High Court in VKC takes a view which is a supportive view, saying no, even on input services, you should have the credit. Madras High Court effectively takes a negative view. The Gujarat matter goes to the Honorable Supreme Court. Supreme Court says, sorry, Government of India, in its exercise of its policy jurisdiction, can effectively say that they don't want to give credit in the context of input services where you can take a refund, and they may restrict this only to inputs. And why they do it is not an issue to be gone into. It is a statutory prescription as per policy, therefore it will prevail. And all other arguments in terms of saying that there's no rationale for this, that if I have already paid the tax, then there is every right for me to be able to transition that, and there is every right once transitioned or on an ongoing basis if accrued, that if I can't utilize it, you must give me a refund. But again, the way in which the judgment has been written, it's very erudite judgment, Justice Chandrachud. The situation is, yes, there were rights, but how those rights are either circumscribed, how they are made conditional is purely in the policy domain of government. And from that perspective, constitutionally, we cannot find anything to fault it. And the message really over there is in the context of saying that, yes, all of this can be done as restrictions based on policy prescription of Government of India. Yes, it is in their policy domain. Yes, there are certain frauds which are happening in the context of ITC. But if this combination of issues, that there are frauds which are lesser than 1%, that we want to keep restricting the credit, and if we restrict it, courts are very likely to say that we are exercising our policy domain and therefore nothing is wrong, then I think ITC as a mechanism, rather than being a facilitator, is really just the fountainhead of litigation. Because every restriction, assessee will feel aggrieved, they will challenge. And courts ultimately will say it's policy domain. So what we are getting into is probably now a situation where the original promises on seamless and full transition, I think, are long behind us. Our situation is, what will they keep chipping away at? And the more that they keep chipping away at, finally, what will we get left with in terms of input credit? And I think that's the chastening thought, as we go forwards. Sadly, as I said, one of the foundational principles is either considerably diluted or at significant risk. And for a nation like ours, where we aspire very rightly, to become an economic superpower, I think there must be a realization at the government level that facilitating a full ITC is actually the surest message that we are a mature economy, and we are an economy where businesses can feel confident that promises will be kept, and businesses will have the environment which they deserve, where they can trust the law, they can trust the government, and act as partners to do the business rather than focusing on ITC litigation, which ultimately is only good for a certain set of people, but certainly is not good for business and the nation. So thank you very much. The topic, I think, was a little too widespread. I have tried to cover as much as I could, and if you all have any questions through Naresh Bhai or through any of your colleagues, please direct them to us, and I'll be happy to respond to as many as I can. So thank you very much.
Thank you, sir. Before the laptop comes to me, there are a few questions which are there.
Sorry, are we sort of overrunning time, because I also need to get to another commitment. So as I said, very happy to take questions and respond to them individually.
Yeah. Sir, in that case, we'll email it to you. I mean, it's okay, sir. There are 3-4 questions, so it will be unfair to not take 1 or 2. So it's totally fine. You've given a very brilliant presentation. So I now request Mr. Vinod Maske to present a hearty vote of thanks.
Thank you, Parth. Good afternoon to all. I'm so thankful to the organizer giving me this pleasant task to offering a vote of thanks to today's learner speaker, Advocate Rohan Shah Sahib. Our Honorable Secretary, Advocate Parth Badekar, rightly says that there is a seamless credit. जैसे नदी में पानी बहता है ना, वैसा seamless credit आना चाहिए. But after the 5 years of GST era, what we found, जो नदी है, राम तेरी गंगा मेली जैसी हो गई है. Sir, after perusal of your resume, it is seen that, sir, having profound knowledge of and vast experience in taxation as well as business and trade laws. Sir, you have very lucid manner explained and analyzed the provisions of ITC as well as transitional credits with its viruses and constitutional validity, and providing the relevant citations and legal remedies available to the layman. I, on the behalf of GSTPM and other co-organizations, propose a very hearty vote of thanks. I request all of you, please carry with loud applause. Thank you. And the next session will be at the 2 p.m. after the lunch. Thank you.
Welcome, friends. Today is second day post-lunch session. You all know that information technology is playing a vital role in our life. And the role is increasing more and more day by day. You must be aware that in 2017, Saudi Arabia country gave a citizenship to a robot called Sophia. So this is how, people are experimenting, and information technologies really revolutionize our life. So similarly, tax technology cannot be stay behind. And we as a professional also, we must keep up to date with the technologies which can help and which can increase our productivity. With this objective in mind, we have decided one very important subject of tax technology. I am glad that Mr. Chunawala, who is a very proficient and efficient in this on the subject, he is going to deliver a lecture on tax technology. With this, please welcome Mr. Chunawala. Sorry. I'm sorry, Mr. Divyesh Lapsiwala. Thank you. Now I request Mr. Hemant Parab, who is the Vice Chairman of Maharashtra Zone, to introduce the speaker. Thank you.
Thank you, Ashwin Bhai. This is the third session after lunch. After heavy lunch, मस्तपैकी नींद आएगी ऐसा सोच के पीछे जो बैठे हैं, please don't sleep, because government is not allowing to sleep. Nowadays, lot of amendment has come. Not only the amendment, notifications, circulars, so many things is coming day-to-day basis. And apart from that, Government portal has changed very dynamically. Now CA is busy in both the things, understanding the law and understanding the technology. Those who have the practice, consultancy-based practice, they don't have to worry. That way, those who have the practically GST, physical practice, those people are doing, professional people are doing, they are very busy. They have a lot of thoughts in their mind. What will be the futures? If such a way, if it is changing, then it is very difficult because nowadays, the GST portal is giving lot of mismatches, generating notices to the SSE, and finally those notices coming to the professionals. So even officer is not aware of it, how many notices has been generated during the day. But lot of SSEs facing the various problems in a mismatching of the ITC, taking the credit, that is a very big headache. To understanding this point of view, so professional has to update their technology knowledge also. Considering this point in the mind, we have kept the topic tax technology, current snapshots and way ahead. For this, we have dynamic young speaker, CA Divyesh Lapsiwala ji. Please welcome him. Divyesh is a partner with the indirect tax practice and leads the Mumbai TMT and FC teams. He has more than 21 years of experience. Looking at his face, I don't understand. He's so young. And the experience is 21 years practice experience in advisory clients on various indirect tax legislation. Divyesh has assisted clients across the sector, including financial services, media, entertainment, logistics, IT, ITES, retails, infrastructure, manufacturing, and so on. Divyesh has experience in handling large, complex projects relating to the restructuring, transformations, technology, implementation, and optimizations. He has a lead several advocacy projects to work with the industry and regulators to make tax policy more implementable. He has an experience in handling tax controversy matters, including investigations and court disputes. Divyesh supports some of the key EY tax technology solutions and works with the client to their technology roadmaps. Divyesh is a regular speaker at indirect tax conferences and has made several editorial contributions on the subject. With this, I'll request all of you to welcome Divyesh bhai. Thank you. Now I'll request Janak bhai to offer a memento to the speaker. As a mark of love and affections, thank you, sir. Divyesh bhai, now dice is yours.
Good afternoon, everyone. And again, this is an amazing opportunity in two ways. One is that so many organizations coming together, organizing an event and giving me an opportunity to speak. it is quite humbling, and thank you very much for allowing me to come and contribute here. And second, of course, because this is after a more than 2-year break, an opportunity to speak in a hybrid model, hoping that this hybrid also goes away from our lives, hopefully from next month onwards. So thank you to the organizers for having me here. And while the presentation is just coming up, I will start off by saying that technology in tax is now extremely deeply embedded. And I think the way I would say it is that we have to, as CA practicing, as practicing CAs, as professionals in the industry, as professionals in service, need to realize that this is an element which is embedded not just now in compliance, but in everything we do. Unless we understand this animal, I think advisory is incomplete, litigation is incomplete, and of course, compliance is incomplete. In fact, even most of the advocacy effort that is happening from the industry side, you look at the institute's submission, you look at STPM submission, chamber submission, all the submissions are now almost 30–40% talking about how GSTN should change, how certain processes should evolve, how notices need to be delivered. This you would not have seen about the ACES portal. We've never written how ACES portal should change, or we've never made long representations on J1, J2 matching in the past, right? So there is a shift, and I think it is an opportunity for all of us to understand the shift and appreciate the shift. I would also say that if you look at how the last 4 years of GST have evolved, the more successful practices or organizations or people in this space are people who are tax professionals. So it's not that software companies have run away with the opportunity. You can imagine the kind of software depth we have in our country. We could have, software companies could have easily run with this, and CA firms would have only been left with either advisory or controversy. That hasn't happened. And that has not happened because there is no opportunity for software companies. That has not happened because, in my view, it is the tax professional knowledge that is the foundation or the base for doing anything in tax technology. So therefore, the title that it is the machine age of tax, and we as professionals have to lead in that machine age of tax. Our roles may be, as sir rightly said, different at different points in time. Some of us may be far more embedded than the others, but you cannot take away the fact that you need to understand it. You cannot take away the fact that it creates huge amount of opportunities and huge amount of challenges. Unless you understand the nuts and bolts of it, you can neither deal with opportunities nor challenges. So before we begin, I think a few interesting quotes that I really like, and it's for us to read. But I think the one that I like the most on this slide is what Steve Jobs is saying, is that let's invent tomorrow instead of worrying about what happened yesterday. And that's where you are today. Look at the benchmark setters in this space. Who's the benchmark setter in this space? Yeah, benchmark setter in this space is the government itself. The government is raising the bar day after day, month after month, year after year in how technology is transforming tax administration. And here we are in this chase of coping up and realizing, okay, let's keep pace with what the government is doing. Let us understand the magnitude of this change. Let us deal with the challenges that the change is coming to. So it is the government who's thinking of tomorrow. I will, during the course of my talk, share some of the very interesting things that are coming up in the next 6 to 12 months. And we will realize that if this is big, what is coming is much, much bigger. And these are all announced projects. The government has been talking about some of these things for years together. It is for us to realize that once these changes are implemented, once this shift happens, will we continue to provide quality services to our clients, whether it's again compliance or advisory or controversy management? So now if you zoom out and see how, how is it that globally governments are dealing with technology and tax as a combination, and how large companies which are multi-country setups are dealing with compliance and tax and technology. There is this shift that has happened over the last 5 to 7 years of looking at everything as a disjointed flow of transactions involving manual effort and paper to a digital flow of transactions which is seamless. This is not just the India story. This digital tax administration shift is a shift that is being made everywhere. This is the slide which will tell you the story. So if you see, there are 5 levels. This is an EY study. There are 5 levels of rating countries. If you see right now, in India is at level 3, which is e-match. So you have e-file, e-accounting, e-match, e-audit, and e-assess. If you see some of the level 5 countries, you have Russia in level 4, you have Spain in level 5. But do you see any other level 4, level 5? You hardly see. Mexico, yes, level 4. What is the difference? And this gives you a trajectory and a trend of what is coming next. And we will talk about that. But if you notice carefully, other than the 3-4 countries that I mentioned, which is Mexico, Russia, and Spain, there are no large economies. Brazil, to an extent, Brazil is also partial. There are no large economies in the world who are using digital tax administration yet. Okay. If you overlay this map with a map 3 years from today, because most of the governments announce their tax policy changes and tax administration changes 2-3 years in advance, especially when it is technology, you will see almost all of Europe in purple. You will see the entire Southeast Asia in purple. You will see Australia in purple. You will see Japan in purple. You will see Canada in purple. So except for the US, pretty much most countries in the next 3 to 5 years are moving towards level 4 or level 5. Okay. What is, we understand e-match, so it's much easier for us to understand level 3. What is level 4? Level 4 is e-audit. E-audit is, to an extent, something that income tax has started experimenting with, but it's not just faceless assessment. E-audit is, I have all your data. I'm going to only come to you when I have some questions, and I will send those notices to you digitally. You respond digitally. If you see, GST is actually moving in that direction far more than income tax, except for the fact that our notices are not coming on the GST portal. So, but it's a matter of time. So India is moving to level 4 very quickly. What is level 5? Okay. So there is a very interesting change that Spain has brought in. Spain has said that no taxpayers should file any tax returns. Okay, we don't want any tax returns. We want you to connect your ERPs with the government ERP, with GSTN. We will pull whatever data we want. Now you see the transformation. Would we have thought of this 3 years ago, that there will be, government connecting their ERPs with our ERPs and saying, okay, don't file any tax returns. But this has happened in one country. I will not be surprised over the next 5-7 years, this will happen in many other countries. The experiment is starting off. We'll see what happens. So this map gives you 2 very interesting data points. First, that India is one of the early starters in the game of digital tax administration, right? Second, that there is still way to go for us, and this will keep evolving far more rapidly than what we know as of now. So what is our India story? We began the whole journey with GSTN. So GSTN was in many ways the first use case. Yes, we've done 26AS in the past. We have done e-filing of income tax returns in the past, but we never got to transaction level reporting and integration of two sides of the coin, which is the supplier and the buyer in one flow. So this is the first time that GST brought in this concept where the GSTR 2 and 2A were supposed to bring in a transaction level flow and matching activity, which then of course was suspended in July 2017 for various reasons. But what did GST achieve with all these launches and changes that were made? They wanted to digitize tax compliance. Digitization of tax compliance does not mean the ST3 return that we were filing at the end of every 6 months, or the VAT returns that we were filing, or excise returns we were filing, because those were uploads in digital format. Even your income tax return is an upload in digital format. It is not a digitized tax return. A digitized tax return is where you give your transactions and the return utility of the government is able to then determine what your income is. If you look at AIS, TIS that is now available in income tax, did anybody think of AIS, TIS in the past, right? Another example of where the government has moved the watermark way higher than what we are ready for, right? Of course, there will be a lot of teething issues with AIS, TIS. There will be wrong notices sent. There will be some trouble that assessees will go through. But if you look at the concept, it is really what big data play is. I have all your information. I can triangulate any information from anywhere. I will present all of that information to you. You are answerable. If you're above board, you have nothing to worry. If you're not above board, then while I may take time to get perfect in my technology and my data discovery, but I will flag you quite easily, right? So tracking the entire value chain is what has happened. Simplification, some may agree or some may disagree. But yes, if you now look at your processes around GSTR1, it is quite stratified and simple. GSTR3B, I don't think we have too many issues or even few issues in filing our GSTR1 and GSTR3B. Yes, we had our journey of getting it right, and we had our teething issues, we had issues with GSTN, but all those issues are pretty much a thing of past. Analytics. Now, AIS, TIS is an example that I gave. Have you started seeing some very interesting results of analytics that are coming through? Let's hold this and we will see one or two use cases in the next couple of slides to see how government is using GST data and challenging us to demonstrate whether we are on the right track. The GSTN was the first special purpose vehicle created, which was not done in the past. Earlier, the government tried to do everything on their own. This time they changed the strategy and that has worked. It is a build, operate, transfer, as you know. But they also created this GSP ecosystem, okay, which is again very, very unique. The GSP ecosystem, as we all understand it, is not there in income tax. You will be happy to note that countries which are now rolling out e-invoicing, countries which have gone after India have launched or announced go live dates after India. For example, Hungary, Italy, then Poland, France. All these countries are also following a GSP model because they have seen the benefit of having lesser connect points in the government platform, which enables more speedier communication, because then these GSPs can commercially build infrastructure and the government does not have to spend all the money themselves. The charge per transaction from a GST standpoint may not be significant. So taxpayers also afford it and the government does not have to charge the taxpayers, right? So they've found a very, very sweet spot in this GSP architecture. This will only grow in the days to come. Let's look at data, and this, data always speaks for itself. If you look at, this is the 4-year report that comes in, and there is always this, this question or this thought that GST compliance, is for large companies or for a few software companies who have created opportunity in that space, who have invested in building technology, and it may not be for everybody, right? You look at your data, 80% of the taxpayers are proprietary concerns. Okay. 10% are partnership firms. So about 91% of taxpayers are not corporations. These are collectively paying 20% of GST. So this is not a small contribution, right? So 20% of GST is still coming from small setups, which means that even if you are a single person practice or a proprietorship concern or a few partners organization, there are several people who need help in GST technology and who need to deal with what is going to come in the future, which is a market. 6% are private limited companies. So these three categories are 97%. They pay 48 to 49% of the tax. So if I include partnership firms, then they are almost 50% of the tax comes from these three types of setups. Data to probably see that are we working with the presumption that, oh, this is not my market. This is the reason for presenting this slide. The India story is known to all. I don't want to get into the more granular details of this, except for the fact that it has evolved and all the recent evolution has been on the input side after the e-invoice transformation that happened in October 2020. The e-invoice thresholds will keep falling as the government has promised. It is currently 50 crores, but I'm sure it will go down to 5 crores as the government wants to do very soon. The changes that have happened from January last year, or which will happen now after this budget, January this year, and if all the budget changes that get passed and get notified maybe in the next 8 to 12 months, those changes are all focused on the input, and you will see that some of the heavy lifting on tax technology now comes on the input side. We'll cover that a little bit. But e-invoicing. Now we understand e-invoicing, and again, many of my conversations with chartered accountant colleagues, the sense seems to be that e-invoicing is more a software solution, or it is something that we really are unconnected to because we are in the business of, at best, preparing tax returns. But you need to understand that today, the e-invoice data is integrated with your e-way bill data, and e-way bill data is integrated with, and e-invoice and e-way bill data is integrated with your GST returns. So if you are already filing GST returns, you know that now the government is posting all the e-invoice data in your returns. So unless you are dealing with your client and with the taxpayer at the e-invoice stage itself, you are not in the chain at all. The chain of transaction starts much earlier than what you think. It is no longer a tax compliance at the end of the month game. It is tax compliance at the time of the transaction. Now let us look at what changes have happened on the input side. I just referred to them in Jan 2022. The changes in 16(2) AA as well as 36(4) are suggesting that you need to match and then take credit. While one can debate whether it's a precondition, post-condition, and we can have many sessions on that. But if you look at it as a practical implementation, you need to match and then take credit. What has happened? From a process standpoint, this has also become real time. You received goods as a GRN. Now, can I take the credit immediately? No, I can't, because 36(4) says that has the transaction reported in the to be return or not, right? So you need to match and then take the credit. So e-invoice made your revenue side real time at a transaction level. The changes in the budget have made your expense side also real time, because you are not allowed to take credits unless you match. And if therefore you now relook at what the digital tax administration shift has already happened, it has moved away from an Excel file that comes to me at the end of the month to file GSTR1 or to calculate input recovery and file GSTR3B. It will result in a situation where when the e-invoice limit falls to 5 crores, you are going to cover such a massive amount of taxpayers in the population. All those people will have to choose how will they do their e-invoicing. The minute they choose that path, their GSTR1 is already done. And then it's a question of GSTR, your 3Bs, where you have to take your input tax credit. Again, if somebody wants to make the real-time matching go live, then he would choose some solution in the AP process, where at the time of accounts payable itself, he's doing the matching, and your GSTR 3B input side is also populated. So how does one fit in this new world where the GSTR 1 is getting done real time, GSTR 3B is getting done real time? What is the space? Is the space now review of returns and preparation of returns has gone out of the window? Or is the space that, yes, if there is a shift that is announced that this will become 5 crores and it will become much lower as we go along the e-invoicing threshold, then I need to shore up and catch the transaction as early as possible, because then it's otherwise going to affect the compliance practice that I have, whichever solution that I use. Unless I know how this transaction is moving, unless I have the technology solution offered to my client at the transaction stage itself, I will not be able to integrate into his compliance. And if I'm not integrating into his compliance, then many of the other logical flows that arise out of compliance, mismatch notices, any fines and penalty notices, any audits that will happen, any investigations that will happen, all of those will go to people who have process control over the transaction, because most of the disputes today are related to, sir, you reported this is not matching with this is not reconciling with this, we have tried to match with this, we have looked at 26 AS data, GSTR 1 does not match with 26 AS data. So if you've not owned the transaction at the very beginning, then what you're going to own in that relationship is whether the classification of this product is 5% or 12%, right? Yes, there will be those disputes and there will be those advisory and controversy practices. But as sir said, if you are in that niche game, then there's no need to worry about all this digital tax administration and compliance. But if you are not in that niche game, you are not a counsel, then you need to understand how are you going to adapt. The sooner you adapt, the more opportunity you'll be able to harness. Look at this data. Today, about 75,000 taxpayers do e-invoicing. If the threshold falls to 5 crores, 6 lakh taxpayers will be required to do e-invoicing. So it's a 8 times increase in the population. 8 times more clients are going to need these services. This is going to happen anytime. They had announced that it will happen much earlier. In fact, last year itself, it's getting deferred. Let us assume it will be July 1, 2022. I'm just putting a date. I don't know. They've not announced a new date. But even if it is July 1, which is likely because I don't think they will give you some 2 years to prepare, then it's a question of 3-4 months within which you need to understand this. You need to have a market. You need to have figured out which clients will need the service, which solution is going to work, etc., etc. On the input side, the change has already happened from Jan 22. So if you have not already figured it for your client, while your client may take time to understand what the change is, he will eventually understand. He's a businessman. Once he understands it, he has to make that choice of whether the existing services which are Excel based are okay at the end of the month, or I need to figure out something more real time. So let's all collectively understand the opportunity and make the most of it. We all know the flow of how the transaction is moving, but I just want to make a couple of very interesting points here. So this is a pictorial representation of how e-invoicing is happening today. You're sending some data, you're receiving some response, you're receiving a QR code, as you might have seen on the invoices. You are now getting a QR code for companies who need to follow e-invoicing process. So you're getting a QR code, which is getting printed. You're getting a 64-digit invoice reference number. Now that data on the right-hand side, if you see, is going into e-invoice, e-way bill, and GST returns. So that single entry is going into multiple places. Now you see these red lines, 6 and 7. What is this? Okay, it's interesting again for all of us to know. So what the government is planning, and this was planned in October 2020 itself, but it's got deferred. What the government is planning is that all the data that you generate at the time of generating e-invoice, if any one of us have understood or experienced that process, the e-invoice template is a 105 field template, optional and mandatory. Out of 105, about 40 are mandatory fields. So if you look at GSTR1, there are only 14 mandatory fields. So from 14 reportable values of a transaction, you are moving to 40 reportable values of a transaction, which are mandatory. And it could be 100 plus. Now, all these values that are getting reported today are going to be put on a portal and will be made available to the buyer on a real-time basis. So if I have supplied services to somebody in Delhi and I have generated an e-invoice, then the e-invoice transaction first gets shipped to my GSTR1 after 2 days. This is the NIC process today. So by, let's say, Tuesday, it goes into my GSTR1. If it goes into my GSTR1, it populates the GSTR2B of my Delhi customer on Wednesday, let's say, right? So he gets to know on Wednesday. What will he get to know? The 14 mandatory fields of GSTR1. What is going to happen very soon? They are launching a platform called BNRS. It's available on GSTN website. You must go and read. BNRS is going to be a data exchange platform where all the 40 or 100 fields of the invoice that you reported on a real-time basis will be available to the other side. So what is the joy? I mean, instead of coming to know on Wednesday, I come to know on Saturday. What is the big deal about it? Here is the big deal. The big deal is that now your clients can do your AP accounting entirely based on this data. Today, what is the AP process? I have received an invoice. I have to scan that invoice. I have to populate. There are fat finger errors. 0 ka O ho gaya, 1 ka I ho gaya. All of that is happening today, right? You are employing a plethora of people to do that accounting. Professional firms are doing that accounting service of preparing purchase registers, right? If this data is available directly through your connection with GSTN on a real-time basis, then it's a matter of being able to download it and upload it in your Tally, upload it in your any accounting software that you're using. All these accounting software will upgrade themselves to receive this input. Once you do that, the whole AP process is very, very different from yesterday. So if we are running an AP solution, that is going to change dramatically. Leave aside the change that has already happened of real-time matching from Jan 22. So again, I'm giving you these anecdotes to drive the point that the way traditional services have run will have to change to adapt to what is changing dynamically in our flows. So I spoke about some of the use cases on analytics, and I want to talk about some examples here. We have seen auto population of returns. We have also seen integration with income tax. I gave you the 26AS example. There is now integration with India Stack. Okay. The Aadhaar Trinity, as we call it. What has happened now, as you saw in the budget, is that Aadhaar authentication has become mandatory. Aadhaar is our base of the India Stack, as it is called. So every transaction of every taxpayer is now integrated with the India Stack. What does it mean? What does it mean when my Aadhaar is integrated with my GST registration? It is just like your AIS, TIS in income tax. You now have a common number through which all your transactions can be traced and integrated and measured, right? On the input side, we talked about enhanced data sharing, which is the BNRS, recovery on unmatched transactions. I'm sure we are all experiencing that. If the mismatches are significant, there is recovery straight away from the buyer. If there is a perception that the underlying invoice is a fake invoice, there is a recovery directly from the buyer. And all this action is happening today. This action is partly also due to insufficient use of technology. Because if I would have done the matching much earlier, if I would have figured out the filing status of my vendor much earlier, I could have done a different result. As you know, today for every single taxpayer, there is a data point available from July 2017 onwards, whether he's filed GSTR 1, 3B, on what date did he file. That information is available. You just have to access it. Public data. It's not necessary he's your client or it is your GST, and it's available to everybody. So if I had a process where I had monitored his return filing status, I would have probably known that there is a problem, right? If I had processes to understand that the fact that he has paid the tax or not influences my ability to take credit, I would have focused on those vendors and made confirmations ready for myself to not face the risk of this fake invoice investigation. So at one level, fighting the legal battle on whether it's a fake invoice and whether I'm obligated and whether the powers of Section 16 and the powers of recovery under 73, 74 will cover such cases or not, those are matters that courts will decide X number of years from today. But what do you do today? And are all of us counsels who are going to fight in court, or all of us are client service professionals who will figure out how to help the client resolve the problem? And this is not a one-time problem. This will keep recurring with all our clients. So unless you have a systemic resolution to this, you can douse one fire of an investigation at once, but you have 30 states who can investigate you, and they can investigate you for all transactions, right? They have all the data. If you look at some of the more interesting analytics that have happened, which is the last block, is network visualization. How has the government started this whole fake invoicing investigation? We should ask ourselves, right? Is it that fake invoicing was not happening in the past and suddenly GST has given impetus to it? Or is it that it was happening in the past, but probably this is the first time the government is aggressively ahead of the curve? It's all because of analyzing big data. They're able to find trails of transactions through which they suspect that there is a fake invoicing circle here, and they go and attack that circle. They succeed sometimes, don't succeed sometimes, but they're getting all of this intelligence. So you look at the data on the slide, 15 lakh crore of tax is being lost in European Union for carousel fraud. So what is a carousel fraud? A sells to B, B to D, D to E, and E exports. Okay. These transactions are all fake transactions. The export is also an empty container, but everybody claims incentives because they have sold for export. So not only are you claiming zero rating and refund of all the GST that was paid on the previous layers, you're also claiming export incentives. This is happening in the EU. Again, right, carousel fraud, EU carousel fraud in Google, you will know. After 50 years of implementing VAT, also they are struggling with this. In 3 years of implementing VAT, we've figured out that big data is the only solution. In fact, now European countries are moving to saying, yes, we should also go to big data. We should take transaction level information, because that is the only way to administer taxes. The MBMA scheme is another interesting one. You must again go to GSTN website. What is MBMA? It is Mera Bill, Mera Adhikar. Okay. Now, what is this? And the government is toying with new ideas. As I said, they are really ahead of the curve. One of the things that they are thinking of is that maybe, and this is my conjecture because the write-up doesn't cover this, that they are thinking that we are able to cover most of the large and medium organizations. But the last mile is very difficult to cover. There are thousands and thousands of last mile B2C shops, and we cannot go and audit everybody. We cannot go and investigate everybody, right? It is impossible. That kind of machinery does not exist. So this MBMA may be an idea to solve that problem, where if I am a customer who is on a B2C outlet buying a product, if I insist that my bill should be registered with the government portal on NIC or any other IRP, only give me a registered invoice. Give me an invoice that you have reported to the government. Report it right now. I will give you some additional information, which is my name, address, so that you can determine the place of supply, and give me that bill. Yes, it will take 10 more minutes, okay, for the billing to happen. But when that happens, it is proposed that like an e-invoice number, a reference number will be issued to this B2C invoice. Right now, e-invoice works only in B2B environment. For this B2C invoice, a reference number will be issued. This reference number will become the lottery ticket number of the consumer. And at the end of the month, lottery ticket prices will be announced. If you think about it now, a lot of customers may, for some of their important purchases, insist on this bill because there is a chance of winning a lottery. By doing this, there is a downward pressure of reporting all transactions. And there is hopefully some sort of self-policing that is going to happen in the B2C chain. Now, you may be dealing with a trader who's doing only B2C today, right? He may be having a 2-gala shop right now. But if this comes in, how are you going to handle it? How do you advise him? Is he going to be ready? What technology is he going to use? How is it going to be cross-referenced with all the digital transaction payment problems that he's dealing with right now? And therefore, how is it going to add up to his GSTR1 reporting, GSTR3B reporting, income tax reporting? So knowing what the government is doing and thinking is very, very important. Now, how do taxpayers respond to all these challenges? Most taxpayers are responding in this manner. We talked about this already. Most of us are thinking of firefighting. Okay, there is a problem, let's douse it. Let's a fire, let's douse it. There is a one-to-one resolution mechanism. This notice, let's deal with, etc., etc. But we are not, many organizations are failing in creating a vision, a broad plan. What will I do in next 3 years? What if instead of one notice, I've got 20 notices? Am I going to be able to handle it? I can work 2 nights on Excel and give the answer, but can I keep doing it all the time? Because these notices are not going to stop. The questions are not going to stop. So this is how most people are responding today. And that is the underlying problem is, one is poor data management, that we are not thinking through how all the data has to be integrated, all the data has to be kept together and reconciled on a regular basis. We are not pushing ourselves in that direction. So there is poor data management, and there is 2 other issues. One is people and second is process. The people issue is that there is excessive dependence on a few people. There is no institutional memory, there is individual memory. If that person quits, then you have a massive problem of remembering which Excel file was the last version of the backup of the return, right? And we are still at that stage where the tax office is saying, Mera bill, mera adhikar. We are saying, which is that Excel version, which is the backup of GSTR1, right? So how do you solve the people problem? Your people need not spend hours on Excel to do the job. They should be spending that time, if you have the right technology, they should be spending the time in managing and making sure that the tax office understands what you have done and your risk is addressed, right? Because they are the best people to handle and explain your transactions. They are not the best people always to just work nights on Excel file to douse the fire. Similarly, people senior in the tax role are spending less time on tax planning. They're spending very little time on what should be the controversy management, what positions do we need to take, how do we deal with this matter in the court. They're spending more time in responding to transactional matters. So people is one quadrant and process is another quadrant. There is a very different wave now, as I see after GST, of people realizing that tax processes are extremely detail oriented. They are no longer something that can be done at a summary level, something that be done at one point in time. They need to be done continually. Second, organizations are realizing that they do not have the ability to invest in technology. There are very few companies that I know, I would say actually there are no companies that I know who have built their own GSTR1 and own GSTR3B technology, right? or for that matter, 26 AS. Why have they not done it? Because companies have realized that this is this is a black hole where I will keep pouring money, but I will still not get results because the law is so dynamic. The entire IT infrastructure is so dynamic. I don't have the talent. I don't have the resources, and I cannot retain those resources also. I cannot challenge them enough that they will stay in my organization forever. So people have not invested in technology, but have they got the right technology? Have they thought about what is the technology that I should use? And how can all the technology be integrated? I may use one software for 26 AS, one for GSTR1, one for e-way bill, one for e-invoice, right? Is that the right strategy? And one for accounting. And everywhere there is an Excel file in between, right? Is that the correct thing to do? Or there is an answer where I should do one extraction from my accounting system. That very report can go into all my technologies and get the answer. It may be disparate technology. You don't necessarily have to choose one service provider, but whatever you choose, you have to integrate back with your transaction. As I call it, what is the ask today is from record to report to return reconciliation. We're seeing that when you file your annual return and your audit 9C, right? There is a record to report to return. Record is the transaction, report is the sales register, the return is what return you file at the end of the month or period or year. There is also a need, when we now start seeing audits, there is also a need from a to report to record reconciliation. I had this very interesting experience of an audit in Gujarat where the central tax officer, he's a chartered accountant, deputy commissioner. Grace of God, he was chartered accountant, so he was able to understand a lot of things that we were trying to say on reconciliation side. But he, unlike most other assessment experiences I had, he didn't want to focus on the usual stuff. He didn't want to focus on in Gujarat, okay, show me a Gujarat trial balance and show me a reconciliation of the Gujarat records with the Gujarat GSTR 9C. He said, I understand all of this is not possible. You are a Bombay-based company. How will you have a Gujarat trial balance and how will you reconcile? You will make something up to satisfy me. Let's do it this way. Show me how you prepared your national reconciliation. Okay, let's sit with your trial balance. I will tick GL by GL and you show me in table 5 of GSTR 9C which entry went where. Okay, you take 2 weeks to prepare for that meeting, but let's sit. He himself sat with us for 2 full days and he ticked out the entire trial balance into the 9C. Okay, what he was trying to do is the same thing. He was doing the return to report to record reconciliation. He said, once you satisfy me at a national level, I'm okay. I will presume that you would not have any objective of giving more tax to Maharashtra and less tax to Gujarat, right? In that process, obviously, he asked us questions on tax positions and so on and so forth. But that's the thing, that are we ready for such representation? Or are we going to say that, no, it is in some Excel file and we will merge 3 Excel files and hopefully we'll find some answer. And yes, there will be some unreconciled amounts and we'll figure out what to do to deal with that query, right? So you have process limitations, system limitation, people limitations, and others, which is leading into and going to increase your errors, compliance delays, your change delays. Any new thing that comes up, you will be taking that much longer to react. Weaker controls, leakages, and more tax controversy, obviously. So what are the new approaches? The new approach is, let's reuse intellectual property. We don't have to invent the wheel classically. There is enough intellectual property available. Let's reuse. In this block, I would say that the office that has the most resounding opportunity in this is the Chartered Accountant's Office, because he can invest in figuring out technology once and then reuse that technology for all his clients. Or a group of chartered accountants come together and invest in making out all the technologies that are needed to align one technology with the other and bring in this end-to-end reconciliation. So you may not want to boil the ocean. You may not want to build a new GSTR1 platform yourself. You may be using service providers, but are you using enough technology to connect your client system with those solutions and with all the multiple solutions to be able to give him the value that he needs when this reverse reconciliation is going to be called for? Understanding technology and leveraging technology is very important for this. Do you really understand what tools are available and what they can do? There is a lot of fear that technology is not for us. We're not trained in building code. We don't know how RPA works. We don't know how Python works, and so on and so forth. It doesn't matter. Actually, these are very, very simple technologies. If you were to learn RPA or Python, free courses are available on YouTube, and I can assure you this, in 4 hours, you will learn these technologies, not more than 4 hours. Okay. A lot of freeware is available that you can download and start using. UiPath is another example of RPA technology or Python equivalent technology. In 4 hours, you can learn basics of it. If you go a little deeper, 8 to 12 hours, you will be able to start coding to say, okay, what is the problem in the client data? Take a very simple example. Today, what is happening? Your client data format, date format is MMDDYYYY. Okay. And your software requires DDMMYYYY. What are you doing? You are going in Excel, you're selecting that column, some intern is changing the date format and sending, right? So you again introduce an Excel file in between, and there is no traceability of record between the original system and the endpoint. And this is just a very simple example. You may have done so many such transformations every month. But if you had used any of these technologies I mentioned, it will happen automatically. You don't have to do anything. You don't have to train people. You don't have to hope that your people have done it right. Yeah. And reuse of data. Can I reuse the GSTR 2A reconciliation data for TDS also? It is the same AP register. Non-salary transactions are all the same. Now everything in the P&L after 194.0 is liable to TDS, right? So can I not do one single extraction of AP and use that data for all the activities? Or even better, once the BNRS platform comes up, can I not use the data that is coming from the vendor side itself and automate my processes for eligible, ineligible, TDS, no TDS, and all the answers that need to be done, and let it populate the relevant returns? What I need to do is to problem solve using technology. I don't need to employ an army of people to do this, because that's not going to last too long with the speed at which change is coming. So what therefore technology introduction does to us? Currently, most of the teams are spending huge amount of time at the bottom of the pyramid, which is transaction processing, then controls and verification, and then a little bit of analytics. If you get your technology right, then you will be able to reverse the triangle. You will be able to spend more time on analytics and lesser time on transaction processing. So what are the 3 pillars for any of these things? Tax transformation journey. You have to focus on efficiency, risk and governance, and value optimization. Efficiency means that can I eliminate manual work? Can I make it simpler, more connected, more integrated? Risk and governance would be, what validations do I need to do? Can I check certain transactions? Do I know certain types of errors can happen? And can I pre-warn the system and make these validations as a part of my data transformation process itself, so that there is no risk later? So for example, there are taxpayers who reconcile their GL balances, liability balances of GST before they make a payment. This is all done through automation. Today, we look at it only at the end of the year, only when a query is raised, only when an audit happens. Why can't we do it more regularly? And value optimization. If I can match the transaction real time, and I can tell the client that, yes, the reporting has happened, I found it in GSTR 2A, now you can pay him. then I have eliminated the risk of a future denial because of mismatch. And I have also eliminated the whole pain of July to September, where you're calling vendors after vendors to say, sir, please correct, because you've reported in some wrong GST ID, or you've reported some wrong amount, or you've not reported the transaction. So I am optimizing value. I'm giving more value to the client. I'm able to get him a cash flow advantage as well as a P&L advantage. And then can I now integrate it with direct tax as well? Because most of the data is going there as well. So can I use this data for advanced tax? Can I use this data for TDS? Can I use this data for any 26AS reconciliation? So the more I integrate the processes around tax, the better value I will give to the client, the more fees I can make. Yeah. So net, what I think is the role of a chartered accountant here as an opportunity is, first is transformation of the tax function. We are seeing, as I was telling you, companies are realizing that tax technology by itself and the processes around compliance are quite onerous, and they don't want to do it themselves. They're not capable of doing it themselves. We are seeing an increased interest in complete outsourcing of tax. So we've all seen accounting outsource. All the bills come to us. You please do the accounting. Please send us the accounts. That is getting extended to tax as well. Not just do tax compliance, but we will not need a tax person when you are there. You will run everything in tax. You will be my tax manager. You will be my tax head. You will do everything around tax, whether I'm a small organization or a medium organization. I will basically treat you as a part of my organization and outsource not just compliance, but accounts payable, accounts matching, income tax matching, reconciliation, reporting, and so on and so forth. So that is the opportunity, tax transformation. Point-based solutions, identifying where technology can make sweet interventions and get you the efficiency and the value proposition that you want to give to your clients. So what are the point-based solutions, you know? And managed tax services will mean that you are basically telling your client, you don't need to have absolutely any technology or licenses. I will worry about technology and licenses. I will basically set up a managed tax function to deal with all your problems. So tax problem, including the technology problem, is mine. So that's how we are seeing more and more CA firms react. There are interestingly new CA firms that have come up, which are only focusing on tax technology compliance, something that I have not seen before, and they are doing exceedingly well. Some of my ex-colleagues are a part of it, so I know it so closely. And the last slide, I would say, or actually the last but one slide, the technologies you can leverage on. The client ERP itself, Tally, SAP, or any of the ERPs that your client may have, Oracle, Microsoft Dynamics, Microsoft Navision, or any of the technologies you have today are capable of doing a lot more in tax than they were in the past. Are you aware of it? And can you bring in experts to help the client and make your life easier, his life easier? Robotics, process automation I spoke about, UiPath, IQ bots. Now this is again very interesting. IQ bots are intelligent bots, which are learning as they go. So if you have an invoice from a hotel, let's say I stayed in 5 hotels in 5 days. We all know that all the 5 invoices will look different. Okay. But once the bot understands that he has to look at the HSN and know this is a hotel invoice, he will know what to look for in that hotel invoice. He will know that, okay, there can be an F&B on which I don't have to take credit. Okay. The bot can be trained to that extent. So IQ bots are being used where there is large volume of transaction, where you can actually transform a part of your intelligence to that bot, and the bot is able to do 80–90% of the workload. All you're doing is exception management or verification. Python, Flash of the self solutions, are the ones we spoke about. These are some of the tools available on GST and website as well. There are a few companies who are servicing businesses which are less than 1.5 crores. They have accounting systems which are integrated with GSTN, and they're able to share data and make it easier. There are 8 companies. This is again directly from the GSTN website. I have not added or verified any of this, but point is this is all available. There are utilities available. There are accounting software available which are integrated. Are we using it to the maximum? And okay, I think I've missed one slide here, but the last slide I would always have is a slide which tries to look into the future. And to my mind, the future is that either I am an Android or an iOS platform. Okay, I compare tax services in the future to providing a platform. We are all thinking and building a platform now. If I can build a platform, which is if I can build iOS, then every new service is an app on the iOS. You want to wake up in the morning, there is a calendar app. You want to go to a meeting, calendar app doesn't do it. You have to go to the meetings app and register a meeting. You want to send a mail? No, then there is a different app to send an email. None of us find that very difficult, right? We're okay with that. We may have at least 40 apps on our phone. We don't struggle with it. What is the success mantra? The success mantra is that the platform is the same. The most money is being made by Apple in the transaction, right? So if I can scale up tax technology to a platform to say, yes, I have established a platform. I know what is the base technology that works for clients seamlessly everywhere. Everything else is an app. Oh, you want e-invoicing? Okay, this is a button to tap. You want e-way bill? This is a button to tap. Yes, everything is integrated. Everything is on the same platform. And so if I am the smart phone, so to speak, or the smart tax professional, so to speak, then I become a taxologist, as I would like to call it, where tax comes before technology, but tax will always stay before technology. So the opportunity is really for tax professionals. And I mean, it's an amazing time to come. So best wishes to all of us in being able to adapt to it. Thank you very much. Yes, yes. I have it in the chat. I will just go through. Can I go through the questions? It's there in the chat. Yeah, yeah. Okay, one second. These are some old questions as well. I will go from the bottom because there are some of the previous session. Can ITC be blocked in case of my raw material or FG for making catalog book for distribution to customers, dealers for generation of orders? Yes, yes, I am going through as sorry. Additional place of business. Okay, I'm sorry. Some of these are technical questions. I will skip. I'm sure there are equally good speakers. Okay, there are questions on revising return. This is a clear problem. Revising of return, ability or inability to put negative entries in 3B still remains. So there is no answer to that as of now. Okay, I think other questions are all on valuation and income tax, sir. So there are no new questions for tax technology. Yes, please. What is the future of the blockchain and using tax technology? Anything you find? So it's a very big question, sir, and I can assure you I also don't understand it. But I think if you look at blockchain, or you try to understand, let's say even if you look at crypto, we look at NFTs, I think those are much easier to understand. Everything is ultimately, the concept is it's a distributed ledger available at multiple points. for visibility to everybody. It's more transparent. There is no government regulation, etc., etc., etc. But when you come to first tax and then tax technology, when you come to tax, I think the big question that needs to be answered is that where is the taxable event? Is this goods or services? So for example, crypto. Now, when TDS came in, there was this whole furor to say, okay, government is recognizing this piece, and therefore cryptos are no longer liable to GST, because earlier, otherwise the fear was crypto will be regarded as goods. Now, yesterday there has been a statement to say that no, crypto transactions may also be liable at gross level. So somewhere, I think many of these things are still getting figured out. But fundamentally, blockchain is telling us that if you integrate multiple data sources, right, you will get a single source of truth for every question you have. In the same manner, if I am able to integrate all my data points in the organization, whether it is, and I'm going beyond tax now, whether it is RPT filing under company law, whether it is any regulatory filing that I'm doing under SEZ, STP regulations, whether there is any ROC filing that I'm doing, or any other SEBI filing that I'm doing, if I can integrate all of this in a manner that there is a well of water, and I need to fetch the right amount of water for the right reporting, right? But the well is common, the data lake is common, and it does not exhaust the water. It only makes a copy. All therefore you are doing is that by creating one single platform, you are never worried about reporting something that does not reconcile with the other. There is transparency amongst all your reportings, so that you are pulled up later to say, oh, you made this filing with the customs authorities in SVB, but that does not tally with the RPT reportings that you've done under company law. That will never happen. Or that this particular transaction you have not treated as a transaction in transfer pricing, but you've paid reverse charge in GST. You know the reasons for the same. Today, the entire exercise is based on a post-mortem douse the fire approach, which will change if we learn from blockchain to say it is necessary to have one single source of truth, and then it's only a matter of just extracting a report from that truth.
So major problem is, that e-invoice portal does not allow the amendment to the e-invoice.
Correct.
So today is a major block, because then what will happen? What happens? Even in one of the seminar and one of the meeting also, the Tarun Singhal,
Yes.
Revenue Secretary said that when the e-invoice data cannot be transmitted to the R1,
Yes.
then you do it manually.
Yes.
Now that is a distortion in
Yes.
the total data process.
Yes.
Now, till the government allows the amendment to the invoices, I'm not talking of credit note and debit.
Right.
Amendment to the basic document. The problem of reconciliation matching will be there.
You're right, sir. But if you look at it from the government standpoint, they have allowed, as you said, the facility of debit note, credit note, right?
It only when it varies the value, but we are talking the particulars in the invoice.
No, I understand that. I understand what you're saying. So if I've got the wrong GST number, what do I do?
Yes.
Correct. So I understand what you're saying. But if you look at it from the way government is looking at this, in government's viewpoint, you need to get it right before you report. Because once you report, I will treat this as truth. Like, for example, once they pass the law and they forget a comma, we go to Supreme Court to defeat them, right? So in the same manner, once you report the transaction, you have to live by it. These issues about wrong GST ID or wrong HSN or all of that have been discussed with them. And their response is very simple. Why don't you give a full credit note to that invoice or raise a new invoice? We have no problem. Yes, errors will happen. We're not saying we are in a perfect world where no errors will happen. What we want to prevent is that after you've raised the invoice, the client then says, yaar, idhar to mera credit zyada hai. Why don't you raise an invoice on the other GST number? Right? We don't want that to happen because that brings in distortion. So why don't you give me a full credit note? So I know that you're trying to change the record. Secondly, when you said, and you made a very valid point, that on GSTR1, you get an option whether to take the download of the invoice data or not. that option is going to go away very soon. They will say your e-invoice data is going to come in table 4 in GSTR1. That's it. Right? Once they make it mandatory, you will have no choice but to then issue a credit note and amend the invoice. And there will be a trail to say that you did this after 3 months. See, today in the GSTR1 amendments is all getting washed. It's very difficult to know when did you change what, because you're making so many amendments. But in the future, you won't be able to do it. So in their view, it is taxpayer discipline. For us, it is taxpayer difficulty, but they look at a different D.
Nobody has a question.
Thank you so much. Thank you, everyone.
Well, you all agree that Divyesh Bhai has dealt with the subject very efficiently. We all, when new technology comes, like everybody has got a phobia, like technology phobia. We think what will happen now, whether our practice will go. So that is a threat. But at the same time, there is an opportunity also that he explained. There is a concept like called survival of the fittest. So if you don't make yourself fit for the future, then the question can and trouble can arise. So like educating ourselves for the future, we have to make ourselves future ready. It's not now future, actually it is present only. What is going on present, this is not future. So to make ourselves ready with what is going on the current trend. And if we do that, then there is nothing to worry. And in fact, it will be an opportunity. With this, I will say, please give thank him with a loud applause for the excellent speech. Now I think 15 minutes break, and then we are going to a panel session. Thank you. Yes.
Jai Hind.
नहीं इसका लेकर 4 घंटे सर आपका लैपटॉप
अभी लेके दे ठीक है ना ठीक है तुमचं काम झालं ते कचरा
Good afternoon, friends. All of those in the auditorium and those witnessing this panel discussion, the last session of the Taxcon. A very, very interesting subject. Startups and digital ventures. Startups are something which are there with us for more than a decade or so. And I dare say that now those are becoming not only popular, but are being supported by the state as well as venture capitalists. As far as digital ventures are concerned, for a person who is, I call myself technologically challenged, something which is of great interest, and I'll be looking forward to this panel discussion. Since the expanse of the subject is extremely vast, I'll not take up too much of your time. I will only very, very briefly introduce the speakers because their biodatas are already in the paper book which has been circulated and which will be with all of you. Mr. Padamchand Khincha will deal with direct taxes. He is a person who walks tall in every sense of the term. And I've been a great admirer of Padam. And I was talking to him a few minutes ago, and his command over the subject is so great that I've seen him speaking for a couple of hours and even more without a paper in his hand. Such is the depth of his knowledge. Sunil Gabhawalla, our very own past president of the Bombay Chartered Accountants Society, a master at indirect taxation. Anybody who has a difficulty in GST, earlier VAT, turns to Sunil for guidance. He's a prolific writer and a speaker, as is Padam. And for the GST aspects of today's panel discussion, we have Sunil. We have then Mr. Robin Banerjee, who represents the industry. Currently, the MD at Caprians, he has led many a commercial venture in his entire career. He is also a very well-known speaker and an author of 3 widely read books. Before I hand over the charge of this session to the moderator, Jayant Gokhale. He is my partner for the last 4 decades. He has spent close to 12 years as members of the Central Council before he returned to the more mundane task of leading our audit practice and earning some income, which he had not done for 12 years. Before I hand over the proceedings to him, let me ask Ashwin to start off by giving a memento to the speaker. First, Ashwin will give it to Padamchand Khincha. May I request our President Abhay to hand over a memento to his predecessor, Sunil Gabhawalla. Ketan to felicitate Mr. Robin Banerjee. And last, my chairman of the Taxation Committee of the Bombay Chartered Accountants Society, Mr. Deepak Shah, to Mr. Jayant Gokhale. Over to you, Jayant.
Good afternoon, everybody. Few people attending here in person and last part of the audience who see us through the virtual connection. Good afternoon, and let me set the ball rolling straight away because as we mentioned, this is a subject, startups, on which everybody, right from the Prime Minister, Finance Minister, all the luminaries are talking about international global investors. Tata, Mukesh Ambani, everybody in the news on this subject. And really, this has been a phenomenon where India has not lagged behind the rest of the world in a big way. It is partially started off a bit late perhaps, but India is catching up very rapidly and therefore relevant to all of us and not just to technical or tax professionals, but possibly right across the country. So to set the ball rolling, the first question that comes to a past generation person like me is that people have been getting into entrepreneurship and business for decades. In the good old days when we were young, people used to invest their own money, start a small corner shop, start a business, small scale industry, which is extinct now, I think. What is it that really defines these sort of entities from what is today called a startup? Is it only the fact that earlier those people used to invest their own money or borrow their own funds, and nowadays people do gamble with other people's money in a big way? Is that what is the defining feature, or is there really something else that defines what is a startup? So I don't want to go into a technical definition, but since Mr. Robin Banerjee is very, very experienced in this area, I would like him to sort of give the broad contours of what really our people, tax professionals, understand when we speak of startups. Is it only what is defined in the Income Tax Act or in other legislation? Or is there a broader picture that we really want to get into? So, over to you, Robin. I think you can lay a broad canvas out for everybody.
Thank you. Good afternoon, ladies and gentlemen. This is a startup session. So we are starting a startup session, which basically means we were zero and now we will become one. From nothing to something. Unfortunately, when we talk about startups, we do not always mean from nothing to something. Let us see the pen which I had. There was no pen maybe 30 years back. And someone invented the pen and pen came into existence. The mic which I'm speaking on, there was no mic like this even 10 years back. Someone invented it came into existence. However, when we talk about startups, it's also there wasn't something, and now there wasn't anything, now there is something. So the concept of startup as now is being defined in the various parts of the globe, and there is no common definition around it. If you look at the definition, Google startups will still say a new business. But actually, that's now what, that is not what it's being even, is not how it is treated as. Startup, one, it is standing on something called innovation. It's something you have invented or innovated, perhaps it wasn't there earlier. Number one. Number two, it has some technology involvement. Very important, technology involvement. And this is where the definition differs between what is an SME, a small business, and what is a startup business. A small business normally will have human beings involved in it. For instance, let us say you start a pan and biri shop. There was nothing, there was no pan and biri shop. You start a pan and biri shop from zero to something. Is it a startup? No, because perhaps you're not using the technology. And there perhaps is no innovation. And number three, because there is innovation, there is technology. The third requirement is whatever you are doing, it is replicable. You can do it over and over and over again. And therefore, whichever startups, whatever you look at, what once was Amazon, and then in India, it became the local companies. Let's say when we go to any internet-based search engines, that's typically will be a startup. It was Uber in the old days in America. Over here, the Ola started doing something. Now, we as chartered accountants here have two roles to play. Either we would like to become startup entrepreneurs ourselves, or we are consulting a startup to ensure that they get the tax benefits, they get their funding, and so on and so forth. Therefore, necessarily, when you are suggesting or giving consultancy to the so-called entrepreneurs, the issue here is that please ensure it is replicable what they're trying to do. They are using technology and not only human beings. And there is a new innovation, there is an innovation which is involved in it. World across, more or less, this is the definition we are going by. If you look at what the government of India is trying to fund, finance, encourage, provide tax benefits, which obviously we are going to discuss throughout now the next 90 minutes, this is the three legs on which more or less this whole startup ecosystem will be standing on. Given this background, a quick word is that India as a country is doing extremely well. Normally in the industry and business situation, India is not top 3 or top 5. But the good news is, in terms of funding, India is the 3rd funding country in the world in terms of startups. So obviously a lot of money is flowing in, and therefore there are lots of opportunities for all of us sitting here to not only advise, but perhaps start one.
Thank you, Robin. And I think we have got a broad concept, but as happens in the most other things, the general concept and the tax concept of various items sometimes goes, sometimes the general concept and the tax concept are at variance with one another. We've got Padamchand Khincha here, who sort of clarified to us, because I understand there is a definition in income tax. I would really like him to clarify whether A, how is it defined in income tax, and whether really it is sufficient to meet whatever is the intent of giving some benefits, or does there appear to be a need for some tweaking in this regard? You could please clarify.
Thanks, Jayant, and thanks to the organizers for having given this opportunity to us to be this afternoon here.
startup, but at any time of this conference, and we are now downtime of this conference. When I came here and sat on the seat here, I was reminded of Earl Stanley Gardner, Perry Mason series. He makes a person who comes in as a client very comfortable for the reason that he has to be numbed in terms of his thinking capacity, so that then he'll be not sharp enough to the cross-examination type of question that Perry Mason is questioning him about, what he has done, how he has done, why he has done. I'm feeling somewhat similar now, that there is some sort of too much of a comfort now, so that you need not be necessarily fully alert to answer the questions concerned. And I was looking also at a very interesting statement that Anil Sate made when he was introducing the chairman, his partner concerned, and very apt for the startup session. The statement he said was that for 12 years, he did not earn any money. Possibly, startups are doing the same today. We're getting valuations better, so he may not have earned money, Jayant, but significant help valuation of the firm. That's the most important aspect. Coming to the interesting question of the aspect of definitions, we've got a broad overview from Robert Banerjee. And importantly, the technology is important. That's the most important attribute of the startup concern. And as he rightly mentioned, extremely important to go into the definitions they mentioned in the examples he gave. Could be transportation segment, need not necessarily be in the intellectual property segment only. So look at the definition of the Income Tax Act, for example, also into the DPIIT, the Department of Promotions of Industry and Internal Trade. What they're saying, therefore, is that you could be involved in a lot of activities. You could be involved in jewelry. You could be involved in money lending. You could be involved in real estate. These are the examples mentioned that you are involved in that. That means they're visualizing that a person can be a startup even in these segments concerned. Therefore, I could have a jewelry store. I could have a lot of online sales, online purchases, online booking, everything happening online. I could have a real estate company that leads you to a live experience of what a flat is going to look like. I could have, therefore, a smart building coming about. So anywhere technology is involved in a traditional business or a new business, it could definitely be a startup. The question is about when we understand startups, we need to be very careful about the statutory background within which you are functioning about. What do you mean by statutory background? The chairman mentioned about everybody being interested in the startup today, from the central government to the state government to the entrepreneurs concerned. The central government says I have various type of schemes available to you. DPIIT is one, fund of funds is one, the startup fund scheme is one. So they are therefore having their own definitions of an eligible person concerned. Going down to states, Maharashtra, for example, has its own startup scheme. Karnataka has its own startup scheme. Therefore, they may have different criteria for startup. Extremely important for us, therefore, to be mindful of these definitions concerned. As far as Income Tax Act is concerned, we largely look at DPIIT definition translating into additional conditions under 80 IAC. So looking at two broad segments concerned, the DPIIT regulations and the income tax regulation. That becomes interesting because Income Tax Act says your entry into tax benefit is conditional upon you satisfying the conditions of DPIIT circulars. Now, having said that, they're not incorporating DPIIT circular en masse into the Income Tax Act. They're trying to draw their own differences, and that becomes a very critical factor for us to be aware of. For example, under the DPIIT circular, they say a company, a LLP, and a firm can be registered as a startup. We will recognize you as a startup concern. Absolutely fine. Come to Income Tax Act, for example, under 80 IAC, it says only a company and an LLP will be eligible for the tax benefit. A partnership firm will not be eligible for a tax holiday under 80 IAC. Therefore, there is immediately a difference between a lack of reconciliation or lack of coordination between what DPIIT is telling you and what Income Tax Act is telling you. It's also important for us, therefore, to understand that what DPIIT says, some conditions of being qualifying as a startup there in a DPIIT. They say your unit shall not be formed out of reconstruction or splitting up. It stops there. Income Tax Act goes to add on another condition. Yes, you shall not be out of reconstruction and splitting up. Plus, you cannot have old machinery more than 20% into your entity concern. So it's extremely important for us, therefore, to understand that the DPIIT is the main starting point for entering into the tax concessions of startups concerned. But having come into the Income Tax Act, let us be mindful of the fact that there could be significant differences in the conditionalities in the requirement that you are required to satisfy for the purpose of qualifying for these conditions. Now, somebody may ask, and that's a very relevant question that Jayant is asking, should there be a tweaking? I don't want tweaking. I want some sort of a parity of treatment. When somebody is recognizing you as a startup, I don't think you should have some additional condition unless you have a very specific purpose beyond those conditions concerned. If you look into the Income Tax Act, and there are a lot of situations concerned, for example, what do you mean by turnover? What qualifies as turnover? Maybe a different issue. Who is an ESOP for a concessional treatment under ESOP? There is a difference between a current employer and a normal employer. These are unnecessary requirements. These are unnecessary variations to the requirements under the normal conditions of DPIIT, trying to make some differential solely for the purpose of differentiation without having a commercial rationale or a legal rationale. Therefore, it's a very relevant question that the chairman is asking us. That, in my opinion, the suggestion therefore should be, having satisfied the conditions of DPIIT, and that's the main body that looks into the conditionalities as also the continuation of registrations concerned. We should therefore incorporate those conditions unless we have anything specific and particular as far as tax laws are concerned. Otherwise, we as individuals, as professionals concerned, are looking into a lot of these niceties solely for the purpose of finding out I should satisfy the requirements of DPIIT circular as also income tax circular. And if I slip somewhere, the tax benefits may not be available.
Perfect. I think the income tax concept of that has been nicely brought out. But as often happens in most countries, possibly we feel the burden in India that it happens only in India, but it seems to happen everywhere around the world. But I would like to ask Sunil that whether there is any divergence, as Padam mentioned, in between not just the DPIIT and the income tax, but also how is it under the Indirect Tax Act? That is there some sort of a parallel, or is there a significant or small divergence insofar as the understanding in indirect taxes is concerned? I may ask Sunil to please clarify.
Thank you, Jayant. As far as indirect tax is concerned, I think silence is the most important aspect. So unlike income tax, wherein there is a definition of a startup and there is a base on basis of which one can really go into the deductions and other things, there is no specific definition provided or a carve out given for startups separately under the GST law. Having said so, being a transactional tax, naturally for activities carried out by the startup, the GST law would apply. I'll just take a point which Robin highlighted, that most of these startups are technology driven. And I think that's one of the essence of a startup. And that's where we have some very specific legislations and obligations cast on technology driven startups, which basically would mean e-commerce operators. And the definition of this e-commerce operator is very widely worded. They talk about saying that if anyone owns, manages, or operates a digital or an electronic platform. Now, these are very, very wide words. And once he's characterized as an e-commerce operator, there are certain special provisions which apply to them. And perhaps that is where we find that there are some stumbling. One important thing is, while we say GST is a one nation, one tax, we are all reconciled to the fact that it's a state level registration. For an e-commerce operator, he is required to register not only in the state where he is located, but he has to comply with the TCS obligations, for which he has to register in each of the states where the underlying vendor is located. So I might be a startup, and typically when you look at technology, we always say technology transcends even national boundaries. Very limited amount we talk about a state boundary. So if I'm in Maharashtra as a startup, and I have a supplier who is supplying goods from Assam to somebody in, let's say, West Bengal, I would need to register in Assam for the purposes of tax collection at source. Now, this actually becomes a sort of a stumbling block in terms of, the paperwork, because once you talk about registration, over a period of time, the government has made registration more and more complicated. There is a concept of an address proof. So necessarily, some of the states don't allow a residential address or a business center address. So therefore, you have to technically hire a place or obtain an NOC from some landlord over there. Now, all of this adds to the transaction costs and reduces a lot of nimble-footedness, which I would believe is one of an important aspects of an e-commerce operator. Another facet which comes is, moment you are an e-commerce operator and there is an underlying supplier who supplies through an e-commerce operator, the underlying supplier, even if he's a small SSE having less than 20 crores, 20 lakhs of turnover, he is still required to obtain a registration because all supplies through e-commerce operator are not eligible for the threshold. Therefore, in the startup space, there's a lot of opportunity for an aggregation model where somebody acts as an aggregator for 10, 15 people now, or maybe millions of people that way. Now that type of a model fails because there's clearly a disadvantage in terms of the denial of the basic exemption limit. So I think these are some of the challenges which do come up when we look at the startup space from an indirect tax area.
Okay, so I hope that gives some clarity about a 360 degree vision of what is the definition, at least in order to get whatever incentive benefits are available, and also for our own clarity. I'd like to move on to one other point which Robin mentioned in the initial parts, that even a Pan Bidi shop in a sense can be a startup, except for the fact that it's already been there and there is possibly no technology involved. So one of the essential characteristics, as you mentioned, is that there needs to be some underlying technology which is replicable. One other feature that at least I consider myself a layman in this area, that we often see, or one unique feature that one sees, is that the funding pattern and the revenue revenue generations or revenue streams that startups look at is basically quite different from what was there in the traditional business. And that's why Padamchand mentioned rightly that they are looking at maybe not generating positive cash flows for years on end. So really, it seems that a lot of the money comes in by way of funding through angel investor funding, investment in equity at the initial stages. So this can actually, seems to be that this can make or break the startup. So I'd like to ask Padamchand that, is there some sort of a feature which would be enabling the startups which apparently require a whole lot of investment? Is there some sort of a benefit that they get? Is there some tax relief that they get on their infusion of funds or investment?
When funds come into an entity, I'm required to demonstrate the nature and source thereof. That's the criteria of section 68. We're now trying to make a statement in terms of startups that if you're getting equity into your company concern, and if the equity is coming from specified entities or specified types or designations of persons concerned, then we will not ask you any question. Now, the genesis behind this is, before this is that the government was worried about unaccounted or converted incomes coming in. And these were coming into companies in the form of unjustified premium. The government therefore was making a statement, this unjustified premium, a company getting subscription to a share capital at a premium far in excess of their actual net worth, that the government believed was a mechanism of converting monies which are otherwise not revealed to the tax department to come into the mainstream. Government therefore said all unjustified premiums are going to be taxed. And how do I arrive at this unjustified premium? I'll give you a mechanism of valuation. 11UA will tell you the valuation, and anything that comes in excess of that valuation shall be regarded as unjustified premium and taxable under 56(2)(7)(b) of the Income Tax Act. Therefore, this unjustified premium becomes taxable. They're now laying down an exemption or an exception to a startup. And that's the way they're trying to encourage to say that if a startup fulfills the conditions of being recognized by a DPIIT, it's important for us to understand that also. When do you become start? What is the period for which you are now eligible and what are the criteria laid down there? You can be a startup provided technology is involved. We've seen already that. And you can be a startup for a period of 10 years from the date of your incorporation. After 10 years, you cannot continue the status as a startup. Maximum 10 years. If within 10 years, you achieve the turnover of more than 100 crores, you again lose the status of startup. The losing of a status of a startup in this context, in the year in which the turnover exceeds, is prospective only. From that year and subsequent years, you cease to be a startup. There's nothing called as a retrospective effect of ceasing to be a startup. It's important for us to understand this because there are certain other criteria especially in relation to receiving unjustified premium. They say this will not be regarded as income provided you fulfill certain conditions, satisfy certain conditions. If you don't satisfy those conditions, anytime during the next 10 years period, that is the maximum time available for you for a startup, and anytime later on you violate this condition, the violation goes on retrospectively to say, to trouble you in the year in which the unjustified premium was received, this unjustified premium becomes taxable in that year, 1. 2, they are also going to say, they're making a statement that this unjustified premium shall be deemed to be concealed income. 3, it shall be deemed to be concealed income as a result of misreporting, not underreporting, as a result of misreporting, for which the penalty can be 200%. Therefore, when you receive money towards your safe subscription, the law is giving you certain conditions. It's important for us to understand those conditions. One, they are saying that your capital shall not be in excess of 25 crores. This capital can represent your share capital plus premium. If you go beyond that, you lose your benefit. Now, what do you mean by this 25 crores? There are a lot of conditions attached. This 25 crores towards share capital or premium shall be exclusive of the monies you receive from a non-resident, from a venture capital fund or a venture capital company, or from those companies whose shares are listed on stock exchange, having a turnover of more than 250 crores and having a turnover of 100 crores. So the monies received from these people concerned shall not be taken into account for the purpose of arriving at this 25 crores of capital and premium. They are absolutely free. Remaining, yes, you have to be sure that the amount received by you towards share capital and premium shall be less than 25 crores. 1. 2, not just this, you are going to get an exemption provided you ensure that this money is utilized properly. So how do we be utilizing properly? They're saying these are the following restrictions you will face in terms of how you utilize this money concerned. It's like 11.5 charitable trust. You shall not invest the money unless in those specified securities concerned. So they're giving you some sort of negative. 11.5 was positive. They're giving you a negative list here. You shall not do the following. And some of the conditions are very peculiar. It's important that we go through these conditions very carefully. For example, one of the conditions say, you shall not use this money received towards share subscription towards investment in shares or securities. Absolute ban. You shall not use this money for subscribing to the capital of any other entity. You can't therefore promote a company. You can't therefore be a holding company for a subsidiary company of yours. One peculiar condition is you shall not also buy a motor vehicle of more than 10 lakhs. Less than 10 lakhs, buy a Benz, third-hand Benz, no issues at all. But in a new car, very interesting. That side is very interesting. You can't buy an aircraft, yacht, or a motor car in excess of 10 lakhs. They're imagining an aircraft is available for less than 10 lakhs also. That's the condition they're laid down. So very peculiar conditions. And if you violate these conditions, having received this money in year 1, in year 4 or year 5, you invest in a car concern, then they say you lose the benefit retrospectively. And when you lose the benefit retrospectively, serious consequences will follow. Therefore, there is some sort of a benefit available to people who are investing in share capital. Got to be very sure that you fulfill the DPIIT conditions laid down there, as also the conditions on how you shall utilize the money and for what period of time. Interesting to say that from whatever date you receive this money, that means in year 1 I received money, year 2 I received money, year 3 I received money, year 4 I received money towards share capital and premium. From the respective dates of receipt for the next 7 years, you have to ensure that you don't violate the conditions of investment of these monies concerned. Subject to these conditions being fulfilled, law says starter can have unjustified premiums not matched by their balance sheet, by perceptions people are investing in this company's concern. We will accept those perceptions. We'll accept the third party's belief in this company, this idea concerned. Will not then trouble those starters.
So as you would have seen, there is a fencing of so many conditionalities, etc., including the one. It almost seems that the conditions are made grudgingly, that you should not be extremely successful. You can be successful as a startup, but you can't be excessively successful. That seems to be the tone and tenor. So don't buy a car in excess of 10 lakhs. But that's on the lighter side. But I think also there is a condition given in 54 GB. Because that is something which I believe that could sort of affect a lot of people when they are going in for startups. It seems to require that only residential money arising from sale of residential properties would be eligible for taking the benefit. And although Robin also mentioned that large number of them may be more in the IT field and therefore may not require a big brick and mortar structure, and yet entities which are into the area of, say, grocery supply or whatever through the startup business, they would require significant amount of space and investment in land, etc. So there are some very peculiar restrictions. I'd request Padamchand to once again throw some light on that, because those also need to be understood carefully.
There are two sessions that are relevant, and both today one has already lost its shelf life. One is having a very, very short shelf life, but just for the purpose of, because discussion becomes extremely important. The government started a fund of funds to say that this fund will then give money to incubators. Incubators will give money to startups. And therefore, to increase this fund, 1,000 crore fund, they said, if you have made a capital gains and you're subscribing to the units of this fund, we'll give you exemption like 54E or 54E type situation was available. But then they said only up to 31st of March 2019, that scheme therefore no longer exists. 54 GB that the chairman Jayant was talking about is a session where it says, if you sell your residential house and you use the money for investing into the eligible capital of a startup, then to the extent of or in proportion to the consideration you have received on the sale of a residential house, it could be a residential house or a land to be used for residential purposes. The classification of land is very important. Either of this being sold within a period of how much time? Within the due date for furnishing the return of income, not 6 months. They say, suppose you're selling it today, 19th of February. Let us say my due date will be 31st of July. So by 31st July, I will have to put the money in the capital of a startup. Then proportion of the consideration invested, I'll be entitled to the exemption. Now, it doesn't stop there. It also makes a statement that the company in which I'm investing this money within a period of 12 months shall use this money to subscribe to certain assets, being plant and machinery, within a period of 12 months maximum. So my condition by my 139.1 and company is 12 months from the date it receives the money towards the subscription of the share capital. And I should not sell the shares for a period of 5 years. The company should not sell the asset for a period of 5 years. If it is computer, they're making a concession. The company shall not sell the computer for a period of 3 years. If the company were to violate the condition, I pay tax. If I were to violate the conditions of selling the shares, I pay tax. So this is a case of 54 GB where I can invest in the eligible capital and the company should invest that money in the acquisition of plant and machinery or certain specific assets concerned. Then these conditions being fulfilled, you are entitled to the exemption. Rightly or wrongly, this expires on 31st of March 2022. That is, I should have invested this money before March 2022. They were expecting that there will be an extension of date. That extension has not happened. In the finance bill, they have not made a mention of this situation concerned. So therefore, it's only for a period of now 2 months more that you have a startup and I invest the money concerned, I will get an exemption under 54 GB.
So anybody thinking of that, please do so quickly. And that too, only residential properties, commercial properties, if you want to sell and get into this, you're not eligible. But having looked at all this, a larger question, let me come to the big picture once again. That we've seen that there is so much of, that means there is an underlying intent that we must promote startups. But is there really the necessary infrastructure or framework that we have created? I would like Robin, who has got a different sort of exposure, that can we say that of course, there are positive amendments being introduced, but they are hemmed in by so many requirements that can we really say that there is a good ecosystem which would truly promote startups in a positive way? Robin, if you can give your thoughts on that.
There is a saying, the taste of the pudding is on its eating. India, in terms of funding, globally, is number 3. Last year, US got funding about $90 billion. China is about $40 billion. Sorry, $50 billion. India got funding of $42 billion. Year before, India's startup funding was $11 billion. So the taste of the pudding is in its eating. It is proven that something is working right in India. However, in terms of global ranking of startups, India is not top 5. It's US, China, UK, Israel, Germany. There is a top 10 ranking where I think India fares around 7 or 8. So what has happened, as Jayant Bhai said, that the startup ecosystem has started off late. And having started off late, we could have started 10 years back. It is galloping. $40 billion investment in startups in 1 year. It's a lot of money. We just heard of the direct tax and indirect tax, I think anomalies. This should not have been there. And of course, when I look at one particular law, which all of you must have heard of, the Insolvency Banking Code, which is about 6-7 years old. But in the early days, it had only problems and no solution. But as times went by, government kept on solving the problems. You must. And today, it is a fairly robust insolvency code. And the world economists say that perhaps India has the best law in terms of law. Still, companies are going bankrupt and nothing, NCLTs don't work, NCLTs doesn't work, but that's another matter altogether. I believe in the startups ecosystem, because it is of late, many of these direct and indirect taxation problems, and one of the problem which you just heard, that if you are a supplier to e-commerce, and even if you're a supplier worth 5 lakh rupees, you are a supplier of, let's say, small plant, and your supply is less than 20 lakhs, you still have to have a GST registration. But the original intent of the government was they wanted consolidation. एक साथ 10-12 एक साथ करके आप supply करो और सबको GST लेना पड़ेगा. But that's not happened. That doesn't happen in India. India is a singular country. Having said that, there are taxation related issues for sure. And however, I believe the ecosystem is fantastic. For a startup, what did I say? What is the definition? The definition of a startup first is from 0 to something, 0 to 1, nothing to something. Now, from nothing to something, you need an idea. And Indians are great in getting an idea because we are very intelligent people. It's a fact that entrepreneurial spirit in Indians are perhaps number 2 after China. I have looked at China very closely. I was in the board member of China. They can replicate, copy, and improvise something which anybody else has done. They do it very well. India is also catching up. So we have the brain to do this so-called, the intellectual properties or intellectual abilities are very bright in India. That's very nice, but ecosystem is not your individual. Normally this idea comes from an IIT youngster from IIT, straight from the institute, 23, 24 years of age, and an idea comes and he, with his friends, starts working. The second thing is you need others to help you. And India has a people power. We have the manpower. If you are in Germany or in Israel, for instance, you have fantastic idea, but there are nobody to work with because there are a lack of people. So we have people. The third good news is that the government has started talking about startups. They are giving awards. Prime Minister keeps talking about startups. The moment the government starts talking about a subject, I have noticed overall that something keeps happening. Last 3 years, if you notice 4 years back, the government was talking about insolvent companies being sold off, auctioned off faster. And slowly what I saw, the IBC is getting strengthened quickly. Of course, the courts do not work. That's the biggest problem in our country. The regulation exists, but the courts are very inefficient, but that's another matter altogether. So I think the government is working. And the fourth important thing, so first, we are intellectually very strong. I think ideation is very good. We have people, the government is backing. The fourth, believe me, ladies and gentlemen, the ecosystem is working because there is enough money. There is enough money for good ideas. There is absolutely no problem of money. If anyone says paisa nahi hai, they are in a fool's paradise. You go to anybody, a venture capitalist, normally a startup starts with equity. As you all know, there are only 2 sources of funding, equity and debt. There is no third source. And if any one of you can invent the third source, you will get the Nobel Prize, I can assure you. Nobel Economics Prize, but there isn't any so far. And debt is not an answer for equity. Because normally debt would need, moment you give a debt, you need a fixed asset. But startups are technology oriented, ideation, idea, nothing is there. There are no customers. And therefore, how do you get, there is no fixed asset. There is no mortgage or hypothecation. Therefore, it is necessarily has to be equity. And there are, in my view, there are more than 100 willing venture capitalists who are willing to spend money and give money to a good idea. The fifth, which you must remember, 9 out of 10 venture fails. 9 out of 10 fails, and that's proven. And therefore, the venture capitalist knows about it. That if 9 out of 10 fails, I will have to make so much money from that one that my loss of the 9 will be taken care of. That is why you have seen Zomato being valued at $15 billion and Paytm being valued at $12 billion and so on and so forth. They all feel that this sort of valuation is worthwhile because I will exit at 20 billion, 25 billion. But it's another matter what's happening to the share market today, but that we will not discuss. So having said that, the ecosystem is very good. There are people who are willing to do, oh, one more idea I must give you. Must give you one more idea. For all those who are watching this program, either through a web or physically here, many of you must be thinking, yes, but if I want to start a startup, what do I do? You have to start up. So you have to start a startup with an idea. Exactly. You are rightly saying. Yeah. But where is that idea? Many of the time we are saying, idea to khatam ho gaya. Whatever ideas, but koi na koi to kachi kar liya. So I have a source to tell you. There is a magazine, just maybe there are many other sources, but one source I found very good. There's a magazine called Forbes. Have you heard of Forbes magazine? Forbes magazine every year does a study of best 100 startup ideas. And they physically publish the top 40 every year. Yes, they publish one paragraph each, top 40 ideas. Top 40 2021 ideas, top 40 2020 ideas, top 40 1999 ideas. 2020 ideas, 2019 ideas. If you can go through those Forbes magazine you can then pick up one of those ideas of the several best ideas. These are all American ideas, by the way, not in India. They're still not in India. And think, what is it that you have core competency in? I'll give you a small little example. One of the ideas I was looking at, there's a company which is rounding off the debit and credit. हम जो debit credit card में payment करते हैं ना, उसका round off होता है. Let us say the bill is for $10, but no, it's a $10.10 and or $10.60, and the customer has paid $11. 0.4 रह गया. That company, this so-called startup, picks up that 0.4 and invests through an ETF. It's a $1 billion company. Yes. They just pick up and invest the rounding of amount available in debit and credit cards. Now that's an idea. You may not have heard and thought of this idea before. Now, why I'm saying this idea? Because I love this idea. If I was a startup entrepreneur, I'd say, yeah, round off karke paise banate hain. So I'm only saying that there are avenues by which you can still get ideas, and those ideas you can replicate in India. And believe me, for a startup, you need not be the starter. A startup need not be a starter. For instance, Amazon was copied by Flipkart. Flipkart was very successful. Now, Flipkart was copied by Snapdeal. Now, Snapdeal was not successful. Now, I'm not getting into why Snapdeal copy of Flipkart was not successful, because already Amazon was in India. Flipkart came in already in India. It was too crowded already. So therefore, number 2 is not bad, but provided that number 2 can add to new customer demand and customer requirements. So to summarize, still there are ideas. You can still get some ideas, perhaps from Forbes magazine, and there may be others. I have definitely figured out that's a damn great place, and they have picked up the best 40 in the world and put it down for you every year. And therefore you make it 300, 400 ideas and just pick up what is good for you. And believe me, ladies and gentlemen, there is still enough money. If you have a good idea, and if you have that just within you, you will get money. There is enough money.
I think that is the sort of optimism. It's not unfounded optimism. It is based on a lot of study. And there, as Robin mentioned, there has to be fire in the belly, there has to be passion. So only with that. And I liked one of the earlier points he has made, but there is also, as chartered accountants, we tend to look at pitfalls everywhere. And I have spent my years in audit, so you become accustomed to that. So the moment he said that, Indians are innovative, they are intelligent, they are educated, the immediate thought that flashed across my mind is, of course they are. And not only us, but the world is recognizing that. That is why you have Sundar Pichai and you have all the others heading multinational corporations. You have people at Warren Buffett's company. You have got Indira Nooyi, past head of Pepsi. So it's not that the world does not recognize. Everybody recognizes the sort of talent that we have. That is, it's a big plus, obviously, but everybody is not turning a blind eye to it. They are also trying to lure our best of talent away. And our job is to see that we keep our talent with where it requires to be with our companies, right? So, when I juxtapose the two between the requirement that we need to go into and what we are today, again, I come back because income tax becomes something which was my passion one time. So now no longer. But, are we having, I would like to ask Padamchand, no, ultimately, although people work for their passion, for their, beliefs and so on, and the challenge, money also matters. So when you are paying our people, are we having the right sort of incentives and not disincentives of not buying a car more than 10 lakhs? ESOPs is one of the major incentives that one can have. Are we having the right sort of infrastructure, say for ESOPs? Because that is how you can retain the best of talent and pay seemingly astronomical. I would say they are often most well-deserved. But then ESOPs is one method. There are also some incidental irritants of TDS which are there through some of these sections like 191, etc. Are we incentivizing enough? Are we putting the stick too harshly? Padamchand, your views on that?
Continuing from where Mr. Robin mentioned, ideas, very critical for a startup. And also going back to the earlier point that one of the most important requirements for a startup is a finance. We are now suffering for lack of adequate finance. We need talent, we need ideas, we need to also compensate them. One combination that works very well to achieve both these objectives is giving the employee a stock option. I'll give you shares for all services I've rendered so that I'll compensate you. You will become a part owner of the company. You'll enjoy the feeling of an ownership and you will therefore participate in the benefits of the growth of the company concerned. And therefore, ESOPs become a very potential tool for attracting and retaining talent concern. This is an idea from the employer's point of view. We also have an idea from the government's point of view. I want to give a concession. The government looks at it in a different way. Its idea of the government is different for an ESOP taxation. That becomes a very interesting combination as far as ESOP for startups are concerned. When a ESOP is granted, stock options are granted, no tax on grant, no tax on vesting, tax only on exercise. Exercise followed by allotment. The value on exercise date, conditional upon the shares being allotted, becomes the taxable event. Now the law therefore says, yes, you have to pay tax on the date you exercise the stock options concerned. So if stock options have been given to me today, 19, after a 12 months hiatus, I can therefore exercise the stock options concerned. I let us say in 2023, somewhere close to 2023, having served for more than 12 months period for vesting, I exercise the stock options concerned. On the date of exercise, I'm liable to pay tax on the value of the shares determined by Rule 3.8 to say that this shall be the value of the perquisite includable in my total income. Logical consequence of that inclusion in my total income should have been that I should be liable to pay tax. In this context, the government has introduced some sort of its own idea of how to make the tax consequence on an employee a little less harsh. It therefore says, yes, stock options shall be included as a perquisite and shall be therefore a part of your total income in the year in which you exercise the stock options concern. But you shall not be required to pay tax on that unless certain conditions are fulfilled. So it becomes a part of a total income, part of charge is satisfied, but the taxability, that means the payability of it is deferred to some eventualities. What are those eventualities? Very interesting eventualities. They say, if you continue with your employer concerned, then you will pay tax after the expiry of 4 years from the end of the relevant assessment year in which the stock options were granted to you. Very simple statement, but has very interesting consequences. I'll give the example today that I therefore got the stock options today, 22. I exercised the stock options in November 2023. Now, the law says in November 23, that is March 2024, I should include this income in my total income. March 24 is assessment year 24-25. So it ends on 31st of March 2025. 4 years thereafter, 31st of March 2029, and 14 days thereafter, by 14th of April 2029, I will be required to pay tax on this benefit concern. So it's not just 4 years, it's effectively little more than close to 6 years time that you get for the purpose of paying tax on your stock options concerned. They are includable in my total income, but tax has to be discharged a little later. So this is the law that they have done about now. How do I achieve this also? How do I achieve this? They have made certain amendments to certain provisions of the Act now. They have made amendment to 192 that the employer will be required to deduct tax at source after 4 years from the end of the assessment year and 14 days thereafter. If for some reason the employer does not deduct tax at source, you as an assessee would be obliged to pay tax yourself under 191. Even that is having an identified time limit coinciding with the employer's tax obligation. That means 14 days from the end of the 4 years after the expiry of the relevant assessment year. Now, when the assessment therefore happens and the stock option is includable in the total income, naturally the assessment order will be served upon you. They will serve upon you the assessment order along with a notice of demand. 156 has been amended, saying that this amount that is mentioned in the notice of demand shall be payable by you similarly in the like manner 14 days after the expiry of 4 years from the end of the relevant assessment year. They could have made it very clear easily itself in this scheme concerned to the stock option taxability itself is deferred. They have not done that. Taxabilities continue to be maintained, but you will pay tax at a defined point of time. This is one of the conditions concerned. So if you are continuing with your employment and nothing else happens, you're retaining your stocks, then you'll pay tax in this manner. Suppose in this 4 or 5 years time you're looking at, you are selling your shares concerned. Then the law would say that time limit I've defined to you will get curtailed now to a date 14 days from the date of sale of the stock options concerned. So that period we discussed now gets curtailed down in the eventuality of a sale because you have sold the shares, you got the money, cash flow was an issue with you, that cash flow no longer is an issue with you, you got money, please pay tax from the date of sale. Now, we as chartered accountants start playing with these words now. What does the law talk about? It says from the date of sale of the stock options concerned. Is sale the only mechanism of transfer? No. I could exchange, I could gift. So when you start looking at the law, because of the peculiarities of this, you start playing with various conditionalities, various alternatives available to you. Law interestingly says only for the date of sale. So if I were to gift that to my brother or to my son, and he sells it immediately, and I'm an employee continuing with the organization, I don't pay tax on the gift. He pays tax whenever he sells it. And I'll therefore wait for the discharge of the tax liability at the end of 4 years from the end of the relevant assessment. 14 days, 4 years, and 14 days thereafter. Now, these are because the law itself is very peculiar. Law itself is very unnatural, and you're trying to look at the law wording very carefully. And you may make a statement that the words used are only sale. Other means of transfer are not therefore included. Let me take advantage of that. Let me get the benefit to some other means, and I'll not pay tax. I'll pay tax only at the end of a defined period of time, which is about close to 6 years, the way we are discussing. So second condition is that you shall not sell the shares. If you sell the shares, you'll have these consequences. The third condition is you shall not sever your relationship with the employer. You should not therefore resign or retire. If you were to resign or you were to retire, you will again get cash compensation for all your retirement benefits and all of that. Therefore, there will be cash available with you. So the time limit of 4 years will get curtailed, and you will therefore be liable to pay tax immediately. So three conditionalities, that's it. On the happening of these, either of these three, whichever the earliest, the tax payability will get attracted. Now, having laid down this peculiar law, as chartered accountants, we start looking at other provisions, connected provisions as to what will happen now. That means, because what I'm saying is that I file my return of income. I offer this for tax. I don't pay tax on it. I don't attach the proof of payment of tax because that itself is deferred. Question therefore arises, would this be a defective return? Because you have not attached proof of your tax payment. Although the purchaser is offered for tax, the tax payment thereof is not shown, not in evidence. Would there be therefore a defective return on 139? Law is not amended there. Therefore, you have to go back and make some twisting to the existing wording to say where tax is deductible in accordance with Chapter 17. I am then required to attach proof. Tax is not deductible because under 192 itself, the employer has a specific time limit for complying with those conditions concerned. 139.9 is not attractive. As an employer, am I therefore going to be worried about the disallowance of the underlying expenditure because no tax has been deducted? Is 48 troubling me in this matter? In the year one, I'm claiming the expenditure on the basis of exercise concern. I don't do TDS. What will happen to my expenditure? Law will say it will allow because the law would say tax deductible in accordance with Chapter 17, you violate. Tax is not deductible under Chapter 17. You don't violate the conditions now. Therefore, nothing will happen to you. Logically, you'll ask the question, what will happen at the end of 6 years close when I don't do a tax deduction then? Then you go back to the earlier year and then say, oh, that expenditure you claimed without deducting tax or source, at the time of deduction of tax or source, you did not comply with the conditions of law. Therefore, you will have to suffer a disallowance of the underlying expenditure. Then you go back to 147 and say, what is the time limit for reopening? 3 years only. You can't reopen more than 3 years now. They changed the law now today. You can go up to 7 or 10 years time under particular situations concerned. So you start getting very interesting situations around the law because they're changing one facet of law without understanding the implications of what they have made under another provision of law. So interestingly, therefore, if at the end of 4 years you don't deduct tax at source, nothing can happen to you. There can't be a disallowance itself because reopening is not possible under 147 of the Income Tax Act. Therefore, there could be interesting situations concerned. What about 2011 interest? From what time will it start kicking in? It will start kicking in from the date you are obliged to deduct tax at source. That is 14 days from the end of the fourth relevant assessment year. Only then, if you delay thereafter only, there will be an interest at 2011A. 220 subsection 2 interest also will be liable from that date onwards. 234B and C also will ask question, what happened to 234B? What happened to 234C? Start looking at these provisions concerned. You are required to do a lot of damage to the reading of these sections concerned to get a conclusion consistent with your basic proposition that income is includable, tax is not payable. This is a very unusual situation that liability of excise on manufacture payable on clearance. That's one way. More closely example in the Income Tax Act is when I convert my capital asset into stock in trade, it's includable in my taxable income, but it becomes taxable only when I am transferring the converted asset concern. Trying to borrow that philosophy, but giving rise to a lot of issues in terms of understanding the requirements and the applicability of various other provisions of the law concern. Having said this, if you look into the provisions of the Act under 192, under section 17, there is a differential now that if the ESOP is given to you by the current employer, this will come in. What happens to a fellow, you got the stock option, they vested in you, you retired now, and you have a time period for exercising the stock options concerned, you exercise those stock options concerned. When the person from whom you got the stock options is no longer your employer concerned. Logically, if I have a stock options concern, I should have waited for the period of time. But the law is saying no. If you look into the wordings of section 17, compare that with wordings of 150, compare that with 191, compare that with 192, you don't find a consistent reference to current employer. Somewhere employer, somewhere current employer. Is there a difference between an employer per se and a difference between the current employer per se? The answer could be yes. But you could have therefore a lot of issues in terms of understanding because there is a lack of symmetry in the terminology used in various sections concerned. And therefore, this symmetry between terminology and the interplay with various sections concerned under the Income Tax Act could give rise to very interesting ramifications in terms of taxation of ESOP, which could otherwise have been addressed very easily by making a statement that this ESOP taxation will be taxed at the point of sale, which was a law in India from 1999 to 2002, before the FBT came in, immediately before the FBT regime. Stock options are taxable in India only when the shares underlying were sold by the employee.
So you'll get, I'm sure, I think the spontaneous response that you get we are talking of a maze of laws. And the interesting feature as I was listening to Padamchand is that at the level of litigation at which he practices, it is all right to argue this. I have also seen the situation when you go before an assessing officer at the grassroots level, perhaps not even in Bombay, because some of these startups are coming in at different places across the country, and why not? But try explaining all these provisions to an assessing officer over there if you are fortunate to have a face-to-face assessment. And I can tell you that life is going to be very interesting. I would not say more. So this is what actually makes, I'm not either critical or this is the ground reality of how tax laws operate. And again, it's not only in India. We tend, we are more intelligent, as Robin said, so we therefore create more intelligent problems. So we have got a maze which is quite different from most other countries. But I think we have said enough about compliances, maze of tax laws. Let's look at the other side, because we have been talking about the taxation part and the taxability part. One of the features that we mentioned right at the beginning, which Robin had mentioned, is that many of these startups are with innovation. There is, and as you have seen maybe in some of the startups that are there, their revenue streams are quite innovative, in the sense when Google started off, there was absolutely, I'm talking of long back, of course, now Google is also history. But the revenue streams which these people could think of were unimaginable a generation back. Okay. So when you're talking of these various revenue streams, then there are various other facets attached to it. So I was wanting, because when you talk of discounts and cashback and various other incentives that are given, rewards, freebies, so many issues come up. And how do you account for is one part of the problem, which is still very much in the domain of discussion, although now various practices have sprung up, but I don't intend to get into the accounting part today, being in the Taxcon. But I would certainly want Sunil to throw some light on how these innovative concepts of promoting your business by giving a scratch card or freebies or whatever, how would they get treated under the tax laws, especially under indirect tax laws, please?
Thank you, Jayant bhai. As far as freebies is concerned, I think the provisions are very simplistic. There is a very specific provision under section 17, which says that if you are supplying any product free of cost, then the corresponding input tax credit is not available. So therefore, there is definitely a cost loading, just like the basic price is borne by the startup. Along with that, even the GST component gets borne. But there could be a lot of interesting nuances when you talked about some other words, like, for example, when we look at discounts being offered, something which is not offered free, but sold at below the cost price, with an intention that you are building up a brand, and jargon like acquisition cost of a subscriber or a member, these are very commonly used in this industry. And many a times they, the startups keep on investing funds in burning out the money. Now, this is where one needs to be a little bit careful of a Supreme Court decision in the excise regime. And it was a very, when it came up, it actually started all of us. And it forced the government also to amend the excise law at that point of time. And that decision is very interesting. That Fiat was coming up with some new model in India. And therefore, they marketed the product at a price which is lower than the cost price. And the Supreme Court said that the expectation of getting repeat business in the future, the expectation of a promotion in the future is an indirect consideration and should become a part of the value of the car. So even though the car was sold at 4 lakh rupees, and that was what actually it could deserve at that point of time, the cost of that was 8 lakh rupees. And the Supreme Court said that the excise duty would be payable on 8 lakhs. This resulted in an amendment in the excise law. But when we look at the GST valuation provisions, perhaps there can be a little bit of a difficulty which these startups might face over there. So that is one area which startups need to be a little bit careful about when we are looking at a sort of a penetration pricing. More importantly, many a times this penetration pricing is partnered through various different people. So for example, if I go on to Amazon and I use a particular credit card, I get some cashbacks. Now, naturally, those discounts are then offered by some third party so that there is a promotion of that brand. And therefore, there could be an allegation of barter around these aspects as well. So those are the smaller nuances which could really bring up some surprises, because while the industry will understand this to be free, but practically the mindset of the officers is that there are no free lunches in businesses, and therefore when you are giving something free or at a penetration pricing or at a discount, the tax officer is going to ring you back to say that there is some monetary non-monetary consideration, and even if there's nothing, they'll try to search around and find something. So that is something which you need to be a bit careful about.
Right. So, so many different aspects to be considered. But again, I'll have to move back because that's the bread and butter of most of us, the income tax provisions. I would once again like to switch back to Padamchand, that we spoke earlier in passing about ATIC and some of the issues that are there, some benefits that are vested. I'd like to understand from Padamchand, and I'm sure all of you would be equally eager to understand, that given the provisions that are there in place right now, are those sufficient to effectively deliver the benefit as is envisaged? Because it is coming in ATIC, therefore that is obviously intended to give a benefit. And also we have seen some changes made in the tax deduction regime, which is admittedly not for revenue gathering, but more as a revenue tracking measure. That is, I'm speaking about 194Q and 206C, that is the small percentage that is required under 194Q or TCS under 206C. The C1H, the whole objective is that you want to keep track of people who are buying or selling items worth more than 50 lakhs. But when it becomes applicable to startups, because here you are competing globally. So really what I would like you to put across is that are these things that need to be done away with? The latter part, is there some tweaking or is there some simplification warranted for ATIC? Your views on that?
To answer the question, let us understand certain statistics. Robin Bhai was mentioning about the number of startups. There are a little more than 61,000 startups in this country. Out of 61,000 startups, a little more than 40,000 only have gone to the DPIIT. 20,000 have not gone to the DPIIT. Only 40,000 have been now recognized under DPIIT. Now, you have to finish the process of DPIIT registration to be eligible to come to Income Tax Act. Having secured the DPIIT registration, there is a form that you have to file with the board. Form 2 will have to be filed with the Central Board of Direct Taxes to get a recognition under the Income Tax Act so as to be eligible for ATIAC benefit. So from 60,000 to 40,000, and 40,000, how many companies or entities have gone to secure the benefit of ATIAC? 320 companies only. Why? They don't find anything worthwhile in this section concerned to say that a company which is a startup, which is now burning cash for the purpose of ensuring that the idea is successful, is therefore investing significantly in R&D, in people, not able to generate revenues. And therefore, if it generates revenues and does very well, so there are two extremes today. You do wonderfully well. We are making some examples, and therefore you do wonderfully well. Even that is the trouble for you. You have to be in the middle line, because the moment you cross 100 crores, you cease to be a startup. You cannot therefore go more than 100 crores also. You have to be less than 100 crores to be a startup to be entitled to the benefit of tax holiday. So only 320 companies up to December 2020 were the people who went for ATIAC benefit. Now, it becomes interesting, therefore, to say why people are not tuning to ATIAC, although they give you a tax holiday, because the tax holiday is available for a period of 3 years in a bandwidth of 10 years. So there is a float. With 3 consecutive years, you can choose in the float of 10 years concern. This type of float is available under other sections also. For example, under ATIA, we have a section which says that you're entitled to infrastructure 10 out of 15 years. That float is available. Interestingly, in that ATIA, in relation to infrastructure for power industry, for example, it says that the first year you choose to get ATIA, that will be called as the initial year, and I look at the 10 years float from thereafter. I look at 10 years consecutive years thereafter. I am therefore making a specific reference or a mention that the first year when you choose shall be called as the initial year. This becomes very critical because Supreme Court has called upon to examine this choice of first year. In the context of the Supreme Court examining this was the legal reason that when you come to chapter 6A deductions, 80 IAC onwards as a deduction, you have to come through the process of the computation of total income. When you come to the process of computation of total income, brought forward losses are there. 70 to 80 will come into the picture. All brought forward losses and brought forward depreciation will have to be adjusted. And if after adjustment, you have a positive gross total income, then only you can go into 80 IAC. So if I'm profitable this year, it's meaningless unless I'm able to absorb all my earlier years' losses concerned. In the context of this infrastructure and power industries, the contention of the SSC before the Supreme Court was, look here, the law says that this is the year in which I get into the tax holiday. This is called as the initial year. This is the year in which I therefore choose to get 80 IA. Look at my performance only after this, because 80 IA 5 makes a statement that you shall imagine that this industry is the only source of income for you. Supreme Court said, yes, when you look at the juxtaposition of the chapter 6 deductions, losses, and look at the choice available to you to say this shall be the first year of you entering into 80 IA. Only from that year, I'll count your performance. I will ignore the earlier year's position of losses concerned. So when you have a concept of initial assessment here, Supreme Court in Valuation case said, look at your performance after you choose the first year. Earlier year's losses, they will not necessarily be considered into account. Therefore, I'll look into your performance after the date you choose the initial assessment here. That concept is missing in 80 IAC. So the biggest differential, therefore, from those people who are enjoying the benefit of 80 IA versus 80 IAC is you don't have the concept of an initial assessment here. Therefore, the benefit of Supreme Court decision will not come to you. Therefore, you have to go back to your position, your performance, look into your brought forward losses, set up all those losses concerned, come to the gross total income. Only if you have this gross total income, then you will come into the position of getting an 80 ISC benefit. 1. 2, you also have to be mindful at this point of time to say 80 ISC, if that's profitable and you have set off some portions of your losses concerned. The law under MAT is going to be different. Law MAT would say you are liable to pay MAT. I don't give any exemption whatsoever. I'll therefore go by the lower of your book losses or depreciation. The lower of them, I'll adjust, not the whole of them, and I'll ask you to pay MAT tax. So 80 ISC becomes in that context a little meaningless exercise. You'll be able to get that benefit tomorrow of MAT credit. But if you're moving to a 22% regime, you don't want this MAT credit also. If you're going to 80 115B AA concept, you don't want that MAT credit also. And therefore, people are not finding 80 IAC meaningful. I also made a statement that 80 ISC is only available to companies and LLPs, not available to partnership firms. Therefore, these fellows are outside as it is. Law also says your turnover shall not exceed 100 crores. If you exceed 100 crores for that year, you're not eligible. For that year, you're not eligible as far as 80 IAC is concerned. But then if you cross 100 crores, you go back to DPIIT, you cease to be a startup for that year and subsequent years. Therefore, in the next year also, if your turnover goes down below 100 crores, you'll not get the benefit of 80 ISC because you now cease to be the startup under DPIIT notification. 80 ISC is conditional upon you remaining a startup under DPIIT notification, and then your board notification continues. So therefore, there are, in my opinion, a lot of problems concerned as far as the applicability of 80 IAC is concerned. You also have to be mindful that the starting sections, 80A, subsection 2, subsection 4, subsection 5, subsection 6 of 80 capital A are applicable. Those are applicable. 80AB is applicable. 80AB therefore makes it mandatory for you to compute the income in accordance with the normal provisions of the law for you to be eligible for 80 IAC benefit. The only silver point of noting that you therefore make is in 80 AC. Law would say that 80 AC says if you are trying to claim certain deductions under chapter 6A, the deduction shall be allowed only if your claim is made by you in the return of income. You don't make a claim in the return of income. You try and make a claim later on through an appeal process, through an additional ground being taken. We will not allow you that. The Gst condition, Supreme Court, all is got over by introducing 80 AC, that you shall make a claim for 80, the chapter 68 deductions through your return of income, which return of income should be filed in time by virtue of 80A. If you look into 80 AC, they have not added 80 IAC into that section concern. That's a small relief that you can, if you look into that section, a small relief available to you to say if you omit to claim 80 IAC in your return of income, you're otherwise eligible for it. Possibly you can make that claim through the appeal process because 80 AC has not been amended to incorporate a reference to 80 IAC. Therefore, if you look into these provisions of law, you get a feeling that yes, it is available for the purpose of government telling somebody else, hey, we are giving a lot of encouragement to people concerned. Let them come into the startup concerns. Let them take the benefit. We're giving a tax holiday. So earlier 3 out of 5 years, we've made 3 out of 7. We are now making it 3 out of 10 also for you. And we're also giving an extension now that eligible startup, you could have started from 31st of March 2024. We're giving you all this benefit, my opinion, more lip service than an actual reality because it doesn't function very well in actual terms.
I think very well said. I'm only hopeful that nobody in Delhi is keyed into this because I'm terrified that that one exemption that has remained inadvertently, if somebody in Delhi listens to it, I'm sure that will be blocked in the next amendment or perhaps even this finance bill before it is passed. So the other interesting point, I'd just like to make a comment. Actually, what Padamchand said, that there is a hullabaloo about giving relief and giving exemptions, but somewhere dene wala haath is not, opening up in the way that is intended. And there, I believe I have had, thanks to my stint at the Central Council, I've had occasion as a chairman of the Direct Tax Committee when I was practicing in this area to interact with some of the officials in CBDT. The difficulty is that some of our top leaders are genuinely people of vision. But in Delhi, if you ask, the people who rise through the ranks in the department are what is often referred to as babus. So Babu, a vision of a Babu and a vision of a visionary is sometimes not having a connect. And somewhere along the line, I think this is an area, not in tax, but in terms of conceptualization, that we really need to change. And the reason I'm mentioning this, I'm digressing from my role a bit, but because that is where I intend to put the next question to Robin, and also just incidentally comment on another point, which, linking the two. Robin mentioned that innovation at the very outset, he mentioned innovation is at the heart of startups and innovation and technology. If you see the pace of technology and the innovations that are going on, 10 years for ATIC, in 10 years, a lot of the technology that we are talking of today is going to become obsolete. So if you're going to talk of taking a benefit 7 years down the line, possibly the innovation that you start today is having a shelf life of only 7 years, forget 10 years. So really it's difficult, and you can't make more than 100 crores, remember. So it's difficult that if you're going to pump in 600 crores and you can't make 100 crores per year and you are having a shelf life of only 7 years, I don't know what the person is going to do. And I'm leading up to this facts because I want to ask Robin a very interesting question. That, as you rightly said, Robin, we have got intelligence, we have got innovation, we have got possibly the intent of the politicians to reach a high level of the Indian economy and so on. But we see a lot of Indian startups establishing their offices or setups outside India. Is it because of an unfavorable or slightly, if I may use the word, hostile environment that we are having, despite whatever incentives we are trying to have? These sort of very reluctantly given benefits, or is there something else that is driving people to set up, Indian people to set up startups outside India? I'd really like your views on that.
Have you noticed all the established, or most of the established companies in India, they have a holdco somewhere else outside India? That's mostly true. Most common is Mauritius. Then companies who are Mocha Hua companies who believe their governance is very good, they will have their headquarters in Ireland or Netherlands. Now, I believe a startup, I know we are talking about direct tax benefits and laws for so long. You pay tax only when you make profits. Unless there is profit, there is no tax. So first they must make profits. So why does a startup establish another company, which is most probably, and most of the time it's a holdco, which pay, and Padamchand ji can bear me out, is that true or not? that most of the companies, when they go to the tax consultant, they say that you please have a holdco. One, where is a double taxation treaty? And two, well, there used to be something called tax holiday countries, as you know, from 2024, including India, all of us will be taxed at 15%. That's what, as you know, 140 countries have already signed, that minimum taxation of 15% will happen. So 15% tax coming 2 or 3 years, everyone has to pay. India is a tax regime, which is a 25% tax regime, more or less. So if I have a holdco, which has a lower tax regime and I start making profit, it makes immense sense to having my parent company somewhere else so that at least the dividend will be subjected to lesser tax. And those two countries have double taxation treaty amongst them. I don't think there is any other reason as to why a startup type of companies will have another company somewhere else. However, dividend is not subject to tax, unfortunately, precisely because of this reason. There is no dividend tax holidays anymore because they believe that the dividends keeps coming into India, which is a round tripping which happens, unfortunately. So a bad move needs to be taken place for a good move. I'm giving a long answer. I personally feel that it is a pure tax planning issue, unless I'm missing something. And whichever startups I speak to, I sit in the board of SME Chamber of India, whichever startups I speak to, I think they all have a good intent of paying their taxes, but their tax consultant says, it's good to have something in Mauritius, good to have something in Holland and Netherlands if you have to pay tax, and later on you will be paying lesser tax, and there is double taxation treaty and so on and so forth. I think that's the reason. I still believe India is a fantastic ecosystem, ladies and gentlemen. While we may be still not number 5, but we are the number 3 in terms of funding. So something must be going right in India. China, I don't think we can go because of China language issue. US, very difficult because you have to at least invest $10 million. India is definitely the right place.
Yes, of course, not that I sort of disagree, but I wanted to elicit an information so that your authoritative view is putting in that sort of a perspective, and also an incidental point that I forgot to sort of seek from you, that A is the tax regime, B also there are a good number of failures amongst this, and you did mention that earlier, and Padamchand also mentioned that in passing, that only so many of them actually make money. That is, so I would like to ask, A, you have already said that the environment is not hostile, but generally, is it more because of the very nature of startups, or is it because that these things add a sort of burden which ensures that you're not at the takeoff point in the best manner possible? I'll again come back to you on that.
Yeah, quick do's and don'ts, ladies and gentlemen, because most of you will be consultants to startups. Startups, one area which you must always remember as chartered accountants, when you go to a client is always looking for 360-degree solution. You may be a tax expert, but if you can give a 360-degree solution, it works brilliant. Why does 9 out of 10 startups fail? That means there must be some do's. And the number 1 do, in my view, is please advise your clients to keep 1 year's cash burn. These intelligent youngsters who are IIT engineers, most probably, they feel from day 1 they will start making profit. They don't. There is always a hockey stick, 2 to 3, 4 years losses, and then starts moving up. You could have the most brilliant idea. Most important, these youngsters assume profit from day 1. Our excellent idea hai, and they don't keep cash burn in their hand. Why do most new restaurants fail? Because they don't keep 1 year's cash burn, minimum 1 year's cash burn. This is do number 1. Do number 2, why it fails? They get the wrong co-owner. Dono se jhagda. Most startups starts with a co-owner. 2-3 people start together. They were good friends. They were in the same college, same class. As they progress, they don't get along. Family background different, family pressures different, whatever could happen. Very important, the co-owners must be in talking point. Yesterday you heard that the co-owner of Indigo Airlines just walked out after so many years. And this is the time when they should have been together when airlines is fighting. But yesterday only walked out, as you know, you must have heard, need to see the news item. Co-owner. Number 3, do is get the right people. You could be most intelligent, but you cannot do anything yourself. You have to have the right people. The fire in the belly which you have, your people must have. Then it becomes successful. quick don'ts, quick don'ts. Most important don't is that don't compromise on ethics. You cannot compromise. Jhoot mat bolo. Don't take customers for granted. Don't do wrong things. Number two, don't assume just because you have a great idea there will be customers running after you. No, you have to create the customer, and that's the business runs on customers. And the last don't is don't go after valuation, sales top line. Those days are over. Believe me, those were the last 10 years. Now you have to show bottom line. Top line, very nice. They have all seen Zomato ka sab dekh chuke hain, Paytm ka sab dekh chuke hain. Valuation, you know where we are today. So therefore, bottom line profit is very important, and don't just burn money to get into top line. So the don'ts are, don't assume they are customers with you. Don't compromise on ethics. Don't only run after top line. You must make profit. If you do not make profit, no business stands. And history will say, or future will say that what I'm saying today is right. And most important do's is have 1 year's cash burn. Believe me, if you have a good idea, your project will be successful. Tell that to all your clients. They will hold you in high esteem. Thank you.
Perfect. I think really some of the do's and don'ts, of course, I must say, without knowing much about startups, are applicable equally in the profession. Never ever think of going away from your ethics, and even in the profession, ultimately cash flow, but not cash flow at any cost. So that is something universal. But I think Padamchand wanted to say something more on this subject, please.
There is a positivity, and that's extremely important what Banerjee has said. But we also have to look at the ground level realities. You have to make an analysis that these companies that are now headquartered outside, they are owned by Indians. That's the most important aspect. That means what happened? The venture initially began in India. When they found that idea being successful, then they were advised to move the intellectual property outside. At this stage, initial stage itself, where the valuation was very easy, they could have therefore made a statement that I will not have any transfer pricing issues. It could be going out of the country. But the promoters realized that the value is now coming from this idea. We need to move it out. Why should these promoters, having begun the venture in India, look at taking the intellectual property outside? That's the most important question that the government should ask. Because these people are worried, not just from the tax laws, they're also worried from the business environment. For example, data protection is extremely important. Their intellectual property protection is extremely important. Their dispute resolution is extremely important. So these are matters where India has not shown commitment to ensure that the ground level realities are addressed. If you have decisions, we have situations where even the Singapore Arbitration Council decision, we are not willing to follow. We are making a statement, I don't accept, I'll go further up. Who beyond God also will go somewhere. That's an unfortunate visualization we are giving to the international community at large, that we are aggressive, we are adamant. These are two attributes that the government should not exhibit. Therefore, people are saying, let me be outside because I know the talent is here, the intellectual property is outside, the development will happen from India. I'll make India only a service center, not an owner in terms of the property concern. They want India very badly. They don't want the ownership to remain here. They want the ownership to be outside. So that the exploitation, access to capital, security taxation, all this, the business regime, the contractual regime, data protection, dispute resolution, they are all much better in their perceptions outside. And these countries, especially Dubai, for example, now, or Singapore example, are encouraging intellectual property companies to come in to establish and say that we will protect you on all matters concerned. Finance, regulatory, business, all matters concerned, we will give you support. Therefore, the question for the government to ask very seriously is, these are promoters who are from India, idea is from India, execution happening from India. One legal ownership is outside. How should we therefore encourage these people to come back? How do you create a regime or an environment here in this country that will make these people comfortable that they come back to this country and start materializing their ideas in this country?
Perfect. I think we have traveled a little bit beyond taxation, but very nicely so and very essentially so, I think, because very rightly, as Padamchand said, and as Robin also mentioned earlier, these people go over there, stay over there, and they are still equally fond of aloo tikki or idli sambar, etc. They are not people who want to desert India. They are people who would love to be in India. It's only that they don't get the necessary support. And even Robin just made a mention about Indigo. If you see, read the fine print, their arbitration was settled in London, not in India. You know, what led to the eventual disinvestment agreement and so on. So these are things where I'm sure the government, we have seen a lot of change. This is one of the changes that is happening, that the government is becoming more responsive, more aware of these situations. Platforms like these should actually help and promote that. And all our professional bodies who are coming together, I'm sure the office bearers are here and they will take cognizance and move the right levers of power to see that we actually move in the right direction. So it's a good thing. And rightly so. You know, one of my favorite themes is that we get too blinkered in the sense of taxation, etc. We need to be acting also as good citizens of this country in seeing that we actually move not just to tax, but much beyond. But anyway, coming back to the main subject, you know, one of the incidents I asked Robin and also perhaps Padamchand, I would like view from you. To my understanding, as was mentioned by one of the persons here earlier in one of the panelists, that failure is an inherent part possibly of the process of startups, because some ideas click, some ideas don't click for reasons beyond your control. Is there a safety net available in the sense that if you take that there is necessarily going to be a certain failure rate? Does the tax regime provide that? Yes, even, you know, the interesting part is for races, if you lose money on 5 horses and you win on the 6th, there is a permission, there is an allowability that the 5 loss that you incur is allowed to be set off against your winnings from races within the same year. Is that same sort of situation in a broad concept? I'm not talking of races, but is that same sort of concept actuated so far as startups are concerned, Padamchand? Because all these are required to be separate setups, etc. when you go for registration. So is a promoter or is an investor or an angel investor protected from this when you go to losses, which seem to be an inherent risk that you run?
Losses are inevitable because you're looking at following an idea and trying to ensure that the idea reach a fruition principle. Losses therefore are inevitable. Losses could be of depreciation and business loss. Depreciation is going to be hardly anything because the costs are not because of investments in tangible assets or even intangible assets. They are because of operational costs. They're therefore largely business losses. Now, business loss can be carried forward, set off in a corporate entity only if you're able to demonstrate that 51% of the shareholders continue with you. So go to the year of incurrence of loss, find out who the shareholders are, look into the year when you made profit you're trying to set off. Ask a question, are 51% shareholders the same? And 51% shareholders would be 51% beneficial shareholders having voting power in that company concerned. If you're able to demonstrate that, then you're able to make a statement, I'll be entitled to set off the losses from an earlier year. So each year, every year that you make a profit and the year's loss you're trying to set off, that year and the year of set off, try and compare your shareholding pattern and make a statement. If your shareholding is 51% consistent, then you're entitled to carry forward the losses concerned. They also realized that this may not necessarily happen very easily to be satisfied in a startup case, because you would have invited so many people concerned, Series A funding, Series B funding, Series C funding, Series D funding. People have come in at higher valuations and therefore they have put in so much of money that the promoter, although he's being there, gets to below 51%. So when I try and set off the loss concern, I find that the year of the incurrence of the loss and the year when I'm trying to set off, the shareholders the promoter's capital has gone below 51%, and therefore he will not be able to claim the set off concern. To alleviate this, they're making a statement now in the law concern to say that if you are an entity and you are with some promoters concerned, let us say they put 25 shares each to 100 shares concerned. Now, over a period of time, because of funding, so many other shareholders have come in, but their shareholding has gone below 51%. Nevertheless, if you're able to demonstrate that the shareholders who were there originally in the year of incurrence of loss continue to hold all their shares in the year of set off, you'll be able to get the losses carried forward and set off. Therefore, This is an alternate regime given to startups concerned. Alternate regime. And this regime alternate is available only to a company, because in an LLP, I'm not able to demonstrate this. In a partnership firm, I'm not able to demonstrate this. And that those losses are not necessarily depend upon 51% shareholding. The 79, which is now relevant only for companies concerned, you will have to demonstrate that 51% shareholders continue to remain the same. One alternative. Second alternative is no, demonstrate that all the shareholders who are there in the year of incurrence of loss continue to retain all the shares concerned. This is a little unfortunate, I thought. All shareholders continue to retain all the shares is a little unfortunate. They're trying to give an alternate regime. But again, because of the insistence on all the shareholders retaining all the shares concerned, this becomes a little impractical in its application. Therefore, the alternate regime that they're trying to introduce for the purpose of set-off may not necessarily work out or pan out properly in actual life situation.
Yes, but one other aspect, Padamchand, I wanted. This is so far as qua the company or qua the entity. I am looking at also the investor, because if an investor, normally what we find is there are certain people who are willing to promote startups. If an investor were to invest in, say, 10 startups, just as an random figure, and as Robin said, 8 or 9 of those might not eventually ever earn money. The point is, I have invested, let's say, simplistically 1 crore in each entity. The one entity out of 10 that I invested 1 crore makes 100 crores. But the 9 entities where I invested money actually fold up. So I have invested 9 crores. It's an inherent part of my risk taking that I have not just put in 9 crores just for the fun of it. I was expecting to make profit. I didn't. Would that sort of an investment also get a proper set off?
So I was referring to losses made by the company concerned. And Jayant is asking a question from the investor's point of view. When he's investing in companies concerned, and 9 of the ventures have turned off, and therefore they are now failures. When do I get the losses? I can't get the losses set off unless I transfer those shares. Transfer happens to an external person, or transfer happens when the company is liquidated. The potentiality of me incurring a loss doesn't help you at all. The impairment by accounting standard doesn't help me at all. It has to be an actual loss that crystallizes on transfer of shares that happens when I transfer the shares to somebody else or the company is wound up. Now, the question that he's asking is that if there are certain losses concerned, will I be able to set off these losses against the gains? Now, I'm looking at an investor where it will be capital gains for him. Now, therefore, look at the classification of the losses concerned. Short-term loss or long-term loss. Intra-year and across years concerned. That becomes very critical because the wordings of 70 and 71 are very peculiar today. And therefore, they would make a statement, possibility, that if you are incurring losses, if there are short-term, adjust against short-term gains. If there are long-term, adjust against long-term gains. Therefore, there is some sort of an inherent disadvantage that if you are incurring losses of different nature, some gains are short-term, some losses are short-term, some gains are some losses are long-term. And you have a particular type of gain, which is one particular character, then only that band will get adjusted. Other band does not get adjusted unless you have a similar item of gain in that year or in a subsequent year.
I was just looking that perhaps, when we start a debate on this aspect, perhaps this can be maybe considered in future in the various submissions that our professional bodies make. But anyway, coming beyond that, let me come more to the broader aspects. There are now emerging issues that are arising in terms of digital assets and cryptocurrencies and so on. Honestly, somebody asked me recently about it. I said the simplest thing is, and another very well-known author wrote in Business Standard that the best thing to do is that don't invest in something that you don't understand. So far as I'm concerned, that's the end of story. But there are many other investors, and I'm sure I would request Sunil to throw some light on what would be the case on some of these assets, the digital assets, cryptocurrencies, how would the tax authorities look at it, and so on.
Thank you, Jayant. Of course, this year the budget has made amendments as far as the direct taxes are concerned, and there is a very specific regime of taxing digital assets which has been brought into the direct tax regime. Indirect tax again is, as I started for startups, even for digital assets, there's a virtual silence in the indirect tax law. But honestly, they don't need to say anything because GST is applicable on all supplies of goods or services. It's very comprehensive. There are 3 or 4 notable exceptions. One of them is money, transactions in money. are excluded from the purview of GST. But the fact that RBI is coming out with its own digital rupee, and also the fact that the cryptocurrencies are now defined as virtual digital assets under the Income Tax Act, would lend support to say that this is not money. And even if you go to the technical definition under FEMA, this would not be recognized as money. So you cannot claim an exclusion under the concept of money. Second important exclusion is securities. And that's where we very loosely use these words, like people say I am an investor, and they would like to equate an investment in a crypto with an investment in a unit or in a derivative or in a shares. Now they miss a very important footing, that when they invest in shares, GST is not applicable because securities are outside the purview of the GST law. The Securities Contract Act is again not wide enough to cover cryptocurrency within its purview. And therefore, when you look at even a last leg retail, I mean, I'm aware that in the Business Standard article, a few days back, there was a discussion about the persons who are mining cryptocurrencies. Definitely they would get covered. The crypto exchanges on their fees which they receive, clearly, I think they are all open issues and everyone is aware of it. But through this forum, I want to highlight to the so-called investors of cryptocurrencies, because I could clearly see a risk over there also. And it would be very difficult for them to wriggle out and say that, look, I was buying shares and selling shares, there's no GST. Like that, when I buy a Ethereum or a Bitcoin, again, there's no tax on that. It's going to be a very, very tricky part. Again, we are talking about situations like NFT. Where an NFT basically represents a digital art. We are aware that when a physical painting is auctioned, there's a GST on that. And if there's a GST on a physical painting, why not on an NFT? I think there are very few arguments which would be available for defense. And the volatility in the pricing is so high. If you are going to factor in 18%, it can become really a complicated mechanism to ensure, compliance is at a future point of time. So this is one important thing which I thought would be relevant from a crypto's perspective.
I just want to add something, Jayant. I know my fellow chartered accountants are all here. I just want to say a little, 2 to 3 minutes on cryptocurrency. First of all, ladies and gentlemen, it is not a currency. It is not a currency. Cryptocurrency is not a currency. Currency means something. You have 100 rupees in your pocket. You can carry it with you. Somebody is going to honor it, and you can have a cup of coffee. You cannot do that in a cryptocurrency. I know there are millennials sitting here. All of you may have already invested lots in cryptocurrency. So you will bear me out, just hear a view. It is just a view. A view could be accepted. You can reject a view. So it is not a currency. It is not a store of value. It is uncertain to store of value, and it is not acceptable everywhere. Therefore, it is not a currency. But most important is, when you have a cryptocurrency and you guys are investing in it, you're first thinking that there is a value in it. What is the value of any product? Value of any product, any asset, anything in the world depends upon demand and supply. What is the demand of cryptocurrency? Who buys cryptocurrency? Where is the demand? Why does anybody buy cryptocurrency? You can do business with your currency which is accepted and monitored by any central bank of any country. Therefore, the basic demand of crypto comes from the underworld. Whether it is arms and ammunition, whether it is drugs, whether it is untaxable money, but there is black money available, the untaxable money is there. So you never know, none of us know, I don't know what is demand of cryptocurrency. What is the demand? Next, what is the supply? If you don't know demand, you will supply. There are 15,000 cryptocurrency, ladies and gentlemen, 15,000. You can say Bitcoin, I know the supply because the supply is going to end in 2022. Who knows? Who knows? We don't know. Number two, what about the others? Nobody knows the supply. You just start making cryptocurrency and then that's it. The supply can enhance and keep growing up. So why should you deal in a product which you don't know demand, you don't have a supply, therefore the price cannot be determined, no way. 2, it is not a currency. And 3, being a chartered accountant, why the hell would you deal in a currency which is outside the central bank's territory? You are therefore dealing inherently with black money. There is no difference between black money. Government cannot control. So what's demand? What's the problem with the digital currency we have in our wallet? There's no problem. You want to buy something through Amazon, you buy, pay through the internet, and there it is, digital currency. I know sometimes cryptocurrency is interested in digital currency and vice versa. And the most cryptocurrency exchanges and the owners say, oh, cryptocurrency is very good because if you don't do that, you are not encouraging blockchain. Blockchain, ladies and gentlemen, has nothing to do with cryptocurrency. Cryptocurrency is a subset of blockchain. That does not mean the blockchain technology cannot be used in other ways. In warehousing, blockchain, logistics, in hospitality, hospital, banking, blockchains cannot be used. Just because crypto uses blockchain and new technology does not mean crypto is a good asset. Be careful, ladies and gentlemen. Believe me, it's a fraud. And don't be surprised, crypto will be valued at 0 one day. Take my views, discounted 100%, but it's your call. Thank you.
Wonderful, sir. I think that you want to add something?
Please go ahead. You can add so many things. Money is a matter of functions for a medium, a measure, a value, a store. Money is a matter of functions for a medium, a measure, a value, a store. So anything that does its functions is called money. That money becomes legal tender by virtue of RBI blessing you on this matter. If RBI does not bless you on this matter, then the question is, it doesn't become legal tender. But then in the perception of people, see, I am also in endorsement of what Mr. Robin has said, that personally speaking, I would not endorse this as a matter of exchange. But then we are all old people and we are supposed to therefore not be in tune with things, and therefore the younger generation is going to say, let these people talk. We are going to do a transaction in crypto. It's giving us some sort of an excitement. Let us enjoy the excitement, whatever be the failures or upsides or downsides of it. I'm personally in endorsement with what Mr. Robin has said, but this is not going to be acceptable to the younger generation, and therefore something that we will have to live with it. Something that we'll have to live with it. Something that about 10 crore people is the official estimate in this country who have somewhere or other had an exposure to crypto. It's a large population. And therefore, we need to be looking at the tax implications. Tax implication doesn't mean I'm legitimizing. I'm only recognizing, that's all. There's a difference between legitimizing and recognizing. I'm only making a statement that I'm making it taxable. Anyway, it's taxable. There's no law which says that income earned by whatever mechanism in whatever transaction is not taxable. It's only taxable. I'm trying to define certain rules because there are going to be a lot of restrictions in terms of a set off, carry forward, rate of tax. I'm trying to lay down the ground rules of crypto. All crypto means that NFT, the token, the number. No, that definition is very wide. The definition as attempted Income Tax Act says by cryptographic means or otherwise. They're making a mess of the definition by saying by cryptographic means or otherwise. Now the word otherwise is so broad, so wide that if I have a flight point, I've traveled by air today and I've got flight points now. Is there a number? Is there a token? Is it encashable? Is it virtual digital asset? Point that I get exim scripts concerned. So the definition is so badly done today that we don't know where we are leading to. In the process of reaching out the largest or the highest number of transactions in something that is not tangible in nature, I'm trying to make a very comprehensive definition concern to call it by various names and looking at the source also to say it could be by cryptographic means or otherwise, and go on to say anything that is a measure of value that represents value concern would be called as a virtual digital asset. Now, this is an initiative from the Income Tax Department. It's unfortunate that not just the Income Tax Department, the RBI is involved, the SEBI is involved, because these are all government agencies that are required to be a part of this transaction. They're required to be giving their inputs. Academicians are required to be there. The government should invite the business people, the technology people to come into this. Only then we'll be able to have some sort of a meaningful discussion to drive through the tax laws to say that I will have some sort of an understanding of the crypto and this business implications. In my opinion, is not a very sound step. Therefore, it's something that needs to be deferred from a tax law point of view, having understood the contours. It should be a situation where the government should have a high-powered committee on this matter to ensure that people, specialists from various organizations who are going to be impacted by this, they give their inputs. Ultimately, thereafter only the government should frame the law.
Excellent. I think actually this is what ideally a panel discussion sort of a format brings out, because you've got a very, spectrum of views. Thank God I said right at the beginning that I don't understand it. So in fact, I would just emphasize, I'm more on the, as both of them have said, I'm of the earlier generation. So I believe in the fundamental concept that if you don't understand something, best stay out of it. And this age-old concept is a tried and tested concept. I would agree with Robin in that regard, that while it is not recognized as a career, there are various moral shades to it, whether it is legal, illegal, etc. There are other thoughts, as Padamchand mentioned, that it is the reality, so you can't run away from reality. Both the things are equally true. The last point I'm making is that, privilege of a moderator. The point I'm making is, if you don't understand it, stay away from it. That is the basic rule. But then I equally know, and there I agree with Padamchand, that if that rule were to be followed by everybody, and that's not my concept, Warren Buffett has said that. But the problem is that markets, trading, etc., is driven not by understanding, but by greed. If people were going as per understanding, believe me, 80% of the people trading on the stock market also would not be there and should not be there. But that's a different matter altogether. People who are running businesses don't understand tax. They shouldn't be there because they need to understand, but then they are there. So that is the reality. We have to cater to the reality. So while I agree with Robin on the concept, I equally agree with Padamchand on the point that even though you may agree or disagree on the conceptual aspect, you have to live with reality. And I think RBI is heading in that direction of recognizing the ground reality. But irrespective, I think I am coming to the last question within the time that we have. And I would also invite any of you to add some last thoughts in case you wish to. But the last question I would like to ask Padamchand, he did make a mention of that in passing. So if you would like to elaborate, that we have spoken about not just the Income Tax Act and the other indirect tax provisions, but one of the reasons he mentioned is that people are moving out because of the problems of intellectual property rights, protections, digital rights and transfers, royalty payments. All these are aspects which are now, although they may seem peripheral, are very important to startups. So would you have something to say in that regard?
These are extremely important because idea when it's going to materialize is moving out of this country. Intellectual property is moving out. License is coming back to people in this country for the purpose of exploitation in terms of marketing. Therefore, there's going to be some sort of a payment made for that intellectual property. The question therefore arises in terms of the royalty aspect. That's a smaller issue in my opinion. The larger issue in my opinion would be the MLI articles, the action plans, action plan 8, 9 and 10 of the MLI or the entire BEPS action plans, which talk about intellectual property and the attribution of profits out of that intellectual property concern. The DEMPE concept, the development, exploitation, maintenance, enhancement concepts of DEMPE. They're now making a statement that if there's an intellectual property outside and that has been enhanced by certain efforts by anywhere in the world concerned, and we're looking at India contributing to the enhancement of that IPs, the development of that IP, the enhancement, the protection, the maintenance, and the exploitation of that. If India is contributing to that, then India deserves a big chunk of the pie, depending on the DEMPE value, when the intellectual property is ultimately sold to somebody else. So capital gains made outside should be therefore liable to be taxed in India. This is going to be a significant factor, in my opinion, over a period of time about the DEMPE aspects. There were already a concept of location savings coming about, that if the fellow person has made significant profit because of he finding cheap labor in India, therefore he having a location savings concern because the ultimate property was developed out of savings in terms of the cost incurred, then the location savings will also to be required to be given some value when the ultimate capital gains were made. That location saving is now getting subsumed into the DEMPE concept concern. Therefore, it's going to be very interesting in terms of the actual output tomorrow. When India is going to get a benefit of that, how is it going to get benefit? How is it going to identify when the sales are happening? Conceptually, it is fine. Practically, we'll have a lot of issues concerned in identifying when the property is sold, how the reporting requirements would happen, how would India ever come to know about this sales concern. Conceptually, yes, India could get into a serious issues of aggressive revenue saying that I will chase those profits concerned. So those are very exciting terms in terms of international taxation, especially when government is becoming very aggressive with the BEPS action plans and MLIs. And there is some sort of a consensus that every corporate in the world is now trying to push monies or profits into tax havens. They're trying to avoid taxes, and the government is increasingly empowering itself to ensure that in terms of power and in terms of presumptions, both power and presumptions are in its favor. the principal purpose test, the GAR test, these are all presumptions in their favor. And powers are also being increasingly retained by the governments concerned to see that we get to what we believe to be the tax concern. And India is becoming very aggressive. If you look into the action plan 1 on digital commerce concern, they said, choose one of them. Choose either equalization levy, choose SCP concept, choose TDS concept. Even in SCP, they said, have a combination of value or number. Have a combination of value and numbers concern. What did India do? It adopted all 4. See, SCP, value separate, number separate. TDS, yes. Equalization levy, yes. So people are scared about the aspect that you make a recommendation to this country concerned. They will say, I'll adopt all of these recommendations, although the recommendation was choose only one of them. That's the problem that we are now showing as an attitude in terms of the government, in terms of looking at the tax implications of a particular transaction. They're going to be very interesting and very aggressive times. I was telling somebody that the amount of complications they introduced now in the tax laws in the last 2 years is sufficient to give me an extension of my retirement by at least 15 years back. Thank you.
Very good. So all of us can look forward to a very educative period in the next 15 years. I'm sure Padamchand will continue to share his knowledge with all of us. Any last thoughts, because we are almost out of time. So
yeah,
unless
one
there is any-
practical issue I wanted to ask Robin sir. Recently, one of my colleague, his client was into some idea of startup. He was wanted to form a fintech company. So in that case, his investment was hardly 5 or 10 lakhs for a software or something. But if I'm not wrong, some RBI requirement is there of 5 crores minimum paid up capital. So in that case, what you will do? This hindrances will not encourage such kind of startups.
My understanding is, if you want startup money, the maximum funding which will come from DPIIT is 5 crores. Is 5 crores minimum paid up capital required? That's not my understanding.
If I'm wrong,
that's
please
not
correct
true.
me.
That's not true. But 5 crores, up to 5 crores funding will come.
No, I think I perhaps understand the query which you tried to ask. Typically in fintech, and this was one example which we actually came across, wherein there was a concept of a retail P2P lending. So it's a concept wherein retailers want to lend to the unorganized sector, and the technology platform is created whereby anonymous lenders lend money to anonymous borrowers as unsecured loans. And this is a product which has been endorsed by RBI, P2P lending, and there are these fintech companies which get involved into it. There they are not defined as NBFCs or as banks. They are a step below because they don't invest their own funds except for the technology part of it. And that's where I think they have kept a minimum capital adequacy ratio. I think that's what Jaydeep is perhaps referring to, because it's still playing with lots of people's money.
Yeah, it is for protection of stakeholders, but then
Protection of all the multiple
stakeholders. Yeah, it is not
stakeholders.
helping fintech companies.
Yeah. And here, in fact, we had a larger indirect tax issue because this was a direct anonymous borrowing lending concept, and the revenue which comes to the borrowers, to the lenders, is both from interest and processing fees. We had a situation that all the lenders who might be salaried employees who would be just lending 20,000, 50,000, because that's the ticket size they were looking at. They would get some 100 rupees or 200 rupees as lending fees. And on that, for that 100 rupees of GST, the entire ecosystem would have to go into the purview of the GST, the provisions which we just highlighted earlier. And therefore, they have to do away with that processing fee concept itself. They said, we'll forego that revenue, we'll only charge interest and have a revenue model which is based only on interest, so that interest is anyways exempted, so we are not worried. So this is how I think somewhere the laws are not able to keep pace with the ground level realities and are not fostering the startups.
Okay, so I think that really brings us also to the end of the time that we have, but I believe we have raised, I think most of the questions have been answered, but we have equally raised a good number of issues which are meriting a good amount of thought. I'm sure we are as a profession, all of us are initiators of that. So I'm sure some positive outcomes will flow from that. With that, let me wind up at least my part of the role and hand the session back to the chairman. Anil.
Panel discussion. It's a Saturday evening. So most of you who are here and most of you who are here virtually have something else possibly in mind as well. So therefore, I'll not take up any further time on any comment. I'll just request Jaydeep to propose a well-deserved vote of thanks. Jaydeep, please.
At the outset, I would like to thank organizers for giving me this pleasant task of showering words of gratitude to all the esteemed panelists. Well, then, when we talk of startups, I will talk in terms of valuations. All will agree that we have definitely raised the valuations of our knowledge today. But like every good thing comes to an end, this esteemed event is coming towards its satisfactory and fruitful end. All the three panelists, Padamchand sir, Robin sir, Sunil bhai, have done complete justice to their domain of practicing areas and carried this discussion to a very informative and conclusive end. And of course, Jayant sir has done great job of moderating this discussion. All will agree, it was indeed a treat to witness great minds exercise brainstorming of new dynamic issues like startups and digital ventures. I thank on behalf of 6 associations to all the organizers, dignitaries on the dais, off the dais, and all the panelists for your time and enlightening our participants. I would like to sum up with this few words of gratitude and thank you.
Company